first resistance would be 24,300. One stock that was already in the band, that is SAIL, and LIC Housing has entered into the band. Some of the stocks that I'll be watching out for. First one is SBI Life has been seeing addition on the long side. BHEL, Page Industries have been seeing addition on the long side. On the short side, both the Gold Finance, Muthoot Finance and Manappuram Finance.
Okay, Sudarshan, thank you so much for that. But on that note, now let's move on. And we had the SEBI chairman, Tunkanta Pandey, who defended the new closing auction mechanism once again. He also said that the regulator is very close to approving the IPO papers filed by NSE. Listen in.
Are we very close to the approval for the IPO, for NSE's IPO?
Yes, we are close. नहीं, अभी हम कोई changes नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी ऐप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
Okay, now let's move on and get you the updates in the world of commodities this morning. We have Manisha joining us as always. Good morning, Manisha.
Morning, Vinny. Thank you for that. I want to start with metals because that is where the major gains seem to be coming in from. This week, we've seen an all-time high in case of copper. Zinc is trading at a 4-year highs, and this is as the inventories outside of US, outside of China have continued to decline. Especially for zinc, the LME inventories are down by 65% from where they were in the month of January, and they are the lowest since April 2023. Tin as well has been gaining. It's trading at a 2-month highs right now. Indonesia has cut export licenses, tightened mining permits, and the demand for tin, especially from AI and memory chip companies, has continued to gain. So metal continues to be in favor there. The crude oil prices in the meanwhile are also holding around that $89 a barrel mark. And this is as markets to look at two different things. One, the diplomatic progress in Middle East, Iran-Oman reaching a revenue sharing agreement over Strait of Hormuz. And on the other side, you have escalations now coming in for Russia-Ukraine war, which has shifted the market attention from Middle East to East Europe now. And that is where the cues would come in from. But having said that, it really is going to be about the Jackson Hole meeting today and the statements coming in from that. A final word I want to have is on the agriculture space, because this clearly has been surging. Overnight, you have seen sugar gain up by 3.5%, cotton 3%, cocoa prices gained up by nearly 7% as well. So agriculture absolutely on fire.
Okay, Manisha, thank you so much for that. We'll keep an eye out on metals as well as the agri side as well, which has been on fire. But let's move on, and on that note, take a short break, because after the break, we're going to come back, tell you the cues from Wall Street. Stay tuned. Welcome back, and thanks for staying tuned into Power Breakfast on CNBC TV 18. Now let's get to the latest updates from West Asia. Qatar's Prime Minister has met with officials in the Iranian capital to discuss critical issues such as Strait of Hormuz amid international hopes for renewed dialogue between the US and Iran to end the conflict. Iran's chief negotiator and parliament speaker told Qatar's Prime Minister that Trump's administration makes incorrect decisions driven by misinformation, which which wastes U.S. resources and destabilizes the region. Meanwhile, Iran says that it is preparing a list of conditions to open the Strait of Hormuz following mediator requests, pointing out that U.S. must first take practical steps to fulfill these demands before the waterway reopens. Furthermore, U.S. Central Command stated that American forces have redirected 75 commercial vessels, disabled 3 and boarded 2 others to ensure compliance with the ongoing naval blockade. Let's move on and talk about what's happened on the U.S. market front and Wall Street. That saw a rally coming in yesterday's trading session. Nvidia's earnings, that is something that powered the broader market as well, with shares surging almost 9% on the board fiscal 2028 growth forecast. Let's go across to CNBC's Peepa Stevens, who's here to give us a wrap on what happened on Wall Street.
Stocks were up across the major U.S. indexes in Thursday trading as Nvidia powered the broader markets to the upside. The Dow gained 106 points, the S&P added 55 points, and the tech-heavy Nasdaq was up 411 points, a more than 1.5% increase. The tech sector rose Thursday on the strength of Nvidia earnings. Shares of the world's largest company by market cap surging almost 9% after beating analyst expectations and projecting 70% growth in fiscal 2028, way higher than the 44% analysts' forecast. That forecast lifted semiconductor stocks along with cybersecurity and even the embattled software sector, including Salesforce, which climbed 21% on strong earnings and an expanded partnership with Anthropic. And European soccer's governing body, UEFA, is preparing a criminal complaint in Swiss court against FIFA president Gianni Infantino over possible financial mismanagement in Infantino's failed bid to sell off parts of the World Cup to private investors. He's facing accusations that he fraudulently offered those stakes without due process. UEFA says it's requesting discovery of potential evidence from Thrive Capital, founded by Josh Kirshner, which was going to spearhead the private investor initiative. That's what's happening here in the U.S. Back to you in Mumbai.
Peepa, thanks so much for that. But now all eyes are also on the annual Jackson Hole Symposium, where Federal Reserve Chair Kevin Walsh is expected to make a speech later today. Investors will be looking out for policy clues about the interest rates as well as inflation ahead of that as well. CNBC's Steve Leisman is now here to give us a preview on what to expect.
The Fed chairman's speech in Jackson Hole is always listened to carefully for clues about his outlook for rates. Will he be hawkish? Will he be dovish? This year, markets are listening for whether Kevin Walsh talks about policy at all. He's held back on his views to get a cleaner message of market pricing not influenced by his own Fed speak. But Walsh's colleagues in CNBC interviews here in Jackson Hole have not been shy about offering their outlooks.
I believe now is the time to act. I believe that we've been in an inflationary situation for more than 5 years. It's been running well above our target. I don't see any restriction in policy.
I think we may be a little bit more accommodative, certainly more accommodative than restrictive in the policy rate.
Schmidt did say he thought Fed officials could talk less, while Hammack offered it was her responsibility, she thought, to share her policy views. Tobias Adrian from the IMF writing, quote, broader communication about reaction function remains essential as long as it is conditional, disciplined, and uncertainty aware. Risk should be clearly spelled out. Walsh may give markets at least some of what they hope for tomorrow, potentially making a distinction between what he's willing to say in a speech on his own compared to when he's representing the committee after a meeting of a press conference. Steve Leisman, CNBC Business News.
Thanks so much for that. But now let's move on. And we have some opinion coming in from former officials Loretta Mester, Fed officials Loretta Mesters, as well as Stephen Moran, on what to expect from Kevin Walsh's Jackson Hole speech and the Fed rates trajectory. What is it, the outlook over there? Listen in.
I think the public, too. I mean, it's an accountability issue. We want to see how a Fed chair is thinking about the economy. He doesn't have to promise us anything, but just how is he seeing it? What does he look at? How's he evaluating the current state of the economy? And an explanation of why perhaps they made the decision they made in July, and you know, what, not about September, but just explaining what he did in July and why.
Mm-hmm. And you continued to get better inflation data, which we've gotten now, a couple of months of much better inflation data. It would be weird to sort of say, okay, before I thought it was appropriate to hold, now we got good inflation data, and now I think it's appropriate to hike. There's no reaction function that gives you both a hold in June and July and a hike in September.
Okay, that's the update coming in there on US front, as well as what to expect from Fed Chair Kevin Warsh's speech as well. But let's move on and get to the latest in terms of Trump-related developments this morning. First up, US President Donald Trump escalated his symbolic and substantive trade standoff with Canada, signing an order to rename Lake Ontario as Lake America. The move follows days of Truth Social threats tied to collapsed US-Canada trade talks and Trump's push for the 50% auto as well as steel tariff on Canada from Jan 1st. Canada has flatly rejected the renaming, calling it symbolic bluster with no legal weight outside the US federal usage. Moving on, and when asked about the CIA Chief Secretary's visit to Moscow, which was a surprise visit, right? It was more of a secret. Trump said that Trump wouldn't confirm anything in terms of a warning, but was blunt on the outcome. He says that he's not going to be attacking the NATO territory. That's a word he said for President Putin. And this comes right after Wall Street Journal reported that Putin could try to limit the assault on alliance within years. Now, Kremlin has confirmed that CIA visit took place, calling it a routine visit. Moving on to the last commentary that we have, President Donald Trump took Truth Social to celebrate Micron's $10 billion investment in new U.S. research labs, calling the chip maker one of the hottest companies in the world. He said that the move layered on top of Micron's existing $25 billion American manufacturing commitment, which will create tens and thousands of jobs for the U.S. and keep U.S. at the forefront of AI and advanced computing. So that's all the update that we have in terms of President Trump's commentary this morning. But on that note, we're going to sip into a short break. We'll come back and give you the updates and latest from the world of AI. Stay tuned in. Welcome back to Power Breakfast on CNBC TV 18. Now getting you the latest updates from the world of tech and AI. In our special segment, AI Pulse, we have Rachna joining us to take us through all of that. Rachna?
Well, first up is NVIDIA that has stepped back from part of its newest financing program. The company had been offering credit support to AI cloud firms in exchange for a share of their revenue. As per the Wall Street Journal, some NVIDIA staff has told the customers now that the arrangement could draw antitrust scrutiny. NVIDIA says the model it introduced in July is still in place. That report landed after Thursday's close in the session itself that NVIDIA shares finished about 8.7% higher, reversing the fade that followed the Wednesday night's results in Washington. Then Washington is weighing a fresh round of chip tariffs, and this time the duties would reach beyond semiconductors to products built with them. As per Politico, that could mean laptops, gaming hardware, and the servers going into AI data. The White House says any tariff reporting it has not announced should be treated as speculation. Then there's Anthropic that's looked at buying its way into chip design. Reuters has reported that it discussed a roughly $7 billion purchase of the startup Matex. Now, those talks have since shifted to a partnership, and Anthropic says it is building an in-house silicon team now. Now, all of this sits just ahead of the listing. As per the information, the prospectus comes after Labor Day with a debut targeted for late September or early October. Anthropic also went public with a model hardware standard, an interface that lets AI agents operate physical machinery from microscopes to robot arms. It works with any programmable device and it is not tied to Claude. then 116 companies have signed an open letter on cyber defense. OpenAI, Anthropic, Google, and Microsoft are among these companies. Now, they warn that AI-enabled attacks will become far more widespread within months and warn governments to fund defenses for hospitals and water utilities. To Washington again, then the WSJ reports that UAE National Security Advisor and his co-investors hold about 49% of the holding company behind the Trump's family planned crypto bank. Now, this is amid Washington is weighing UAE access to advanced American chips. That's all we have from the world of AI and tech, but we'll get you more updates through the day.
Absolutely, Rachna. Thank you so much for that. But getting some updates from a neighboring country, we have the death toll from the massive Nepal-Tibet flash flood that has risen to 392 as rescuers continue to trace hundreds of people still missing, including 290 Indian nationals. Of the 392 victims, 389 died in the flash flood in Nepal, while 3 were killed in neighboring Tibet. Nepal authorities have issued a fresh flood warning after satellite images showed a lake had formed at the site of the earlier flooding. Now, India's External Affairs Ministry and Indian Embassy in Kathmandu have issued emergency helpline numbers for Indian nationals seeking assistance. And with that, we're absolutely out of time on this edition of Power Breakfast. Thank you so much for tuning in. Up next, your Passar Morning Call.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. It's a Friday morning. And with me, my colleagues Nigel and Rima. Guys, hi, good morning.
Hi, good morning. So final trading day of the week, final trading day of the month, and two key headlines, right? One, U.S. markets closed well, particularly Nvidia. So Nasdaq up 1.5%. But what happened in the cash session? The last 10-15 minutes, markets slumped and now below 24,100.
Well, that's right. We've got the full day to talk about markets and the cash session as well. Wishing all the brothers and sisters out there happy Raksha Bandhan, my sister in particular as well. Lucky to have a sister like you. Wishing everyone a very, very good day. And I think at parts of India, I think volumes will be relatively lower because people would have taken the day off, but we don't have that luxury.
Guys, schools are shut, so at least
Not
in
all.
Bombay. Oh, not all, but yeah.
Well, many are shut.
This week was tricky actually because you had a Onam, you had Eid, then you had, so one school or the other was shut. In the newsroom, in fact, I heard someone say, oh, you've gone to school? Oh, but it's shut. Okay, then take her to the play area.
Okay, all right. Well, happy Rakhi, as Nigel said, to everyone out there, everyone who's celebrating and everyone. It's a beautiful day. Well, let's just take it from the top then in terms of what you need to know as you begin a fresh new session. Oil's at what, 89, actually 89.5 now, right? It's up a little bit. So we were at about 87. The high was about 93 when we came into this week. Then it dropped to 87. And for the last 2 days, we opened this, this show at 87, and we're at about 89.5. So slightly worse off compared to the previous two sessions. As is expected to happen, diplomatic efforts, there will be roadblocks, stumbling blocks, and so there's a bunch of things. I'm not going into details, but I think it's pretty well understood that it's not a sort of if this situation is not a clean kind of a situation to be resolved with the stroke of a pen and a handshake. It's become, of course, much more complicated than that. Treasury yields were up once again, so 3 to 4 basis points across the curve as far as the U.S. sovereign bonds are concerned, yields are concerned. Equities also came up. Nasdaq was up 1.6%, and that's largely because of the two stocks we mentioned yesterday, same time as well. Because yesterday, same time, Nvidia, we were looking at the after-hours trading action, was up 5%. It closed up 9%, by the way. Numbers have doubled, and they're saying, well, they'll grow up another 70%. That's the thing. It's the steepest, largest one-day jump since April 2025. Salesforce in after hours yesterday, at the same time we were talking about it being up 15%. It was up 23%. And, again, strong revenue outlook. It's all numbers related on these two. US data, you had the jobless claims numbers, you had the trade deficit, etc. Goods trade deficit, well, little impact per se. And, of course, all eyes today, later today, on the Jackson Hole Symposium and Fed Chair Kevin Warsh's speech. Is he going to strongly indicate what the Fed is leaning towards to do in September? And a bunch of other things on the bonds and, communication and et cetera, et cetera. So there's a fair bit. It's a new chief at the helm. And markets, of course, have been on the tenterhooks in that sense. Now, let me just quickly, before I time the levels here, tell you what happened yesterday as far as the cash session is concerned. Yesterday was the first BSE, first expiry on BSE, monthly expiry on BSE post the cash session introduction, right? So you had the weeklies which expired. You had also the BankX monthly which expired. And look at the rates up on your screen. This is the final close, right? So the BankX, the BSE BankX ended 800 points lower compared to the 315 price. And the Sensex ended 250 points lower compared to the 315 price. So these are very, very large moves that we've seen on the Sensex indices, the Sensex and the BSE BankX as well. But the real thing is what happened intraday during the session, right? This is between 320 and 328. The Sensex traded 2,000 points lower for almost, 4 out of those 8 minutes during the cash session. So 8-minute long cash session, Sensex was down 2,000 points for almost half the time. The BankX at one point was down 3,000 points during the cash session, and then it kind of settled higher. We know this because now, as we all sort of, we put this out live as well. We know this because exchanges and everyone gives you indicative closing prices starting 320. So that's the price I'm referring to. So at one point, these indicative closing prices on the BankX and the Sensex were down 3,000 and 2,000 points respectively compared to the 315 price. Now, as a result of this, all kinds of crazy action. I mean, imagine 3,000 points lower on the BankX, right? And what will happen to option prices? Option prices went absolutely berserk, out of control. So one out of the money BankX put option basically was trading at about 20 rupees. It went to 600. I mean, there were trades at 600. Actually, the high on this was 1,000 rupees. But this is 30x still, right? Before, of course, cooling off. And the thing is, it's not as if the BankX was BankX settled within, it came back to the 315 price or settled near the 315 price. As we just said, the BankX sold off pretty hard, and it was down 800, 900 points, as lower as compared to the 315 price. So basically, people with option positions would have been taken. A lot of them would have been taken to the cleaners. Those who were trading on the BSE yesterday. So I think this once again, I guess, reignites the debate around the linkage between the futures and options market and cash. Lots of people are focused on cash and whether cash is desirable or not. But I mean, I think from day one we've said why both have linked. And that, I think, is a debate which is worthwhile having, and we'll continue to focus on this. Now, just the levels here. So the Nifty support and resistance. So 24,040 is the first support. Below that, we again kind of stare at 23,600, which is the low that the Nifty has seen in prior periods where the markets come off sharply. And these are near-term levels. So focus on 2440 as the first one. The resistance, the first one, is 24,375. On the way up, the market got stopped out at 24,375 twice in the last 1 month. And then, of course, after that, it is 24,500 or so. But the range is 24,375, 24,040, both resistance and support this morning. The GIFT Nifty comes up, gives you a quick sense of how we start. 26, 27 odd points lower to begin this Friday morning. Well, Nigel has walked across to the wall with the futures options data, the positioning. Nigel, take it away.
Well, the closing auction session yesterday brought a fair bit of volatility on the Sensex, and that's where we had those wild swings of more than 2,000 points. Just one word of advice, writing of index options is not for the faint-hearted, particularly on expiry days. And particularly with the introduction of CAS, I would recommend you completely avoid writing of options as well. Buying is, still your losses are limited, but writing, your losses can go extreme. So just keep that in mind. For the time being, I think completely avoid it if you're not a professional trader. Well, moving to the other point of debate then. In the cash session, remember the NSE and the BSE, they conduct their closing auctions independently. And that's what's making things tricky. Case in point being IndusInd Bank. Just look at it. Just look at the difference. It's a 3% difference on a very, very liquid name because of, the cash session is independent on both the exchanges. Even if you look at an IDFC First Bank as well, out there as well, the difference was close to around 2.5%. So, something needs to be relooked, I think, in terms of this. Or maybe, a bit of restructuring will help, traders as well as investors. So we'll see how that goes, but just thought I'll point this out as well. Moving to the flows, well, they have been skewed because of the large trades that we've seen, but good to see institutional number, it still continues to remain positive. Now the FIs, they're going ahead, they're adding short positions. Both on index futures, there were short positions. 10,000 contracts were added on the short side. On stock futures as well, you had close to 21,000 contracts that were added on the short side. And the positioning on index futures, the short positioning has moved to around 90% or thereabouts. They were fairly defensive, fairly cautious yesterday, actually, because the FIs, they continue to write calls as well. Yesterday, close to 1 lakh contracts were written on the call side in the ratio of close to around 2 calls for every 1 put. And some of the strikes should come up for you on the screen. 24,200 call, 60 lakh shares getting added there. Premium close to under $100. 24,300 call as well, 44 lakh shares getting added there. Premium ballpark around 60 rupees. While on the downside as well, the 24,000 put, it was a mix of activity that you're seeing. But just take a look at the difference in terms of the call addition as well as the put addition. The call writers, they are at play. And because of this sort of a move, you're seeing that the PCR is moving gradually to the lower end of the range. The question is, will this sort of a combination, that is the PCR moving to around 0.7 and the short positioning moving to around 2 lakh contracts. In the past, this combination has called for a bit of a pullback. So if the Nifty, pulls back close to around 50, 100 points today, I wouldn't rule out some kind of a relief rally actually, because this combination normally has spelled good news from a bullish perspective. In terms of the levels to track, well, the recent low, that's a month or so ago, you had this low level, 23,950 going by the options data as well. It's important that that gets defended on the downside. On the upside, you're looking at the 20 DMA as the first level of resistance. So I think that's the near-term range that you're looking at. But as I said earlier, the FI short positions are getting piled on. The PCR is moving to around 0.7. Normally, that's a combination where you see a bit of a bounce.
All right, thank you very much for that. Cass Apocalypse, that was a moniker coined yesterday, given the kind of extreme volatility and chaos which was triggered in yesterday's trading session in the final 20 minutes. But an interesting equity call coming through. It's Mahesh Nandarkar of Jefferies, who says Indians hold an estimated $4 trillion in gold. This is 4x the money held in stocks. And if the recent surge in gold prices extends on the back of dollar concerns, wealth and spending would be likely visible. He says monetization of gold savings via gold-backed loans has gained salience and could be driving 80 basis points of additional GDP growth and spend if there is a 10% gold price increase, and partially offset by higher current account deficit. He adds Manappuram Finance, Hindustan Zinc, Naveen Fluorine, Misho to their model portfolio. Other gold beneficiaries on a potential price surge include jewelers like Titan, Kalyan, MCX, lenders like IIFL Finance and Muthoot Finance. All right, let's get in Neeraj Seth, then founder CIO 3R Investment Management on the show. Neeraj, all eyes on Jackson Hole's, the first one for the new Fed chief, Kevin Warsh. So far, he's followed this policy of less is more in terms of communication. So realistically, what should we expect?
Not a lot. I think more of the less. So I think we will continue to see less of forward communication coming from the Fed chair. And I do think to some extent that makes sense. He might look at some big picture focus in terms of the overall policy, but I don't really expect a lot in terms of the forward guidance here. So there will be some disappointment for the markets, expecting to get more clarity on the policy path from here.
So it's going to be a bit of a non-event to your mind. And what about the overall call on yields now? Yields have been stubbornly high. And even if we've seen some measures from Scott Bessent in terms of buying back of bonds, they're pretty much addressing the symptoms and not the underlying problem, which is high inflation, oil prices, except the $40 trillion of debt on the books. Do we expect yields to remain high? And what will, over a medium, for a longer period of time? And what impact could that have on equities?
So first of all, the yields are high because of a combination of factors. Obviously, inflation is one, but you also have a high fiscal financing requirements, and you have a very high funding requirements from the hyperscalers, which now has started to compete in the long end with the treasury issuance. So the implication in my mind, I still think the yields are going to remain somewhat sticky, although I don't really see a scenario of the runaway yields, like they're really getting out of control in case of US here. The signal from the Treasury, from Scott Bessent's messaging, although they haven't done really anything, they just announced the increased buying of the long end, is just a signal to say that there is some level of discomfort with the long end going higher. But I don't think it's easy to just push it lower from here by 2 or 4 billion of buying.
Got that. Neeraj, precious metals, right, is the other area where there has been, a bit of an interest back in that sense. Are the weaker hands all out, you think, gold, silver, and the shakeout is complete?
So I do think a lot of the deleveraging from the standpoint of what leverage had built up in the system in both gold and silver has been cleaned up. Structurally, I remain positive on gold, although it has run up a lot in the last 1 month post the Japanese yen intervention and then the treasury market announcement from the US Treasury, with the whole idea of the dollar debasement trade coming back into people's mind. I don't think gold can continue on this path again, because there will be a lot of caution around the leverage that was building up beginning of the year. But structurally, I think we are back into the positive territory for gold. And as the dollar sees more weakness in the coming quarters and years, gold is the single biggest beneficiary of that.
It's been that kind of a market, Neeraj, right? Gold bulls are active, bond bulls are active, gold bulls are active, and even crypto is doing very well. But what's the call? What do you think the Fed is going to do in the upcoming meetings or even in the next 6 months, 12 months?
So I very much stay in the camp that Fed in the upcoming meeting is not going to hike. Fed is going to stay put. The potential for hike is still maybe later in the year in November or December meeting. But before that, till the task force committees come back with a report, there's basically more review. I can't see a strong reason. And the data has been mixed. It has not been one-sided strong. The labor market data is weak. The inflation data is sticky. So very simple call. I think next 3 months, Fed is on a hike, very data dependent, with a risk of potentially a shallow hiking cycle towards the end of the year.
So 1 year down the line, the 10-year yield in the US and the 30-year yield, where do you think, or the broad range?
So I still think we're stuck in a range here. If you take a longer term view and the Fed has maybe one hike or potentially two, I think the 10-year treasury still can sit in 440, 450 to a 475, 480 as a range. I don't think it's breaking out. 30-year is harder to predict, to be honest, because it will depend a lot on the issuance patterns in terms of how much the US Treasury wants to borrow in the long end. And they've been, if anything, going back into the front. So they can keep in the high fours to a low fives as a range despite potential hikes from the Fed.
Okay, all right. Neeraj, we'll leave it there. Thank you very much for joining us. Good speaking with you here on CNBC TV 18. It's a pleasure. Well, I'll just quickly run you through interactions which are lined up on the program. So 8:35, we've got the management of iFinance to talk about the recent block deal and the road ahead for the company. So Sanjay Sharma with us at that time. 9 o'clock, we are joined by Rajesh Baheti on the cash impact with respect to the BSE expiry. 9:20, Rana Gupta will be with us at Manulife to talk markets. Cholamandalam Investment and Finance at 9:35. Outlook for the year and more. Gokuldas Exports at 9:45. So that's a management you'll hear after a while from. And towards the end of the program, Lata discusses how the rush of $80 billion of FCNR deposits may impact bank earnings. Stay tuned for all of that.
Well, time to slip into a short break. On the other side, we go full tilt on the stocks that we're tracking in our special Top 10 segment. For the time being, I run you through the list. Ather Energy, Apollo Tyres, Metropolis, Tejas Networks, GE Shipping. They'll all be reacting to positive news flow. Add to the list Texmaco Rail, Federal Mogul Gods, Star Cement, and Gujarat Emesis Biosyn. On the flip side, Lenskart, another large trade is what we're bracing for. Take that break, come back. We get into further detail on all of these names.
Good morning. It's a Friday morning. You're watching Bazaar Morning Call. It's time now to talk about stocks. This is our favorite CNBC TV 18's list of top stocks for the day. Everyone's here bright and early. Good morning, Vivek, Lenskart.
Well, that's right. On Monday, you saw SoftBank selling close to 2.6% equity of stake, in the company. And today, another block deal is expected in Lenskart. This time around, Alpha Wave Ventures is looking to pair a little over 1.2% stake in the company. The floor price for this particular block deal is at a 1.7% discount to yesterday's close at 630 rupees a share, which indicates that the block size is going to be slightly northwards of 1,300 crore rupees. On further sale of shares, there is a 45-day lockup. So again, within a span of a week, 2 large block deals in Lenskart is what we're anticipating.
Thanks a lot for that, Vivek. Well, let's hop across to Sudarshan. He's got 2 stocks on his radar, Ather Energy and Apollo Tyres. Good morning, Sud.
Good morning, Nigel. So, Hero MotoCorp's Ather Energy story continues. Company has announced that it will be investing additional 1,758 crore to acquire another 2.9% stake in Ather Energy, and this will be completed by September 3. Now, once this is done, Hero MotoCorp's stake in Ather Energy will be rising to almost 33% versus current holding of almost 30%. Remember, just last month, Hero MotoCorp, via preferential allotment, had got more than 1% stake by an investment of almost 1,000 crore in Ather Energy, though so stake will increase further. Next on Apollo Tyres, we had seen that Warburg Pincus had sold more than 4% stake via block deals, but I'm going with green because entire stake has been bought by 2 major mutual funds, and those 2 are ICICI Prudential Mutual Fund and SBI Life, and that's the reason I'm going with green for both Apollo Tyres as well as Ather Energy.
Thank you very much for that. Metropolis held their investor meet yesterday. Ekta joins in to tell us the key takeaways. Ekta, good morning.
Morning. Well, Metropolis, the management has said FY27 revenue growth should be 14 to 15%, 100 to 150 basis points EBITDA margin improvement. The 3-year plan is better network utilization, tier 3 growth, specialty growth, M&A and stable volumes. So growth targets B2C, which is business to consumer, 1,000 owned stores by FY29. True Health, which is preventive testing, should move towards 25% of revenue versus 18% currently. Specialty should move towards 45% of revenue versus around 40% currently. And inorganic additions are going to be a strong part of their 3-year growth plan. Overall, they're also expecting a stronger margin improvement up till FY29. So overall, stock should be in the green today.
Okay, thank you very much for that. I'm watching Tejas Networks because the company has received an LOI, a letter of intent for an order worth 1,537 crore rupees from TCS. This for now is an LOI. TCS is expected to issue a formal detailed purchase order in due course. Now, as of Q1, the company's order book was about 1,530 crore, which basically means that this order, this LOI, effectively doubles the order book. Now, the story for Tejas Networks is that in August of 2023, they got a very large order from TCS. That was 400,000 BSNL sites. They just completed that. That happened in May of 2025. And for the last 1 year, investors have been waiting on for an additional order from BSNL that's been pending. So they executed one order. But there is an additional order for an expansion from BSNL, which the street is still awaiting. But for now, this LOI from TCS worth 40 crore is a positive for Tejas Networks. The stock has been a bit of an underperformer. Now let's go across to Devyani for more on GE Shipping and Texmaco Rail.
Well, let's begin with GE Shipping. Now, the company has announced a 900 crore buyback at a price of 1,530 rupees per share at the maximum. Now, this is an open market buyback, and this represents roughly around 4.12% of paid up capital, with promoters opting not to participate in this particular buyback. As a result, the promoter holding could rise from 30% levels to 31.37% levels, although the actual impact will depend upon the buyback execution itself. So expect the stock to be in the green and trade today. Now, next up is Texmaco Rail. Now, the stock could also be in the green after the company signed an MOU with Germany's BVV for a proposed joint venture. Now, the partnership will explore opportunities across railway wheels, wheel sets, axles, as well as other rail wheel components. Now, BVV will provide the technology, the technical know-how, manufacturing processes, as well as the engineering support under this joint venture, while Texmaco will undertake the manufacturing and supply aspect of it. BVV will also become one of Texmaco's preferred international
potential suppliers under this arrangement. So this opens up an opportunity in the rail wheel component segment for Texmaco. So this could be a positive for the company as well. Expect the stock to be in the green in trade today.
Okay, all right. Devani, thank you very much for that. Well, Winnie is here with more stocks with news. Winnie, good morning.
Hi, morning. First up, we have Federal Mogul. We'll see this one, see a bit of a green. They've announced a special dividend coming in this time as well. Total dividend is 94 rupees in that. Interim dividend of 7.5 and the remaining is special dividend of 86.5 rupees. The record date for that is 4th of September. That's next week. So we'll keep an eye out on that one. Star Cement, the company and the arm will no longer be required to pay mineral cess from August 22nd. The company's already paid around 35 crores mineral cess in FY26 and around 10 crores so far in FY27. Now, this relief is coming in after MMDRA amendment restricting that state levies on mineral rights. So, because of that, this is an exemption or a relief, I beg your pardon, coming in for them, and that is why some positive news for Star Cement. Lastly, Gujarat Thermos, that's the one we'll watch out for. The board will be meeting actually on 1st of September to consider fundraising, and this is going to be via preferential issue of equity shares and convertible warrants. So, watch out for that as well.
All right, thank you. Here is a quick recap of the top stocks. Stocks with positive news flow are Ather Energy, Apollo Tyres, Metropolis, Tejas Networks, GE Shipping, Texmaco Rail, Federal Mogul Goetz, Star Cement and Gujarat Thermos, while Lenskart is the only stock on our radar that could open in the red on the back of that impending block deal. That's equities. It's now time for commodities with Manisha. Good morning.
Morning, and thank you for that. Well, I'll start with metals right now because this has been a great week for all of those metals. Copper, remember, hit an all-time high in this week. We are trading at zinc, which is trading at June 2022 highs. If you look at the LME inventory stock of zinc, well, that has declined by 65% in this year alone, which is trading at the lowest since April 2023. And there's not just support coming in for copper or zinc. It's nickel, which is trading at a 3-month high, tin, which is trading at a 2-month highs as well on back of strong demand and inventories constantly declining. For other metals like precious metals, well, we're looking at slight gains in this week. It's all going to be about the Jackson Hole Symposium today, where the markets are now pricing in a 64% chance that Fed will keep rates unchanged in September. But there is a more than 70% chance of a rate hike in December, and that is what the street is working with. But I absolutely want to take you through on agriculture commodities because that seems to be a hot topic right now. Cocoa gained 7% overnight, sugar 3.5%, cotton 3%, rubber is trading at a 3-year high. So almost everything in agriculture as a space as well seems to be surging quite strong.
Thank you very much for that. Get into break on the other side. Siddharth Khemka, Motilal Oswal Financial Services will join in. Stay tuned. We'll also connect with the management of IIF Finance to talk about the recent block deal and the road ahead.
Welcome back. You're tuned in to Bazaar Morning Call. Well, let's invite our first management on the show. iFinance, that's the stock that we're going to be talking about. Remember, Alpha Wave, they've exited the company with a 320 crore bulk deal. We have with us Mr. Sanjay Sharma, the founder and MD of the company. Hi, Mr. Sharma. Good morning, and thanks a lot for joining in. Well, we've got three focal points that we're going to be focusing on, so we should get that for our viewers up on the screen. We're going to be looking at the regional delinquency. We're also going to be looking at the new products business, as well as what's the way ahead. Now, remember, the stock trades relatively cheap, Mr. Sharma, on FY 28 basis. It trades at around 1.2 times price to book and around 8 to 9 times on a PE basis. So the street is optimistic on the stock, but they were waiting for this large trade to get out of the way. Now, fundamentals are going to be tracked. So give us a few details. What's the guidance for FY 27, both on the AUM growth? You've been guiding for elevated growth. So what's it likely to look like? And the credit cost over the last few quarters has been dipping. By the end of FY 27, where does it settle at?
So, I think on both the points, we're tracking well. First of all, on AUM growth, we have not seen any slowdown from our markets. We were planning, or we are guiding for a 25 to 30% growth. And I think in the first quarter, we've shown a 28% growth. So we're well in the middle of that range. And I think as the year progresses, we hope to hit the higher end rather than the lower end of that guidance.
Got it.
On the credit cost, that's a very important marker. We have seen 6 quarters of falling credit costs, and we typically model our business around a credit cost of 3.5 to 4%. We are already in the first quarter sitting at 4%. So I think we can see that continued fall, which will help us reach our guided figure of 3.75% credit cost plus minus 25 basis points, because we are sitting at 4 and we'll probably exit much better. Okay. So this, we hope, will be a good year from a credit cost perspective, and growth will continue.
Okay, growth we've got the credit cost guidance out of the way as well. Could you help us out with the AUM mix target? Because if I look at it right now, hypothecation, I think, is the largest part. I think it's around 60%. Mortgage products in that vicinity of around 25 to 30%, and other products like gold is part of the 10%. So going ahead, how do you see this mix evolve? And in turn, what would that mean for your NIMs? Because as of now, hypothecation is the highest yielding product for you. I think more than 25%. Yeah, please go ahead.
It's a very insightful question. We focus on the micro scale businesses and into businesses. So I think we clearly provide hypothecation loans for short duration, 2 years sort of.
Mr. Sharma, just hold on to that thought, sir. Just hold on to that thought, because we're just going to try to fix that audio, and then we're going to get you back, for further clarity with regard to your loan mix and how do you see it impact, your NIMs as well. I think he's back with us.
Sure.
Yeah, I think we can hear Mr. Sharma. Mr. Sharma, you want to retry?
Yeah, thank you so much. iFinance focuses only on the micro scale businesses. So we look at only business lending, and therefore hypothecation forms a big part of that loan, because the loan is typically for a 2-year working capital loan. We find that in this segment, there is no other dominant player except for iFinance, and that is why there is no pressure on our pricing or NIMs. We had forecast that our NIMs will be over 14.5%. And in the first quarter, the NIM was actually at 15% plus, primarily because we had raised money recently through the IPO. And that's helping us in keeping our net interest margins steady. We don't see any major drop from that range of 14.5% that we have projected for NIMs. So I think that seems to be tracking well and stacking up well.
You were giving us the mix as well. Sorry, we missed that.
On the mix, we have about 70% is hypothecation loans, which are pure business loans. And today, about 25-26% is mortgage or micro LAP loan. We will look at opportunities. We have not started yet, but we will look at adjacent opportunities which appeal to this customer segment, which could be gold loan. So that could be one area that we will explore as we go along. But that's a 2 or 3 years sort of perspective where we'll build AUM in that product as well.
Sanjay, hi, morning. I think the first time that we're speaking, I'm not sure we've done interviews earlier, but I stands for yes, right? Or is there a you? I think the line's not clear. Do you want to just take a shot again?
Yeah. Hindi meaning is income, and the English meaning is yes.
I mean, I and I, right? I mean, the parliamentary procedure that's what I was referring to. But, okay, so let me ask you this, right? This is the hypothecation business is a LAP-like business, correct? I mean, you're essentially lending against, movable property, right? Not immovable property like in LAP, which is land, etc., but against whatever other assets, right? Movable assets.
Very true. Absolutely right. It is movable assets like machinery, working capital, etc.
Is that fundamentally is that a little more riskier as compared to LAP?
See, I think it is. I won't say that it's riskier because the asset itself is quite dear to the customer. The customer does not want their place of business to be impacted. And these are all business assets. So I think they protect it as closely as they would protect their homes. And therefore, their tendency not to default is similar to a person who has a mortgage loans.
See. And this is how much of the AUM right now? Just to repeat that.
About 70% is hypothecation. About 72% is hypothecation.
I see. Is it kind of tougher to underwrite? As you said, I mean, there's not very much competition, right? So, I mean, is there a reason why there isn't very much competition? Because there's no dearth of lenders. It's like, everyone is doing everything.
A great question. I think the problem that has to be solved is how to underwrite when you don't have any written documents which are formally used. Even the account statements do not contain too many of these transactions. iFinance has solved for this by doing a cluster-based underwriting, which looks at other business data or business observations to underwrite. So that's one big challenge. And the second is that the ticket size tends to be small. Typically, we have a ticket size of 1 lakh to 2 lakh rupees. And to make that profitable, one has to use a lot of technology, which we do, almost akin to a fintech.
Okay. Just and the remaining 30% is how is that split?
Yeah. So rest of it would be micro LAP or mortgage-based loans.
Micro LAP. What is the ticket size there?
The ticket size in LAP is closer to 5 lakhs. And since this is given to businesses, so it continues to do quite well.
Because there's been some concern at the margin, maybe at the higher end, that there's just too much excessive lending happening in LAP. Maybe at the upper end of the ticket size, but you're at the lower end, right? 5 lakh average.
Yeah, I think more importantly, we are giving to businesses for business purpose, which helps improve the quality of the lending. Because if this was for consumption and at the lower end, probably there might have been stress.
Just to belabor on that point about this business being fundamentally a little more risky. If I look at your gross NPAs, Mr. Sharma, over the last 3 years, there has been an uptick in FY24, and correct the numbers if you're wrong here. I think your gross NPAs were about 3.2%, FY25 4.2%, and last year closer to 4.7%. So there has been a deterioration in the asset quality.
Yes, I think the business does have some cycle. And we do expect, as I said, that our credit cost is likely to be in the 3.5% range, plus minus 25 basis points. Last year was a difficult year, and we did see 4.6, 4.7 was the gross NPA. Today, the gross NPA stands at 4.5%. At the end of the last financial year, it was 4.5%, and today it stands below that. So I think we will oscillate between a range of 3.5% to up to 4%. Typically on our write-offs.
Okay. So if you look at it 3 years down the line, as you said, this business is also fundamentally cyclical. Do you think the asset quality has peaked at last year's level and 3 years later, and the gross NPA range you're working with is 3.5 to 4.5?
Yes. So I think we will stay in that range. The important thing is we don't fluctuate volatile outside this range. So very rarely do we go over 4% on our total credit cost. And it's on very rare occasion, like during COVID, we had that challenge. And in the overlending cycle, we did see that problem because some of our customers were being lent to by other NBFC players. But generally, we would see 3.5 to 4% credit cost.
Okay.
Okay. All right. Sanjay, we'll leave it there. We wish you all the best of luck. Thank you very much for joining us for that conversation.
Thank you so much.
Thank you. So 181. Stocks done well, by the way. It's held by decent institutions and good names there. If you look at the shareholding list, so that's iFinance for you. I think we have Siddharth Khemka with us. Siddharth, good morning. Good to have you with us here. Any thoughts on this one? Hi.
Good morning, Prashant. So recently listed, not yet under coverage.
Not under coverage. Fair enough. So what's top of mind this morning at your end, Siddharth? Is it CAS, all the debate it's stirring, or something else?
Well, I think that debate continues. I think volatility at the fag end of the market, that kind of impacts, and especially the traders on the FNO side. But if you look at from the market perspective, I think NBFCs is something we discussed today. Fundamentally, things are looking pretty strong. Now the discussion about the Q1 results validates the cyclical recovery, and now the stage is set for a broad earnings upgrade as well as a re-rating cycle. So what we believe is that the Q1 has clearly validated our thesis that the NBFCs are entering a new cyclical recovery. Operating performances have improved meaningfully across the sector with healthy loan book growth, broad-based asset quality normalization, resilient margins, and improving operating leverage. Within our overall coverage universe, what we have seen is that if we exclude Muthoot, PFC, and REC, the overall earnings have been upgraded by about 1% for by about 4% for FY27. And we believe that with the margins having held up, operating leverage is emerging as a next earnings lever. So overall, what we like are top picks within the financial sector. Bajaj Finance, which we upgraded to buy from neutral after the results. L&T Finance, PNB Housing Finance. So these are the three stocks. Apart from that, Shriram Finance continues to be among our preferred ideas in the NBFC space.
Siddharth, what's the big idea for the day? Give us one nice stock idea for our viewers.
Yeah, Rima, I think we initiated coverage on Adani Enterprises. It's a Nifty 50 stock, but if you look at the street, only 4 to 5 brokers are currently covering it. So what we believe is that Adani is now uniquely positioned to benefit from the India's next capex cycle. Pretty strong intersection of India's capex cycle with its exposure to various business segments like airports, roads, new energy, data centers, copper, mining, plus some of the strategic manufacturing, which provides multiple long-term growth engines. If you look at in terms of the airport, the Navi Mumbai airport commissioning, expected to see strong ramp up in terms of utilization. On the roads, the assets moving from the road laying to now tolling, and then the copper ramp up. In the new businesses, data centers, the company is targeting to increase its scale up its capacity from just 55 megawatts currently to about 3 gigawatt by FY30. And also on the solar cell plus module capacity is expected to reach about 10 gigawatt by end of this year. So should provide significant earnings potential. Overall, we expect EBITDA to grow at about 29-30% CAGR over the next 2-3 years. And with Adani Enterprises' ability to incubate, scale, and eventually monetize business, combined with its leadership positions, we believe that the company has the ability to create a long-term value unlocking opportunity. So currently, we rate us Adani Enterprises buy with a target price of 3,880, giving almost 25% upside from current levels.
Okay, all right, Sid, let's do one thing, take a short break, come back. We'll continue our chat with Sid. We'll ask him about a few more stocks. Our technical experts as well will be with us.
Okay, welcome back. We got markets which will start, the pre-open will kick off in about 11 minutes or so. Brokerage calls, which should be sort of in focus, those stocks. What are those? So, morning.
Good morning. So first one is SBI Mutual Fund. Jefferies has initiated coverage with a buy call and target price here is 710 rupees per share. It says company's largest Indian AMC with more than $130 billion of mutual fund assets. So what are key differentiations? First one, exclusive association with largest PSU bank, market leadership in faster growing low tier markets. Third, well-diversified scheme mix, and fourth, institutional scale. And because of these factors, it expects 15% operating profit CAGR till FY29, and that would be led by 18% mutual fund AUM CAGR and operating leverage. Next one is Meesho. Here also CLSA has initiated coverage. Call is underperformed, target price 150 rupees per share. It says company is a leading value commerce platform by transactions and leveraging an asset-light zero commission marketplace model, but monetization, especially of low-income cohort, is a key challenge. And also on valuation front, it believes that current valuation is pricing in unrealistic outcome, and that's the key reason why it has underperformed call.
Okay, thank you very much for that. Meesho's stock has gone pretty sideways and seems to be facing some resistance around the 200 rupee mark, unable to convincingly climb well above that mark. Siddharth, any view on Meesho? Had a good listing, stock ran up initially, but after that, it sort of petered out.
So yeah, Reema, I think if you look at, we recently initiated coverage on Meesho as well. So what we believe is that Meesho, again, the entire new age digital stocks, the path to profitability is kind of improving. Meesho, with its multi-sided e-commerce marketplace connecting the consumers, sellers, logistic providers, and has a differentiated business model as it has a zero seller commission kind of model, low cost logistics, and it has gained popularity in the tier 2, tier 3 towns where there are a lot of value consumers. So a differentiated positioning that it has created, we believe this franchisee catering to Bharat through a wide seller base, the vernacular shopping experience, and as well as the advertisement through the shopping mall as well as the financial services. I think that is expected to strengthen the platform's engagement and improve the seller productivity. So what we are forecasting is about 25% CAGR in the marketplace net merchandise value over the next 3 to 4 years. And that would be driven by customer acquisition, rising platform adoption, and the advertising monetization, which should lead to some profitability. So we expect the adjusted EBITDA to go about 4,500, 5,000 crores by FY31. So we remain positive on Meesho. We have a target price of 240.
Okay, all right. Sid, I want to ask you about this one. India plans, they're planning around a 13,000 crore incentive for battery component manufacturing. I think a couple of stocks that come to mind could be the likes of Exide, Amara Raja as well. What's your view on them?
Yeah, Nigel, I think that's a step by the government aimed at securing better cell manufacturing, battery manufacturing scheme to boost the domestic manufacturing of components that should go into the battery cells, complementing the existing incentives for cell manufacturing. I think the key objective is to build a strong local supply chain as well as strengthen India's energy security. So overall, I think proposal is expected before the finance ministry and is expected to go anytime soon. I think this will be positive for domestic battery component manufacturers and accelerate the localization, capacity expansion, and reduce dependence on the Chinese imports. So I think two large companies, A, Amara Raja, and B, Exide, both of which should see these benefits. And then there are several smaller battery manufacturers, HBL Energy. I think that should also come into play. But clearly, I think between Amara Raja and Exide, both of them are also getting into the lithium-ion battery manufacturing, and Exide showing a lot of strength in terms of the plant coming on stream and showing strong growth in FY27. So positive for Amara Raja and Exide. Preferred pick would be Exide Industries.
Okay, we will slip into a break. Siddharth, stay on. When we return, we'll get the pre-opening rates. We'll also connect with Rajesh Baheti on the first monthly expiry following the implementation of CAS.
Welcome back. We're getting ready for market opening. So let's welcome our technical experts. We have Mitesh Thakur who joins in, and joining him today is Sudeep Shah. Hi, good morning, gentlemen. Good to see you all in. Well, Mitesh, you go first. The cash session went to the bears, and we start off on a bit of a back foot today. Your take? How do we progress from here on? Are we reaching the lower end of the range where you'll be interested in buying? What's your take?
Yeah, good morning, Nigel. I think, very clearly this market has been slowly sliding on the lower side, and yesterday the closing was also slightly negative. But as we have said, 24,000 is the key level to watch as the support area in the short term. One, there is a swing low which we made on the 19th of August, recording an intraday low of 24,025, and then there's also a gap area over there. Below that, I think if you break that, then I think 23,850, 23,800 is the next target area. But I think we will see how it reacts as we get closer to 24,000. There is some chance of a pullback which could happen from those levels.
All right, Sudeep, what would the Nifty call be?
Morning, Rima. Rima, what we feel is that with yesterday's fall, Nifty has even breached its 20-day exponential moving average as well as the 50-day moving average. So, in the short term, we feel that markets would consolidate. A bigger move could only be witnessed once Nifty is sustaining above this 24,250, 24,300 mark. Having said this, what would be the downside areas to accumulate? The downside areas to accumulate would be closer to 23,850, 23,900. We feel that is the zone from where the markets could once again take support and rebound. So 23,850, 23,900 is the zone from where one could start accumulating. And for the bank Nifty, also we have a similar view here. Also, we feel that 56,800, 56,900 was the prior breakout area. That could get retested, and then we could see a stable rebound. So 56,900, 57,000 would be the support zone for Bank Nifty, and 23,850, 23,900 for Nifty.
Okay, and stocks, Sudeep?
A couple of stocks. The first stock that we like is from the power space, that is CG Power. Here we have seen a consolidation breakout. Last 4 weeks, the stock has been consolidating, and yesterday we have seen a breakout with volumes. So we feel that the stock could be bought with a stop loss of 872, and the targets on the upside would be 930 and 950. The second stock is City Union Bank. So here also there has been a breakout a couple of days back, and the stock is right now slated to move towards the 240, 245 levels on the upside. And we feel that this could be bought with a stop loss at 223 on the downside.
And Mitesh?
I have more of sell calls today. Some of the stocks, are slipping below their averages, indicators turning negative. So 3 sells to a buy. On the buying side is Adani Power. Keep a stop below 210, look for targets of 225. Average is a sell with a stop at 1263. Here I would look for a target of around 1200. A sell on TCS with a stop at 2281.82. A target of 2175 on the downside is possible. And M&M also had a negative closing, so sell with a stop at 3375 for targets of 3260.
Okay, all right. Well, thanks very much, both of you, Mitesh and Sudeep, and we'll chat more a little later. Now, to the cash session yesterday and the expiry of BSE futures and options contracts and what happened. SEBI Chairman Tuhin Kanta Pandey defended the new closing auction mechanism. Once again, he also said that the regulator is very close to approving the IPO papers filed by the NSE. Of course, 2 different things, but listen in.
Are we very close to the approval for the IPO, for NSE's IPO?
Yes, we are close. नहीं, अभी हम कोई changes नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी एप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
Okay, well, that is the SEBI chairman there. Let's welcome in Rajesh Baheti, Managing Director at Crosseys Capital Services, who's joining in. Rajesh, good morning. Good to have you with us here. Surprised you're not on the tennis court, but
I was.
You were, okay. So what's crazy stuff, right? Yesterday, and I think you've been absolutely vocal about it from day one. This is even before the first expiry. I remember that Monday, essentially saying that that this is letting the F&O market function while this is going on is not a good idea. It's actually a pretty poor idea. Go on.
Yeah, so I think while I've been very vocal, I think SEBI has been equally vocal in saying that this is going to stay, this is the way it's going to stay, and that this CAS is going to decide how F&O expires. So there's very little for me to say. SEBI is saying all is well. So, I mean, really, why are we having this show? Because all is well.
Sorry, what was that? Right at the end? What did you say?
I mean, SEBI kind of said all is well yesterday. That's what the papers reported. If all is well, then we should be having this show about CAS.
No, the thing is, right, while the chairman did say that the point is CAS per se is fine, right? But basically it's using that to determine where F&O contracts expire, right? That's the problem.
Absolutely. I mean, if the idea of CAS was to help the index funds and the passive funds discover a price without incurring the tracking error, that is one thing. Now, those passives and the index funds do not trade in the F&O segment. So to expose the F&O segment to the anomalies of the CAS discovered price, and then say that, this CAS does not exist for the F&O market, and that was said some time ago by SEBI. And you had interviewed Anand Kumar, and he had kind of said, well, then if CAS is proving to be a problem in F&O discovery, then maybe people should not trade zero DTE options so much. So I'm now veering to the idea is it's more than just discovering prices for the index funds and the passives. It's probably to kill the zero DTE market, and this might be one of the ways to do it.
So you're now getting more and more, in a way, you're leading towards the idea that this is a move to do that, basically.
Well, it may be an unintended consequence, but I certainly see nobody's unhappy about it.
Talk to us a little bit about some of the craziest things you saw yesterday in the session.
Yeah, kind of TV channels discussed yesterday. There's just a close, and then the close was another 250 odd points below the 290 that the Sensex had declined. That didn't seem so alarming. But if you saw what happened during the CAS session, that the Bankex and the Sensex went down by 2,000 points and 3,000 points respectively, and that the Bankex actually closed 1,100 points below. To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes, and the rest of the day can just do whatever it has to do, and it has no relevance. Then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this, and all is well. Yeah.
This was the first monthly BSE expiry, right? After the introduction of CAS.
Yeah.
So, I mean, defensible or not, but that many would say that, well, it's the first, so give it some time. And the other point is that if you look at cash volumes on the BSE, right, I mean, they are lower as compared to the NSE. So, yeah, I mean, it exasperates the situation in that sense. But how do you respond to the point of this being the first one?
The BSE is clearly worse off, and I'll tell you why. While it has 30-35% of the F&O market share, it has only 5% of the cash market share. I don't think the passives are going to go to the BSE and put in their orders for index rebalancing or buying or selling their stocks. They will trade on the NSE. And the BSE indices do not get determined by NSE closing prices. They get determined by their own closing prices. So with a 5% volume, with absence of institutional players in the cash segment on the BSE, I think the BSE indices closing is going to be prone to such high volatility moves, and it's going to be really bad for BSE options trading, because eventually people will stop trading the BSE options if they find that the price setting is all over the place.
Well, what about kind of having a common price discovery? That has also been discussed, debated. Some have said, well, that must be done, because otherwise there's too much price. I mean, do both routes, the price discoveries separately.
Okay, that could be a possible solution. The second thing could be a lot of the price anomalies that we see is due to the fact that people enter orders and they withdraw it all of a sudden, or they then start modifying the orders. So I think maybe there should be some penalty for withdrawal of orders or modification of orders, because clearly you're putting in orders at 3% up or down initially, and just a minute before the closing period when you can withdraw or modify the same, you end up modifying those orders. And that is creating the journey, is creating a bigger mayhem than just the closing levels that we are seeing.
No, you're right. I think there is by the way, we'll also have in the course of time, I think the first one will be the big rebalance that MSCI is going to do, and I think our colleague Vivek was pointing to it. That'll be a big test again, isn't it?
I always maintained if that's what's needed to be done for index and passives, go ahead and do it, but at least allow cash to have 10% or 15% of the market's volumes, and then link it to the F&O. I mean, what is the hurry of pushing F&O segment into the abyss? It's a classic case. I feel that there's some stepmother treatment being meted out to the F&O segment.
Just one thing, isn't there? I mean, you can this what you call, right, putting order and then withdrawing it. What is referred to as spoofing. There are rules around it, isn't it, Rajesh? Because I remember speaking with Anand and he said you can't withdraw after a certain point.
After a certain point, but you've got 8 minutes, right? And you saw what happened yesterday. So I want to ask this question, that why is it that the indices went down 2,000 points? And why is it that they moved up 1,800 or 1,700 points thereafter? I mean, somebody's got to come up with an explanation. You can't just say everything is okay, people will come and prices will get discovered in a better way in the future. Well, there are people out there trading real money in the option segment who are being taken to the cleaners while they do this.
Got that. And if you were to, I mean, this delinking, right? How would you do it in terms of the timings in a practical sense, if that were to be considered?
I mean, expire the F&O at 315, and maybe the trade thereafter could be part of the T+1 day. I mean, there are many ways to do it. There are many ways to skin a cat, but the best way is that you want to expire the contract at 315, and then let cash have a determined price. I gave you the example that the currency segment didn't expire at 330, it expired at 1215 with the RBI rates at that time. So it doesn't have to be the end of day prices or the prices discovered at the end of the day. It can be any price you set a time, and that is the discovered price in the F&O segment for settlement. And it doesn't affect any passive funds. Yeah. I don't think any passive funds have anything to do with the F&O segment.
Or you can do the F&O close at 3:30 and then 15 minutes of cash, 3:30 onwards.
You could have cash till 4, I mean, honestly. Yeah.
Okay, all right, Rajesh. Another day, another expiry, and some wild moves once again. I'm sure. The stakeholders, regulators are watching, and we'll see if we'll follow up on the story. So it's a immensely discussed, debated subject, and I think you've helped shape some of that debate. Thank you very much, Rajesh. Appreciate your time here.
Thank you.
Okay, well, that's the cash session yesterday and what came out of it. Well, Mitesh is with us. By the way, the pre-open I think is ended, and what do we have? Nifty is up 31 points. Let's just look at the Sensex as well, and maybe the BSE BankX, if we will. Maybe there is a bit of turn there. So Sensex is up 200 points. So I think some amount of reversal after yesterday's cash-led sell-off. And I think same is true for the BSE BankX as well, which is up about 1%. Let's look at the Nifty Bank. I don't think you will see that same kind of move coming through on the Bank Nifty. Look at that. Nifty Bank is flattish, slightly sideways, but the BSE BankX is up 1%. So it's basically correcting for the sell-off that we saw in the last 15 minutes during the cash period. Actually, the 8-minute period is essentially what is relevant. Let's get the trades out. Mitesh is with us. Mitesh, what do you have?
I go with the buy in Adani Power for targets of 225.
Okay, thank you very much for that. Let's talk about HDFC Bank because the wait for the CEO continues and the clock is ticking. A recent Macquarie note says the uncertainty over the HDFC Bank CEO Shashi Jagdishan's tenure is weighing on the stock. Ritu joins in to tell us what we should expect. Ritu, less than 2 months to go.
Well, yes, Reema, 26th October is when the current CEO Sashidhar Jagdishan's term ends. And of course, there's been worry about, the delay in his reappointment. Typically, you have banks send these names a good 4 to 6 months in advance, but just 2 months to go and there's still no clarity. Now, there's this Macquarie note that talks about this overhang on the stock. It says there are 2 key options now going forward for the CEO tenure. And both, the Macquarie note says are equally probable. The first option is that there is a limited up to 6-month extension that Sashidhar gets. And the second option is he gets a full 3-year term. But in either of the cases, there will be some uncertainty. If there's a temporary extension, it could mean that, more time would be needed to recommend a new CEO, probably an external candidate as well. And, the new CEO, if he does come in, will also take some time to settle in if his tenure is not fully extended. So they do see a further downside in, HDFC Bank stock in case of a temporary extension. In case of a 3-year extension, that would end to some extent this uncertainty surrounding his tenure. They see the current levels, though, of the stock, which is around 715, 720, providing some bottom support if the 3-year term is granted. If not, then, they see some uncertainty lingering. They maintained an outperform on the stock with a 12-month target of 1,150 rupees. But they do point out to 2 key risks. One is, of course, if he does not get the full term. And second is there is a further, margin contraction that HDFC Bank reports.
Okay, all right. Well, thanks very much, Ritu, for that. So that is HDFC Bank in focus. I mean, stocks, of course, at a low, and but a fair bit of interest. Much of the interest is essentially asking the question, why is it at a low? And of course, the others are waiting for triggers and what could turn this around. But we'll see. The top stocks to focus on as markets will start trading. Aether will come up in the pre-open, where all these are, of course, what we've put up since the morning. Apollo Tyres is there. There is Metropolis, which is about 1% higher. They're all small changes. Tejas, though, is up 5%. So as Rima pointed out, there is it's been a big underperformer. This order is helping at the margin. So the Nifty is at 24,120. The Nifty Bank is at 57,385, 375 now. And you've got the mid-cap index, which is flat, 5-point change. And the small-cap index will come up on your screen. And I think even there is a 0.2% kind of a pop. So broader markets are doing better, most definitely. The Nifty, though, is now up 50 points. So we are bouncing. I mean, actually, we got to almost, the first support is about 50 points away from where we left off yesterday, which is we left off at 24,090. 24,040 or so is the first support. So we are bouncing once again, but let's see, how we trade through the course of the day and the close today. Can I request for the Nifty, the BSE, the Bank Nifty and the BSE BankX together? If you're able to put both in the same place, you'll be able to see the difference. Can we do that? Okay, then we'll just do it. Why don't I just look at the Nifty heat map as well, and then maybe we can come back with that. How the 50 stocks opening this morning. So yeah, that's the one, right? Look at that. The Nifty Bank is down 100. The BSE BankX is up 600 points. And that is because the BSE BankX sold off 700 points in the last 10 minutes or so. So the final close on the BankX was 700 points lower than the 315 price. So it's basically just correcting for the excessive move on the downside yesterday, whereas the Nifty Bank didn't have it. So that's trading more off its own steam. Okay, the heat map, if you can look at the 50 stocks and how they are, or how they're starting up, the rates should be up. And you got Tech Mahindra, TCS, Infosys, Wipro. It's an IT day. HCLTech, which are all up and about. And on the other side, you got Bajaj Finance, UltraTech, SBI Life, and ICICI Bank, which are lower at this point in time. So 40-odd points to show for it to begin this Friday morning. Rima.
Well, it's IT all the way. In terms of the sectoral index gainers, Nifty IT index is open with a gain of 1.7%. Large cap names like TCS, Tech Mahindra, Infi, HCLTech up 1.5 to 2.5%. But even outside of that, big gains seen for names like a Coforge and LTM. A Mastech is surging 4%. The one which is seeing profit booking today is Happiest Minds, but that rallied to that was under pressure yesterday as well on news about ITC Infotech potentially buying the promoter's stake, and the stock continues to remain a tad bit subdued. Tejas Finance is clearly the big stock winner of the day. 8.5% up move on Tejas Finance. For the last 3 years, Tejas Networks has given negative shareholder returns. But this order, LOI, letter of intent from TCS, is boosting the interest in Tejas Networks. So that's doing well. Ather Energy, where Hero Motor Corp is committing more capital. With this, Hero Motor's stake in the company goes up from the current 30% to 33%. Stock is doing nicely. iFinance, we were chatting with the management earlier and they spoke about how for this year, their AUM guidance is 25 to 30%, but they're hopeful of closing at the upper end of their guided band. Metropolis also spoke strongly in their investor day yesterday, and that is pushing the stock up by nearly 2.5%. Keep your eye on names like Misho, Apollo Tyres, where there is some block deal, and Lenskart should also come up for you on your screen on the back of a potential 1.2% block today.
Well, that's right, Rima. We'll keep an eye out on all of those stocks. A few more notable movers in today's trading session. Bodal Chemicals, that one in fact is strong. H asset prices actually have moved up, so that's one of the counters that's actually been quite strong. I think you have even Kiri Industries, that as well has some play. That one as well is up close to around 17%. So both these two have moved up because H asset prices have actually been surging. I understand that there is a bit of a supply disruption in China, which has caused these stocks to, in fact, move up. Actually, they've been rallying for the last few days. We'll keep an eye out on them. Tejas Networks, as Rima pointed out, that stock as well is up. Ather continues its good run. Vedanta, after selling off yesterday, well, that's popped up a little bit today. And SAIL, yesterday there was that fear with regard to the supply overhang. I noticed in the last hour of trade, the stock had cut its losses from around 5% down. It had cut its losses to around 2-3%. And this morning, it's almost at par with what we saw yesterday at the start of the trading session as well. So that one comes up for you on the screen. In terms of stocks that are down on large volumes, Physics was down 2.5%, and you have Leventree as well. That's a little bit lower in today's trading session. Federal Mogul Gods, you have that special dividend of around $75. Street has latched onto that, so that one as well up 4%.
Just Dial, that's shot up 10% at open and pretty decent in terms of volume gains. So Just Dial is a stock to watch, 9% up, 700 rupees on Just Dial.
Yeah,
okay.
I think we have a Kotak institutional note, right? They have a buy rating over there with a target price of 1,175, I think so. Okay. So explains why, I think they've got a new CEO, Mr. Dinkar, who's focusing on merchant acquisition as well as ROI. And I think that note could have got the street excited because 5 lakh shares in first 5 minutes. That's telling you that that note is making an impact.
Indeed.
Okay, all right. Well, let's get in Rana Gupta, who's with our Senior Portfolio Manager, Manulife Investment Management. Thanks very much for joining us, Rana. Great to have you, as always, here on CNBC TV 18. We've had some good conversations over the last few days with top CIOs and fund managers. And generally, the mood's quite positive. Everyone's focused, of course, on different segments in that sense. The one thing is absolutely clear is that large caps are kind of struggling in this market, right? I mean, there are those who've kind of taken the view over the last 1 year that maybe now is the time that large caps, the risk reward is much more favorable on the larger end of the market cap curve than it is in small and mid caps, etc., but not really worked out. I just wanted you to address that, Rana, before we dive into themes and what you are doing.
No, I would tend to first of all, good morning, and I would tend to agree with that. In Indian large cap space, if you just look at the earning growth of the large cap, even in the last quarter that ended, I think the Nifty earning growth somewhere between 12-13%. But as you go down, if you look at the Nifty Junior, you look at the NSE 200 and mid cap 150, and then the small cap 250, the earning growth goes up to 20, 30, even 40%. So it is very clear that the Nifty Junior and the mid cap companies are growing earning at a much faster pace. And this is also not by accident. If you look at the structure of Nifty, which is dominated by IT, FMCG, one or two big companies in energy, then some in private banks which are facing a lot of challenges, and then there are some mature auto companies. All these companies, they can possibly at best give you earnings CAGR not higher than 10-11%, and it will be very difficult for these stocks to re-rate given their trading. So I think outside that there are very exciting opportunities, but I would tend to agree with the thesis that you said. I will just make a small distinction. I think even in the large cap, some Nifty 50 companies are of course interesting, but I think outside 50, the chart of interestingness, earning growth starts growing. It's not necessarily all large caps are not growing. Those sectors that I mentioned are particularly seeing some challenges.
Rana, you've liked financials in the past. In that, what's the view on HDFC Bank? And are you worried with the delay the bank is taking in announcing Shashi's reappointment, or whatever the next step is going to be in terms of the CEO appointments?
See, we liked financials, and on specific question to HDFC Bank, I would say that for any bank where if the management who's in charge, that is not known, that is a very difficult thing for the investors. And it's 2 months left, and we do not know the direction. So I think it's a challenge for the investors. There is no two ways about it. But within financials, I want to make a few points on the financial space. Traditionally, I think FI investors, including us, we have liked the private bank space. Private banks can even do well going into a possible rate hike sometime in November and January, because banks are usually sensitive to rate hikes. But the structural trend, if you see, barring probably one private sector bank, the private sector banks are growing in corporate, high-end, high-graded corporates, prime mortgage, auto, where there is no pricing power, and their margins are under pressure. It can alleviate the pressure a bit because of interest rate hike, but I think the structural pressure not going away. Unless the private sector banks are taking a bit more risk and doing a lot more of gold loans, SME loans, some affordable housing loans, I think the yields will be under pressure. So this is where I think some of the mid-sized banks and some of the non-banking financial sector companies, the larger ones, they stand out, because when we meet them, I think they speak very confidently about growing their SME book, growing their gold loan book, growing their affordable housing book, where the yields are good, the market is large, and the banks are not that present. So at the moment, competitive threat is also less. So that is one space that we structurally like now.
Any clear avoids from here on, Rana? Sectors that you would be cautious in deploying incremental capital? And if yes, tell us which ones and why.
So, we can go sector by sector. Let's say, for example, I mentioned IT. Does that mean that all ITs are avoid? Possibly no, but the large caps are avoid. Even within IT, there are certain mid-cap stocks which are doing very well. And I do think there is opportunity there. So I think the older model of IT, whereby, you go to a client with RFQ and then get your team to deliver, all that is, that business model has changed. We like companies who go to client, propose a solution, propose cost savings, and all do more proactive way. And these are the mid-cap companies, because they do not have a back book to defend. So there are some bottom opportunities. If you look at staples, I think, again, the earning growth is under severe challenge. But within staples, as the index providers classify it, they classify alcoholic beverages as staples. Now, alcoholic beverages is one segment which also sees very low competition and very high growth. So again, structurally, we like that is a bottom-up pick also. Even in financials, like I mentioned, The private sector banks, we have turned a bit more cautious because of lack of growth and margin delivery, although we acknowledge that they can do well in the short term. But I think something like NBFCs are, although NBFCs are large, but I think that is something looking quite good. So some of these sectors have still bottom-up opportunities, just not the conventional ones.
Okay, so Alcobev is one of the ideas that you like. You also like in the entire electronics manufacturing space. What's the runway in terms of an earnings growth? Because valuation for many of these companies are also on the higher side.
Yes, it is. So we have always liked electronics manufacturing space, and we still like it. If you look at this electronics manufacturing space, I think over a period of time, this sector has expanded. Now you have like camera manufacturer, now you have server manufacturing, and so on and so forth. So that is one space we continue to like, and our idea remains simple. The companies which grow with good operating cash flow can reinvest back to disciplined margins acquisitions. Those are the ones we like. See, in a high growth industry, if the cash flow is a problem and the company goes on acquisition spree, there's always risk that something can come back to bite, as we have seen happen in this segment. But again, if you allow me, I just make one more point on electronics manufacturing. I think this manufacturing opportunity, electronics was always there, and we liked it. We still like it selectively. But I think the manufacturing opportunity is now moving to aerospace, defense, and semiconductor. That is the next big area. I believe that this aerospace, defense, and semiconductor, ADS as we call it, is perhaps where electronics was 3-4 years ago. So that is one area that we like in the manufacturing side.
Okay, all right. Hi, Rana. Good to see you in. Rana, what about metals? One good day, one bad day, but actually in the last 1 month or so, it's come back to the party. And normally it's, swings wildly, but for the time being, that still appears fair bit of interest. Your view on commodities? Either you want to look at metals, you want to look at chemicals as well. Every now and then, there is some kind of a short supply coming out of China. Case in point being H asset prices that have ballooned up, shot up big time in the last 1 month. Or sometimes, when China produces less steel, then we have at least steel prices that get some support. So your view?
Sure. So in terms of commodities where China has a lot of capacity, and of course there are, as you're pointing out, there are from time to time shortages and those stocks do well. That is very difficult for a long-term investor like us to really really to kind of bet on. So chemicals, steel, all this China is quite long, and I think the pressure remains. In case of India, of course, because of safeguard duty, there are some opportunities. But I think in export market, it's going to be very tough for everyone, not just Indian companies. Where we like commodities is where China is either not as big, and even if they're big, they're busy supplying their own markets and not too much of a participant in the world. So if you think about that, I think in that segment, or the demand for that metal is growing in a very big way. So we like the base metals. Base metal space, that is where we like. And outside that base metal, we also like the precious metals like gold and the gold linked companies. I think within commodity, those two areas that we like.
Sorry, you mentioned NBFCs, right, Rana? Do you have a view on the gold lending segment? Has been the fastest growing.
Yes.
The bullish argument is, and I think it was presented by the Jefferies, I think it was Jefferies which initiated coverage, essentially saying, but basically they're saying that only about, the penetration is 11%. If you look at household gold, I mean, their calculations show that there's only about 11%, which is in the play, against which I think borrowing has been done. So it's a big market, etc. Just your thoughts, how you think about this?
Yes, gold loan is a big market, and I think now every company who are aggressive with growth, they are putting their capital behind it. See, I think our interaction with the lender, one of the particular lender has told us something really, put it in a nice way. He said that this is one sector where something remains with me. If I give a personal loan, they take the money and will do what they buy. If I give an auto, the asset is with the consumer. Home is with the consumer. Here, the asset is with me. So So from a asset quality point of view, I think people are very comfortable. LTVs are 60% gold price rising. That makes it even more comfortable. I think what can happen is that gold loan can see significant amount of growth, and even for the consumer, if some NBFCs they start lending gold at or somewhat below the personal loan prices, because then they have a secured, it's secured. I think it's good for the consumers also. So I think gold loan will grow. It's underpenetrated, and gold loan can take share from something like a personal loan as well, is our view.
Rana, great conversation. Thank you very much for joining in.
Thank you very much.
Let's talk about Tejas Networks. That's flying today, 10.5% up move. This is after the company received an LOI, a letter of intent, which is basically what precedes a formal order. The LOI is worth 1,537 crore. It comes from TCS for an BSNL order. The company has said that a formal purchase order from TCS will also follow very soon. It's a sizable order. In Q1, as of Q1, the order book of the company was of a similar size. So basically, this order of 1,537 crore effectively doubles the order book of the company. Secondly, bear in mind that Tejas Networks has also been an underperformer. In the last 3 years, the company has given you a negative return of 33%. And that's because about 3 years back, the company got a very large order from BSNL. They executed it. The street was waiting for part 2 of that order, which as of now hasn't come through. So the wait for that continues. But in the meanwhile, the company seems to have got some additional orders from BSNL, and that's got the street excited. 2 reasons: a large order, LOI, which is a precursor to an actual order, and secondly, the fact that the stock has been an underperformer.
All right, Rima, thanks a lot for that. Well, Cholamandalam Investment, that's the next management on our show, where we have the company has maintained their FY27 AUM growth guidance of around 20 to around 23%. And gold loan business remains a key trigger. To discuss this and more, we're now joined by Mr. Arul Selvan, the Chief Financial Officer at Cholamandalam Investment, who joins us on the show. Hi, sir. Good morning. Good to have you, as always, on the show. Tell us, what are the trends you're observing on ground? And, what are your expectations in terms of a better growth number in the second half of the fiscal? Please go ahead.
Yeah, I think we still maintain our stance that we will continue to grow in the 20 to 23% AUM growth, and that's we are not changing. Things on the ground are good. Auto is picking up, and a large part of the El Nino threat has also got sort of subdued. Though there are some pockets still of deficiency, but I think in a country like India, there will always be some small pockets where we will have, deficiencies or surpluses in the monsoon. But everything seems to be on the right path for the second half.
Okay, all right, Mr. Selvan, one interesting, point that we always look at is with regard to the gold finance. That's a smaller part of your business, but you've been talking about scaling that up. Give us a few details about the break-even point. How long will some of these new branches that you open, how long will they take? At what scale do they break even as well? And the ultimate guidance in terms of, scaling the gold finance book.
See, as we closed March 26, we had around 119 branches, and the AUM was around 1,800 crores. We plan to introduce another 300 to 350 branches in this fiscal, of which we have already launched more than 120 branches as we speak today. So we are progressively, expanding, because for gold loans, we set up exclusive branches, and it is not part of our existing branches, unlike other businesses within our portfolio. As we move on, we will still, the new branches will have more OPEX, so this trend will continue. Gold loan as an overall business, it will take us 2 to 3 years to, at an overall level to have a break even. But if you look at it, the existing branches which we have installed last year, they are already on break even. The new branches will be a little bit of a higher OPEX and cost in the current year. So these will a little bit offset those break-even points of the old branches. So gold will continue to be in a negative territory at a PBT level for us for one or two more years before the the existing or the old branches become larger and their contribution becomes more solid. Overall, it is a 4 to 5% rate of product pre-tax.
Okay, all right. And you said that the AUM per branch you're targeting is what? Around 12 to 14 crores?
I don't want to commit any number right now, but certainly yes, we will be in line with the industry. We won't be too far away, but certainly we will make endeavors to make it larger.
Got that. By the way, just a side question. I'm not sure it's meaningful, but has the people cost gone through the roof in the business, Mr. Selvan? On gold specifically, because I mean there's just an absolute scramble to get people, because everybody is opening up and fast expanding, right? Almost a race.
No. On gold, yes, we are taking from existing industry players, but we are also in the process of, creating the training and development aspect of for people, so that we sort of home grow people for the future. The first set of branches, of course, had been, the people out there are from the industry, and we will continue to do so for the current year also. But I think by next year, the new branches which will come hereafter will start having progressively homegrown people.
I don't know if you heard that conversation with Rana Gupta of Manulife earlier. He was saying, I think you did briefly towards the end. What do you make of it, sir, as someone who's been in the business a long time? I mean, is the runway long, risks very low? It's a business where traditionally realized losses have been very negligible, right? Because you have the product at the end of the day. What's your sense?
Yeah, I heard of it, and I think I strongly believe that, and I've been also talking on similar lines, because here the product is with you. There is no, worry about the product even being cannibalized or it is getting depreciated. Mostly it is an appreciating asset, so there again we have a positive. The only risk is fraudulent or spurious gold coming through the customer, or collusion of employees and fraud at the branch level in misappropriating the gold which are being stored in the individual branches. But now technology is available to a large extent where you could monitor them from a command center at a central point, which is what we are doing. And there are multiple options available to track, like RFID packets or RFID tags, which will be able to track the gold loan at every stage, right from its receipt from the customer to its delivery back to them. So these technology and developments help to make this gold business much more secure. So I think it's a good business we should focus on. Yeah, a lot of competition is coming in. That could be some sort of a pricing pressure, but still there is enough PBT, and certainly it will be at least for Chola, it will be an ROA accretive business in the days to come.
The other one, Mrs. Selvan, is this RBI circular on revolving credit. Do you have those kind of products, sir?
We do have a very small part of it. I think it's at around 0.6, 0.7% of our overall book. We started recently because most of the other players in the industry had been doing this. But I think we will take a view on it as we get the final guidelines on this from RBI.
That is the 0.6% of the book is basically these flexi personal loan kind of things, right?
Exactly.
Okay.
It's around 1,600 crores.
7,600?
No, 1,600.
Sorry, yeah, okay, 1,600 crores. So just one more thing. There's personal loans, right? But there is also talk and anxiety that maybe other kinds of, supply chain finance and, those kind of things also may fall under the ambit of the circular. So have you taken a look at this?
Even in supply chain, we had been slowing down on for different reasons. We had slowed down supply chain. We have articulated that in the earlier calls, etc. Because that is not an ROI accretive product, so we had been slowing down on that product. So I don't think even there, if that gets added into this, though I really doubt that is the intent of the regulator to add supply chain into this. But if they do so, then also it may not be a large variance for us from a AUM perspective.
Gold doesn't work like this, right? As a product, I mean, on tap kind of thing, right? Or in some cases it does. I mean, typically it's designed like a fixed tenure, right?
We don't have a product like that. We don't have a product which is like a revolving. In gold, you have to repay, and now the regulator allows the interest to be serviced and then obtain a fresh with the latest LTV being factored.
Got that. We wish you all the best of luck. Good conversation, sir. Thank you very much for joining us here and talking to us about a bunch of things, really. 1870 on Chola. We'll take a quick commercial break here. We are back with the management of Gokuldas Exports, and we decode the export opportunity post the India-UK FTA, US tariffs, and of course, I mean, you know, the situation on the apparel export side overall. So we have the Gokuldas management ready with us. Welcome back. So from finance to, textiles and apparels, we have Siva Ramakrishnan Ganpati, Vice Chairman and Managing Director at Gokuldas Exports now joining in. Siva, good morning. Great to have you with us here. Thanks very much for joining us. Lots happened, and most of the things in the right direction, Siva, right? India, UK is done. And the US tariffs, which there was a fair bit of uncertainty after, which direction they would go, whether they'd be a step higher or a step lower, that's also in a way largely worked out. So give us a sense of, the lay of the land right now. Has all of this reduced uncertainty? What about customer inquiries? This is also, in that sense, the busy period. What is it looking like?
Okay. So, among the big markets, both Europe and US, there is US tariff, leveling off, which means we have a level playing field in terms of having the Section 301 tariff of 10%, which is across the board in most countries. And our operations in Kenya, where it is 0%, actually bestows a favorable advantage to us. So on the tariff front, as far as US is concerned, it looks good for us for the moment, especially coming out of that 50% penal tariff that we encountered in the quarters of in the last year's second, third, and fourth quarters. So the good scenario on that front. UK tariff, being rated to 0 is helping us gain ground in that market. We are in advanced discussions with a new customer based out of UK, in addition to growing our existing customers. So that side is also going good. eagerly waiting for the European FTA, which would open up access to a very large market. And if that happens sometime the next calendar year, that would be great. Then, most of the economic constraints for India would be lifted, and we would have a very favorable access to major markets. So on the macroeconomic front, things are looking good. And again, subject to any new uncertainty which comes our way these days, that seems to be a standard, and we have to just prepare ourselves for anything. But for the moment, the course seems to be clear. As far as demand is concerned, retail demand so far has been good in the US as well as Europe. However, I'm seeing the growth month on month has been slowing down a bit. We got to keep a close watch on how 2027 pans out. We have our order books full until Q3. So we are now looking at summer 27, which is quite some time away if you look at it, which is almost next year. And we got to see how the retail market will behave sometime then with the inflation in the US, etc. But then, given the supplier consolidation and all those things that are going on, we seem to be having a fairly strong order book to sustain our business and our growth trajectory.
So you're saying order book is full till this is December?
Third quarter.
Which is December calendar 26.
Financial. No, yes, that's correct. That's correct.
Okay. And that new customer in UK is large enough for you to make a mention, I'm assuming, Siva?
Yeah, it is large enough. It's a good customer. So
you're talking to them with this UK FTA?
That is correct.
And that
in addition to the existing set of customers with whom we are growing anyway.
And you'd said that you'd given us the big number for the industry, which is that exports to the UK is about $1 billion, right? And
as an opportunity.
That's industry level that you said could go to, that could double, right? Is what you'd said with this.
No, I said that the opportunities, the incremental opportunity post the tariff is about $1 billion. Post tariff being rated down to zero is $1 billion worth for India. And that will pan out over the next 3-4 years, depending on how fast the ramp ups will happen.
Morning, sir. This is Rima here. Walmart is a key client of yours, isn't that? When Walmart reported their numbers, the street was very disappointed. The stock cracked. And I remember they reported the slowest quarterly growth in nearly 6 years. And the Q3 guidance was also cautious. That disappointed the street. Now, you just said, while the order book is full for now, month on month, you are seeing US retail demand slowing down. To what extent? And how do you think FY27, based on the early indications you have, would compare with FY26?
So if I look at the first half of calendar 27 versus 26, retail demand has been higher. When I say month on month, it is a slowing down. The growth is slowing down, that's all. But it's still a growth over last year. So these kind of monthly volatility could be there, but as far as it is a growth, it's a good sign. So the June or July number over the previous period of the same year was about 2.4%. So it's still a growth, right? And for that large market, it's still good. Now we got to see how the holiday season goes. Most of our production for those seasons are getting over as we speak, and we'll be starting summer. So our order books have been full. We have, so most of our customers think that they will have a good demand. But I'm looking at really 2027 and seeing, looking at macroeconomics, how things will pan out. It's a bit too early to say. US market has always pleasantly surprised us rather than the other way around. So I'm kind of cautiously optimistic about the retail demand. However, if I look at the inventory with the retailers, that seems to be very, very low. So I'm not that particularly worried because, most of the, ecosystem has been prepared. So I think from a demand standpoint, it should not be a challenge at all. And it's borne out or evidenced in our order books, which seems to be pretty healthy as well.
Okay, so that out of the way. The other big story is the surge that we've seen in global cotton prices. I believe from the lows in February, it's up 35%. Of that, 15% surge has happened in the last 1 month. Is that going to negatively impact you? How is raw material inflation?
See, any runaway increase in raw material prices does impact because, overall, whether customer is able to pass it on to, whether the supply chain is able to pass it on to the customers. For us, raw materials are generally a pass-through, and we factor in the higher raw material costs. And cotton prices, by the time it comes into fabric that we consume, it kind of peters down quite a bit. So far, we have been able to price it into our, into our orders. But if there is a runaway inflation, there also could be a switch between cotton and polyester. So these kind of dynamics also play out, right? So if one fiber peaks in terms of pricing, there could be an offset in terms of demand for another fiber. The blending increases, and so on and so forth.
Okay. And broadly, what is the call on margins for the second half of the year, sir? Based on what
there should be growth. Usually, second half is better than first half. Number one. Number two, even in this first half, most of the orders were secured when we were going through a 50% tariff. So we did have some bit of discounts we had offered to our customers, which is not there in the second half. The second half margin should be above the first half margins for us.
All right. So directionally, sir, you're saying that margins could hover around that 12-13% odd march directionally?
It should. It should go up to that 12% is the impression.
Okay. All right. Now you've done various acquisitions, right? The BRFL, Matrix, you've done it in the last few years. Now this integration is taking place. I think BRFL takes place during the course of the year as well. At peak revenue potential, what can the business look like? Put all these inorganic growth together?
You're talking of BRFL revenue or Gokuldas revenue?
Overall, consolidated. Putting BRFL into the piece, yeah.
So Gokuldas itself is growing at about 15 to 20%, and that's the trajectory that we will have this year. So last year we did 4,000 odd crores in revenue. So you could estimate the growth for this year. And then BRFL will merge towards the end of this calendar year, so somewhere around November. So we will have only 1 quarter of revenue. So that may not be adding much. It may add about 400 crores odd of revenue this year. But next year, BRFL will also yield about 1,200 plus kind of crores of top line, in addition to another 15 plus % growth on Gokuldas. So we are looking at a revenue trajectory which, including BRFL, approaching about 5,800 or above, right? 6,000 or that in that trajectory next year.
That's FY28.
That's correct.
With margins of 12% very roughly.
That's right.
Okay, all right. Give us a sense in terms of your return ratios, because of this inorganic growth as well. The sell side is waiting for these ratios actually to improve. So as an entity, what kind of return ratios are you looking at? If you want to break it up for us, the inorganic growth, how much has it diluted your return ratios as well? So give us a sense on that front.
So obviously our investments in BRFL is not borne out in our books because we're not consolidating those numbers. If you look at the apparel return on investment, it should be of the order of 20% or higher. And that's the trajectory we've always held. We've been in the range of 27% in the past. And I think, with these new acquisitions playing out this year, I think next year we should be in that 20% plus trajectory. The fabric investments may be in the teens. But however, fabric's contribution to overall revenue will be sub 20%. So overall, I think the return on investments or return on capital employed should hover in the high teens to 20%, and it should only keep on improving going forward. So I'm talking of 28 and then 28, further ahead, we will be focused on improving it. Because what happens is a lot of investments have already happened, and those capexes will start playing out in the quarters ahead. Rupee depreciation is also not fully realized in our books at the moment, so that hopefully will also play out in terms of improved margins and thus improving ROCs.
Okay, and what about the debt in books? Consolidated level, debt at peak will be what?
So debt at peak, once the merger of BRFL happens, BRFL debt will also come onto us. And I think we will peak at about 800 plus kind of crores, 850 odd crores. And then it will start falling because this year also we'll be generating a good amount of cash flow. So that will also help towards retiring debt. the peak debt will start falling from that level downwards going forward.
All right. So in the next 2 years or so, what should the debt number look like? That's 29?
I would think 29 we should be, sub 500, maybe closer to 250, 300 odd level.
Okay, and there is some news that you're looking at setting up some more machines as well. What is the capex plan out there, the asset turn as well? I think Karnataka and various other states is what you'll have said that you're looking at adding some capacity. Yes.
That is correct. So, we need to look at growth beyond. And if I start looking at capexes today, they will start yielding revenue in FY20, late 28, but early 29 is when that will happen. So looking at how, in the FTAs are panning out, etc., we are keen on adding capacity. So my sense is that in the next year, we will be adding about 125 to 150 crores of capex. And this year also, we would be gunning towards about 125 plus crores of capex.
Okay, and BRFL, it breaks even in, I think it starts reflecting from November, December. So it breaks even in a couple of quarters?
It'll start breaking even. It'll break even in Q1 for sure. Right? It may break even in Q4 itself at an EBITDA level, but at a PAT level, it'll start doing that in the next calendar year.
Oh, it's always a pleasure, sir, having you on the show. Thanks a lot for joining in. Core business grows by around 15%. Margins hover around the 12% odd mark. The BRFL acquisition gets into the books, and ROC directionally moves towards the high teens to around the 20% odd mark. Thanks a lot for joining in. Have a very good day ahead.
Thank you.
Well, let's focus on a couple of stocks then from the broader markets that are buzzing around. Sudarshan joins us down to break down Ather Energy and Federal Mogul. Sudarshan?
So we'll start with Ather Energy, which has seen block days of almost 1,758 crore. That has happened in the block window. And equity, if you talk about, it was 2.9% equity. We understand that Hero MotoCorp is likely a buyer in the block days because if you talk about the yesterday, company had announced that it's going to invest 1,758 crore, and that stake buy will happen by September 3. But in all probability, it has happened today in the block window. Currently, Hero MotoCorp's holding ahead of this block deal was 29.8%. Now, if Hero Moto has bought the stake in Ather Energy via block deals, its stake will increase to 32.8%. Just last month, Hero MotoCorp via preferential allotment had invested almost 1,000 crore, and because of that, its stake had increased to almost 29.8%. And that's the reason Ather Energy is in focus and the stock is higher in the trade today. Next one is Federal Mogul. Company had announced interim dividend and special dividend. Interim dividend was of rupees 7.50, special dividend was of rupees 86.50, and that's the reason this stock too is in focus.
Right, thank you very much for that. Let's talk about more stocks. Metropolis doing well today. Ekta, what is it that stood out from the investor meet yesterday?
Well, yes, a couple of important takeaways. First, they've spoken about the FY27 growth targets. So revenue growth of around 14 to 15% is what they are targeting. 100 to 150 basis points EBITDA margin improvement is what they have estimated. 25.2% is where they closed in terms of margins in Q1. They're expecting a 300 basis points EBITDA margin expansion over FY26 to FY29. So the longer term target is to improve margins further. Now, growth targets in terms of the B2C segment, 1,000 owned stores by FY29 and beyond. Pathology is what they're looking at, maybe into vitals, diet and consults. True Health, which is their preventive testing arm, should be around 25% of revenue versus 18% currently. And B2B, which is basically their specialty testing, should move to around 45% in terms of revenue versus 40% currently. Inorganic additions are a strong path of growth on a 3-year basis for the company as well.
Okay, thank you very much for that. Let's get in Somil Mehta on the show now to find out a few trading ideas. Somil, morning, good to have you. 24,150 on the Nifty, so recouping part of the losses that we had on account of the cash session. But where do we go from here?
Good morning to everyone. See, the overall trend still remains positive. We've seen a lot of volatility in Nifty. We've seen range-bound movement as well. In the last couple of weeks, we are stuck in a very narrow range between 24,400 and 24,000, so 400 points range. However, this consolidation I'm expecting to break on the upside. Now we have to definitely be very cautious because this is the third time we are taking resistance at 200 daily moving average, and we slipped down below 24,200, which was very crucial support as 40 daily moving average. So cautious stance. Stay on the large caps, stay with the themes which are going on with a strong uptrend like pharma, like defense. I think IT has again started moving up, which is looking good as well. In yesterday's show, I had mentioned about Tech Mahindra. So these are some themes which I really like. And I think now the next move should be on the upside, and I'll be expecting a breakout about 24,400 for a target of 24,800, 25,000 in the short to medium term outlook. Very similar in the Bank Nifty as well. It has been consolidating previously, third or fourth time actually the Bank Nifty has taken resistance around 58,000. So that becomes very crucial now. However, I'll be expecting this entire range to break on the upside, and the view should be positive. My medium-term targets are around 59,000, but I'll be expecting markets to go, Bank Nifty to go at least till 58 to 50 in the short term as well. So overall, a positive view. Buy on decline should be the strategy.
Okay, thank you very much for that. Look at that listing coming through for Tempson's Instruments. The stocks doubled straight away on day one. Issue price 300. Stock is open at 634. The subscription was also very strong at close to about 185 times. And that stock is absolutely flying away. As of last year, the company ended the year with a revenue of 445 crore rupees, with a bottom line of 71 crore. And the company has been growing at 25 to 30% on a CAGR on the revenues and on the margins, and on the profits, it's been about a 32% revenue CAGR. Very solid growth. Seeing this is a company which makes contact and contactless temperature sensors. Get into a break. Okay. All right, before we get into break, Saumil, what about the stocks that you're recommending?
There are two stocks which I recommend. The first one is Sagility. Sagility has broken out of a huge, triangle pattern, trading about 20, 40, 200 daily moving average. Great setup. I'll be expecting a medium-term uptrend for Sagility, and also in the very short term. The stop loss should be around 41 and the targets are above 54, but at this point of time, short to medium term targets are 54. The second stock I've chosen is Astral. Astral has also broken out of a small triangle pattern, trading about 20, 40, 200 daily moving average. We've seen a good uptrend, so I'll be expecting this to continue. My stop loss for Astral would be around 1500 and my targets would be around 1660.
Okay, thank you very much for that. On Sagility, yesterday only Nimesh was telling us that the street is expecting some sort of a global business tie-up, which is why the stock, after consolidating off late, is showing some signs of life. Get into a break. We'll come back and talk commodity. Stay tuned. Welcome back. Let's talk commodities now. And Manisha, today it's not crude, not precious, but it's agri-commodities. And the way it's going up, it's going to pinch our food.
It already seems to be doing that. Well, yes, international markets are looking at food prices going higher. Inflation has been on the higher side as well. And I'll get you on what we've done in sense of August for many of these agriculture commodities and for this year as well. But look at the overnight moves first of all. And cocoa, I mean, not an essential commodity, but it has been going up every single day, 7% higher. And as we get into festivities, Christmas, New Year, this is a commodity that will perhaps be in a very, very strong demand going forward. Sugar is another one, 3.5% of a surge in the overnight markets. And you have cotton, which has gained up by 3% as well. Let me show you on what we've done in the month of August, because much of these gains actually have come in July and August more than July. So this is what we've done in August. For soybean, we are up by 7% in this month. It actually is anywhere between 4 to 14% higher, as we can see on your screens. Rubber and cotton, of course, are agriculture industrial commodities, but palm oil and edible oil, India imports the most of it, is up 4% in last 1 month, 19% higher in the matter of this year right now. And wheat, of course, the Indian prices have been rising as well, but the global prices have been much on the higher side. 12.5% of rise for wheat prices globally in the month of August, and perhaps the best performer or major gains that we've seen in case of agricultural commodities seems to be coming in from wheat. 46% of gains in this year till time, and 31% up for rubber, 43% up for cotton in this year till time. So it has been very, very strong gains that we seem to be dealing with. The whole year, the first half has been on the stronger side, and month of August only adding to those further gains there. Some more commodities on your screen, and rice in Indian markets have risen by 10% in the matter of last couple of months. These are the international future prices, where month of August has seen again 10 to 25% of gains. Sugar clearly has been on the move higher. We've seen cocoa, we've talked about that, sunflower, corn, and these prices have gained anywhere between 20 to 54% in case of rice there. So very, very strong gains. And this is multi-month high, multi-year highs as we're looking at in commodities. Cotton is trading at a 2-year highs, wheat at 3-year highs. You have soybean trading at more than 2-year highs as well, 15-month highs for sugar, cocoa trading at a 2-month highs as well. And there are various reasons on why many of these agriculture commodity prices have been rising. One, it is about adverse weather in producing countries. There have been reports of floods, drought, dry, unseasonal rains. All of that has impacted crop in many of these producing countries. And then it is about El Nino as well, which seems to be impacting yield right now as we speak. And El Nino for India will start to develop until the month of February. And that is when you will see Rabi sowing coming up as well. So that is what the concern really is. And many of the markets really seem to be preempting these price rises as well. The higher crude oil prices is leading to higher fuel cost everywhere. So input costs in various countries seems to be increasing as well. It also is about higher biofuel and ethanol mandates that are coming in from countries. Well, let me tell you that 27% of global edible oil right now is being used as biofuel. We do understand of those ethanol mandates, not just for India, but Brazil, Argentina, US, many countries are coming out with these mandates right now. The West Asia conflict also has led to shortages of fertilizers, prices rising because of that as well. And the Red Sea shipping issues also have led to declining freight availability and rise in prices there. It also has to do with the declining global grain stocks and various other commodities. The inventories in many of those exchanges are trading at a multi-year lows. And all of this is the reason that you have all of these agriculture commodity prices trading at multi-year highs.
All right. Well, Manisha, thank you very much for that. So soft commodities also picking up, as Manisha puts it, across a range, both, because of the supply disruptions already there, and of course, some of the weather-related issues as well. We'll take a quick commercial break here. We're going to come back. Our special segment, it's the economy. Lata discusses how the rush of $80 billion of FCNR deposits may impact bank earnings going forward. Stay tuned. A discussion coming up.
Well, the Reserve Bank told us that as of August 14th, India had inflows of nearly $73 billion by way of FCNR deposits and other foreign currency borrowings of banks. Thereafter, all major banks, that's HDFC, ICICI, SBI, BOB, announced raising at least $3.5 billion via bonds and borrowings. So the market estimates of inflows of about 85 to 90 billion by August 31. And the estimate is maybe $100 billion by December 31 when the RBI's bond swap is still available. Let's take 90 billion till August 31, multiply that by 95 rupees to a dollar. It works out to 8.5 lakh crore of deposits flow from June end to August and only from the foreign sources. This works out to a near 5% rise in bank deposits in just 10 weeks. Will this improve bank loan growth? Will it improve their margins? And above all, can this sudden increase in money lead to risky lending? Who will borrow? To answer these questions, I have with me Nitin Agarwal of MOFSL, Motilal Oswal, and Sachin Sachdeva, who handles finance at ICRA. Gentlemen, good morning and thank you very much indeed for your time. Okay, Nitin, to start with you, would you bet, are you upping your loan growth numbers?
Yeah, hi Lata, good morning and thanks for having me. Yes, there is a good possibility of a further uptick in the loan growth estimates. We in fact wrote a note more than a month back saying that there is an upside risk that we are seeing to our credit growth number. We started the year looking at around 13.5 to 14% growth. After 1Q, we have already revised it up to 14.5, 14.6. And looking at how the latest fortnightly data came in last, it was like suggesting of a 19% plus credit growth. I think there is a case for a credit growth number for the system to be moved towards 15.5, 16% at least for the year.
Okay. Likewise, a question to you, Sachin. You all have already upped your number, but even that report is about a couple of months old. Will you also look at 16, 17% credit growth this year?
Yeah, Lata. First of all, good morning. Yeah. So you rightly said that we wrote that note in the month of June when we upped our estimate to 13.5 to 14%. But looking at the current numbers, the way the deposit have been coming in, boosting the liquidity, and even before that, till July 31, the way the numbers have been coming at 18, 19% kind of a growth, definitely it makes a case that we will be probably revising it upward. Now, whether we revise it by 1% or 2%, like take some time to get to that number, but definitely there will be some upward revision. But having said that, there is one more angle to it is that last year's number, if you look at, that was 21 trillion on a like-to-like basis. Because when you compare 31st March to 31st March, then that was not 29 trillion, but 21 trillion. Now, compared to that, how do you go? We are currently at 30 trillion estimate for the full year. So there is definitely some upside to it, but may not be a very huge margin upside. A little bit, some increase could definitely be taken in the coming months.
Yeah. Okay. This is just for us data people and, for people like Nitin. Sachin makes a very important point. Until last year, RBI was giving fortnightly data. Now they are telling banks, give us August 15th, August 31st, September 15th, September 30th, So the data, what we are comparing, as Sachin says, is March 31st data to the last Friday of last March. And therefore, it does look like the credit growth is bigger. Technically, if you compare, it is 21 trillion versus 18 trillion. Point taken. But anyway, at the moment, we are just looking at the rush of about 9 trillion rupees via FCNR deposits up until August 31st. So, Nitin, does that improve margins? Because this has got no CRR, SLR problems and no priority sector.
Yes, while FCNRB does not have any CRR, SLR requirements, but I think most banks here are suggesting that this is, especially the ones wherein the funding cost is already optimized, the larger private names. It's a margin negative raising that you'll be doing because you still have to pay or you still have to hedge the interest rate component. Only the principal is kind of hedged free of charge by the RBI. And it's akin to a term deposit that you are raising. Therefore, the effective cost will be more like 6.5. So it is net a margin negative. It will kind of bloat your balance sheet for the time being because a lot of lending that we are seeing, like for example, the last fortnight, we did see more than 3 trillion increase in the credit base. And a lot of
1 minute, Nitin. 1 minute. I'm sorry to interrupt you. You are actually saying that the FCNR deposits are costlier than a comparable term deposit. You're saying it's margin negative.
Not to the term deposits, but to the overall funding cost, the portfolio cost of deposits. Because that cost will be, say, broadly around 4.5-5% for the larger banks, and mid-sized names will be more like 5.5 to 6.5 in that range. So to that extent, FCNR, it's like a TD, which is coming at a higher cost than the portfolio deposit cost.
Okay.
Of course, it has benefits on the CRR SLR front, which makes the economics better, but that will play out over the coming period. For now, because you'll be deploying these deposits mostly into the corporate lending or into the NBFCs at a very fine spread, so there remains a possibility of a very slight margin dip. And this will also depend on if these deposits are pure inflows or they are leveraged, because a lot of these deposits, significant chunk, will be the leveraged flows. So that will kind of bloat your balance sheet, and therefore the denominator effect may have a slight negative connotation on the margins.
Yeah, and there is another factor which keeps coming back to me, but we don't have the data for it. Can we pull up the FX data of RBI's reserves? If you look at RBI's reserves from June end to the last available number in August, the rise is 40 billion. It is not 72 billion. So clearly, there is also a sale of dollars. And the other possibility is there is a churning. Some old deposits have been sold off and they have come in the form of new deposits. So, no, not this. I was thinking of RBI FX data. It's okay. The point I'm making is that maybe net the accretion to deposits is not that much. It's likely that some old deposits was rechurned as new deposits with the FCNR scheme. Okay, Nitin, Nitin, you want to add?
To that point, I will also add that there are banks who are looking to retire bulk deposits. So, for example, in our recently concluded annual conference, there were quite a few PSU banks who indicated that they will use FCNR to retire bulk deposits, in which case it will become more like a margin neutral event, because you are raising one relatively cheaper deposit to retire a high cost bulk deposits, and your balance sheet is not seeing a bloating because of that.
Yeah, fair enough. But you still think that banks may see a rise in their earnings because of volume growth, not margin growth, correct?
Yes.
Okay.
There will be an absolute increase in NII because of the lending growth itself, which has picked up. And to that extent, you will see some marginal uptick in the profitability estimates also.
Fair point. Now, Sachin, the bigger question, the worry that I have, and I will be glad if you demolish it, you're suddenly faced with 10 lakh crore in 2 months. I'm saying 10 lakh crore for a reason, because that is the number that RBI's data itself is giving us. If you look at from mid-June to mid-August, we don't have the end August number yet. This kind of rush of money, you have to deploy it somewhere. And at the moment, banks don't have too much of corporate credit. They have working capital credit from corporates, but more of it, the demand is from retail. Will you end up lending risky?
So, Lata, you rightly said, that's a question how banks look at the lending side. Now, the key question is, if we look at the data which is available till last month, they have been mixed. They are spread across MSME, secured retail, and corporate also, because bond yields were high, so corporates were coming to banks. Now, with bond yields sort of cooling off a bit, some demand may shift back to bonds. So, banks are left with a limited choice in terms of secured retail and MSMEs. Now, if this sudden influx of liquidity and they start deploying in a riskier asset, definitely that can lead to some asset quality stress going ahead. But having said that, I don't take that as a worry of too much for two accounts. One, that we are currently at a very pristine asset quality level. So even if I look at a slight uptick in terms of the, slippage rate, but the recoveries remain steady. So per se, overall asset quality stress will not boil down to a very significant number going ahead.
Fair point. I'm not saying all hell is breaking loose. Yeah. I'm just saying whether the very pristine asset quality will now, that fall in NPAs bottoms out, and do we see a rise in NPAs? Nitin, same question to you.
Yeah. I think, for now, system looks to be poised well on asset quality. We are not seeing any challenges, at least for next couple of quarters. The unsecured, we have already seen a lot of stress flowing in, and new cycle is probably beginning to take shape. So you will see some recovery in MFI, PL, and credit card, possibly in that order in the coming quarters. And SME as a space, I think the government keeps coming up with the schemes, and the last ECLGS scheme has further handholded things there. So, and a lot of lending, therefore, which is what is happening, is more to the corporate and the services sector, and including NBFCs. So, wherein we expect the delinquency risk to be relatively more controlled, and therefore we have a more benign outlook on asset quality, at least going into the second half of 27.
Okay, I take your point. So maybe those fears are unfounded. My only fear is that there is a West Asia dislocation, which hurts MSMEs more, some raw material disruption. And there is the El Nino, which may affect pockets of retail credit in some rural areas. On that, you have banks and NBFCs eager to lend. Is this a recipe for some kind of increase in NPAs? Okay, I take your point that you guys are not that worried, though Sachin perhaps is buying my point of view a bit. Thank you very much, Nitin and Sachin, for joining in and helping us understand how this rush might work out. We will have a more detailed debate after we get the full FCNR numbers. Thanks much for watching this edition of It's the Economy. After a break, Chartbusters.
Tejas Networks receives a letter of intent worth nearly 1,600 crore rupees from TCS, nearly doubling its overall order book. Once the purchase order is received, the stock rallies over 10%.
Kotak Institutional Equities issues a bullish call on Just Style with a buy rating and a target price of around 1,175 rupees a share, citing attractive valuations and expecting its new management to drive growth. The stock is locked up 10%.
Ather Energy rallies after a large block deal where nearly 3% equity worth about 1760 crore rupees changes hands. Hero Moto is likely to have hiked its stake in the company via a block deal, is what we learned.
Metropolis held gains on bullish commentary. The stock is up close to 3% as the management in its investor meet guides for around 14 to 15% revenue growth and around 150 basis points of margin expansion in FY27.
A stellar debut for customized temperature sensing solutions manufacturer TempSense Instruments. The stock more than doubles on debut, listing at over 600 rupees versus its issue price was 300 rupees, still holding with a gain of 97%. The management joins shortly on the show. Don't go anywhere.
Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And the IPO market, Mangalam, is live and kicking. So you want to take first strike, then you go for it.
Let's go for it, Nigel. We have the GPU as a service provider, ESDS Software Solutions, 720 crore rupee IPO, which is open for subscription. And it's one of the only two Indian players providing the full spectrum of GPU ASS, or AAS, as we call it, GPU as a service offerings, including cloud managed services, data center infrastructure. Piyush Somani, who's the chairman and managing director at ESDS Software, joins us now on the show and in the studio as well. Thanks a lot, Mr. Somani, for joining in. You know, it's a very interesting business, also trending right now as everyone speaks about data, managed services and all of that and stuff. Just wanted to understand a little about the economics of AI/GPU as a service business. I mean, what's the capex per megawatt per GPU that you have? Expected utilization? What's the kind of revenue that you make? And EBITDA that you make per, megawatt? If you could give us a sense, basically, to explain the economics, and thereafter we take all the numbers forward.
So in India, people are investing close to 50 to 70 crore rupees per megawatt to build the data center. The base is the data center. For an AI factory, you have to build the data center. So 50 to 70 crore for megawatt of power, the MEP equipments in India. Outside India, people are doing around $12 million. If you go to Europe or if you go to Australia, it's around $12 million per megawatt. Now, the GPUs that will sit inside this data center, they will cost you approximately 550 crore rupees in India or close to $60 million outside India to put the GPUs in this per megawatt kind of an AI data center. And the revenue that people will, so currently B300 and GB300s are trending in the market, and on an average, the service providers in Europe or in America or in Australia, Southeast Asia, they are charging in the range of like $5 to $6 per GPU per hour at the moment, and the rates are going upwards of 30-35% every 3 months at the moment.
So, from a payback period in the investment, what does it mean for a business like yours? And also, what's the useful life and refresh cycle of these cards?
So the GPUs are an appreciating asset at the moment. So they are not depreciating. The prices have gone up multifolds in the last 6 months' time. And the target which all these neo cloud companies outside, their target is to have an 85% EBITDA margin. ROCEs, they are seeing somewhere closer to 45%. PAT margins around 40%. And the ROA is also upwards of 40%. And around 1 turn is what people expect. So whatever you've deployed today, equal amount has to come in the form of your earnings every year is what they target. But these are the numbers, like 85% EBITDA margin and 40% PAT margins is what they target.
Piyush, welcome to the show and all the best with regard to this issue. Piyush, one question before we get to understanding your business. Normally we see promoters coming and they sell some stake in the, the IPO. Here you're doing an entire fresh issue. I think post this issue, you'll have close to around 40% in the company. Do you want to hold on to this, or are you very, very bullish on the company that you expect actually things to really pick up from here on? And that's why you're keeping your holding intact. If you want to sell some shares, you'll do it at a later date.
So here, there's no need of making any personal money here, personal gains here. So I have no intentions to sell anything in the future also. So the purpose here is to make sure that we've come with a larger purpose. India's journey has just started into AI factories right now. And this is a business model which I see that will continue for multiple decades now. So next 50 years, 100 years, the world is going to be dominated by AI infra. If you will see globally, out of top 20 companies, the top 10 companies which were in software products, they have all diversified into AI factories now. And trillions of dollars they are investing into AI factories. So we see that there is an opportunity of trillions of dollars of earnings happening out of AI factories, and that is the reason we are there. What if I sell something today and make 10-20 crore rupees, is that going to give me anything? Nothing. Compared to where we can reach in next 5-10 years time, it's peanuts.
So you're sounding very, very optimistic and bullish about it. I like the way you're putting it. It's peanuts right now. You're expecting, a big runway going ahead. Got that, Piyush? Let's understand a couple of details. So since you briefly went to those numbers, I'm talking about the Sharon AI deal that you've backed.
Yeah.
Do you expect more such deals to be closed out?
Definitely. So when this deal was announced,
as large as this, $1.2 billion approximately.
Yes. So funnel we have at the moment is very large, and around $14 billion of funnel is there with us at the moment. And India also we have a very sizable funnel at the moment. See, when this deal was announced in the month of March, April, this was the largest cluster that was getting deployed. When you enter in an ecosystem, once you get inside an ecosystem, then obviously a lot of others who have similar requirements, they start coming.
So the funnel is looking at $14 billion approximately, and you hope to get some part of that. Just one question with regard to the Sharon AI deal. You mentioned just now that per GBU, I think, so per hour per GBU is around $5 to around $6 approximately.
Correct.
Out of that, you'll have to pay, close to around, say, 3.5 or $4 approximately. So the rough spread should be around $2 per hour per GBU. Approximately, yeah. And you'll have to pay something as well, out of that, which margin could be around 50%. Putting that into perspective, on an annual basis from the Sharon AI deal itself, can you make a PBT of around 700 crores? Is that math roughly working out to that number?
Yeah, there is a possibility that we can have that kind of a spread.
So when does this start reflecting in your books? Is it, from Q3 FY27 itself? Is it...
yeah.
And this is the maximum potential revenue or minimum contractual commitment?
So this is the minimal contractual commitment, and because this one single AI factory can serve only this 8,200 GPUs at the moment, so there is no scope to add anything more in that one AI factory. Obviously, any new orders that are going to come, they will go in the new factories.
New factory. And what could the, overall revenue potential for the new factory be, if you could give us a sense of the capacity, etc.?
As we close the orders from the funnel, obviously there will be an upward trajectory from those also. We cannot at the moment commit anything, but definitely as we progress, we will. And
directionally, say if this one is 8,200 GPUs and you are maximizing at around $1.25 billion on this one, the next one will be how many GPUs?
Depends. There will be some small customers, there will be some large customers. So we will, as we start closing the deals, we will have to inform the regulator.
Potential revenue could be as much as this one or could be much more?
I will tell you about the competitors who are there in the international market. So let's consider our partner Sharon AI. When they did the first deal with us of 8,200 GPUs, that was the first single deal that they did, largest deal that they did with us. And after that, they have closed orders of 200,000 GPUs. Same way, if you will look at Nscale, their first order happened last year in September 2025. From there, more than 1 million GPUs. Their last round happened at a $14 billion valuation. And yesterday, they closed a contract of $45 billion with Anthropic. So companies are seeing this kind of growth in a year also outside India. So I see that in next 1 year, 2 years, we will have multiple such companies in India, 10, 20 such companies who will come into this business model.
Okay, Piyush, one question before we let you go. Last year, you did revenue of ballpark around 500 crores.
Yeah.
But now you'll have the Sharon AI deal as well that will start reflecting. Back of an envelope calculation, if you're going to get a PBT from the Sharon AI deal itself of around 400 crores, and as the core business was giving you around 150, 200 crores, FY28, can your PAT number actually look like what the last year's revenue number looked like, or more actually, because it could possibly be in the vicinity of around 550 to around 600 crores, which compares with last year's revenue of less than 500 crores?
Definitely, we will be working towards that, and we will try to maximize the opportunity. Market is there, demand is there, and we have to do right things to achieve those numbers.
All right. And how is Swaraj any different versus all the other hyperscalers? I just wanted to understand that. What's the moat of Swaraj?
So we could calculate that India's digital sovereignty score as on date stands to around 18. And why? Because we don't have our own orchestration here, our own operating systems here, APM, DAM tools. So multiple tools we identified. We built a Swaraj Cloud platform, and we are now putting Swaraj Cloud to our customers and telling them that this is a complete made in India platform. So our aspiration that over the next 2000 days, we want to take India from a score of 18 on digital sovereignty to 95. And we are taking all other competitors also along with us under Bharat Digital Infrastructure Association. We are ensuring everyone who is doing the same thing in India, we all come together to make sure India reaches there.
Okay. All right. We appreciate you coming down to the studio, Piyush, and explaining the business to us. We've got a date fixed on the day of listing. You're going to be joining back on Chartbusters and giving us further guidance with the way ahead. All the very best, and Mangalam and myself look to host you on the show.
Thank you. Thank you, Nigel. Thanks, Mangalam.
Okay. Time to slip into a short break. Come back. We'll focus on the newly listed company, which is listed at a premium of 100% in comparison to its issue price. Stay with us.
Welcome back. The market's holding well. The Nifty around 24,150. Obviously, a sharp recovery from what we saw as a sell-off in the last hour of trade yesterday on CAS and on Sensex weekly options expiry. Right now, there is a bit of a bounce. The only fly in the ointment is the Nifty Bank, which isn't as performing as well as the other frontline indices. It's the IT stocks which are supporting the frontline index. But let's get you some ideas for profit coming in from our colleagues at Money Control Pro. Khushbu Rai Gupta joins in with the stock that she's tracking. Khushbu.
In today's idea for profit, we have Varun Beverages. As PepsiCo's second largest international franchisee, VBL continues to outpace industry growth. VBL is scaling rapidly, backed by over 23% CAGR sales volume. By diversifying into new product categories and expanding internationally, the company has expanded its growth. The company is building a highly resilient business model driven by its aggressive expansion of production and distribution paired with backward integration. We believe higher demand and strong operating leverage will drive sustained earnings growth for the company. Moreover, the rising focus on adding new categories supported by wider distribution network and steady margins keep the growth story firmly intact. Varun Beverages also dominate the non-alcoholic beverage market by leveraging the powerful production and distribution capabilities. Capitalizing on this momentum, VBL has partnered with Ashi Group to manufacture and distribute the iconic Japanese dairy drink, which is Calpis, in India. The company's impressive earnings growth, a premium product mix, and rising global growth makes it a standout investment opportunity.
Okay, thanks a lot for that. Time to slip into a short break. When you come back, the management of Tencent's instruments will be waiting for us. Remember that, in fact, stock has doubled on listing. Stay with us. Welcome back. You're watching Chartbusters. You're on CNBC TV 18. Well, temperature sensors and specialized cables manufacturer Tempson's Instruments made a stellar debut on the street, more than doubling from its issue price. We're now joined by Vinay Rathi, the director of Tempson's Instruments India, who joins us on the show. Hi, Vinay. Wow, what a listing. Look at that. Happy visuals out there. You, the family, the team. Well, I think it's going to be one big party on Friday evening. So congratulations to you as well as the team.
You could have smiled a little more, Vinay, with that kind of listing in this kind of market. I'm sure the smile could have been a lot wider than what it is right now.
Yeah. Thank you. Thank you very much. So it is really overwhelming, the kind of response, yes.
Right, I understand.
I think, Vinay, you're keeping the smiles and maybe a little bit of dancing. Maybe at the end of the interview, you could sing a couple of lines of your favorite song. But for the time being, let's get to business. Last year, you did around 450 crores approximately in terms of revenues, with margins hovering in this vicinity of around mid-20s. For this year, what kind of a revenue growth are you looking at? I think you've been growing at around 20% or thereabouts, in the previous year, 18 to 20%. Do we see that sort of a replication and you grow by around 20%? And is margin sustainable in this mid-20s or is there scope for improvement?
No, I think we'll be continuing forward with a similar kind of growth and maintaining similar kind of margins. But we are trying a lot of newer kind of territories, newer customers. So that is what would be pushing the margins in the same direction, also growth in the same direction. And that is what we think would be in the future for the company.
Around 550 crores in the coming years with margins in the vicinity of around 25%. Doable, right?
Yes, looks like in that direction. Also, our companies which we have started outside India, 3 of them about 2 years back, so they also would be kicking in a lot of revenue. So we see a good growth possibility for Tempson's in future.
Right. That you preempted my next question, actually. The companies that you started outside of India, you have earlier said that exports are growing 10% higher than all the other businesses, even though the margins are same. If you could give us a sense on how this contribution will pan out from these companies, say, over the next 3 to 5 years, if you could give us that sense. And also, the demand for categories like electrical heating system for oil and gas, petrochem and defense, along with process manufacturing industries. How much do they account for in your overall sales right now? How is that likely to pan out over the next, say, 3 to 5 years?
Right. So regarding the export market, so last few years, we started 3 companies outside India. And so those would be growing much faster because the initial years were just the seeding years. And now we are going to see the fruit. So especially for UAE, what we did was a 3x last year. So we kind of see that similarly the geographies that we have started in Korea, Poland and Mexico, so they would be adding to this kind of growth. And regarding petrochemical, we see that petrochemical is going to be a big booster once the things settle down, the geopolitical situation. So this would add to the company's work in that direction. Also, I would say the company is also adding to the original base of the end user, heavy industry based customer base, to also adding a lot of OEM based customer base. So that is what would be adding to the...
And that is what I wanted to know, because electrical heating solutions, that is exactly what I wanted to know. Electrical heating solutions, which was about 4% of your revenue 3 years ago, has now become 21% of the revenue. There is a fair amount of growth that you're seeing, outsized growth here. How much will that be as a proportion of your sales? And is this margin accretive or similar to the margins that you do everywhere else in your business as well?
So the margins is similar to everywhere as well. And we got some specific approvals in the oil and gas segment from some large customers. So we would be going in that direction for those kind of products. And that would be significantly growing. I would not say the kind of initial growth what we saw last year. So that was mainly because of amalgamation of a company for heaters. But it will grow, I would say, a little bit faster than the regular growth rate at Tempson's.
Okay, all right. Vinay, I'm wondering how Mr. Amit and Mr. Puneet are feeling today, the promoter entities. The names, I'll tell you why. Because I think they sold some shares in the OFS, right?
Yes.
They could have got double today.
It was a decision, and You never know what is the value the market would give, because when we started, so like you are playing a blind game.
Yeah,
So you
markets
don't
are
know
tricky.
what-
I can assure you,
It is,
Vinay,
I
markets
think-
are tricky.
Yeah, market.
Okay.
Yes, it could also be the other way around. Yeah, thank you.
Okay, tell us about the working capital days. That's got stretched a little bit, but I recall, when you had your IPO had opened up, you had said that you expect things to normalize. Now you're at the liberty of giving us a number. So what should the working capital days stabilize at?
Actually, last year, the working capital days, as I told you last time also, they were increased because of we kind of acquired some companies. And so those were done in the last days of March. And that is why the balance sheet got consolidated. And whereas it kind of increased the working capital days artificially. But if you see the year before that, so those were the normalized working capital days, which would be continuing in future.
So about 100, 120 is a normalized number. We should look at it by the end of this financial year, right?
So it will be around 130, 140 days. So that is the kind of normalized number.
Right. And just finally, before we let you go, do you have any guided range when it comes to the seasonality of your business? Because a large part of your revenue obviously comes from a couple of quarters. What are you doing to de-seasonalize that?
No, I would not say the revenue is seasonalized. I would say about it would be in the ratio of 45-55 for the first half and the second half. So it is not seasonal. So, but obviously there are some project orders which have in the end of the year there would be more shipments. But overall, I would not say it is seasonalized. So it is quite normalized. Maybe 20% for the first 2 quarters, and then could be 30% for the next second half of the year.
Okay, and now that business is done, talks about business is done, it's now time for you to, live up to your promise. Sing us a song on this occasion. It's such a happy occasion for you and your shareholders out here.
So I think your TRP will go down if I sing a song. So it is better.
Congratulations.
Thank you.
Vinay, we appreciate you joining in, giving us some color on the business. Have a splendid day ahead with you, your family, as well as your team. We're going to be holding you to these numbers, and we look forward to our next interaction. Thanks a lot for speaking to us here on CNBC TV 18.
Thank you.
Okay, on that note, though, we'll wrap up on this edition of Chartbusters. That's it from Mangalam and myself and the entire team that put this show together. You stay tuned, though. Mangalam and the team are waiting by on Trading Hour.
Good morning. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me is Ritu Singh. This Friday morning, the market looks a lot better than what it was over the last few trading sessions, and that is largely on account of the IT stocks. So the IT stocks have found their form this morning, up nearly 3% for the IT index, the mid-cap and the large-cap IT stocks gaining, and that's on account of the big surge that we saw in Salesforce overnight. Salesforce stocks were up 22.5%. Now, intuitively, one would say that, if Nvidia has risen about 9%, the AI rally is back, it would be at the cost of some of these legacy players. But Salesforce said, why does AI have to have all the fun? They actually went ahead and partnered with Claude and came out with a new business called Claude Force, where they would actually combine their powers. And that's something that the street is perhaps taking note of. Will legacy IT companies combine as against compete with new age AI solutions? And as a result of which, we are seeing an upward move on all these counters. So looking good so far, at least from one sector, but by and large, not particularly bad, Ritu.
Not at all, Mangalam. In fact, it's a very good Friday morning, and these IT names particularly perking up in trade. I mean, if you look at the top contributors to the Nifty 50, we pull that up for you on your screen, whether that's Infosys, TCS, even to a lower extent, Tech Mahindra, HCLTech, all of these are adding to the gains that you're seeing on the frontline index. That is, like you said, doing a relatively better job today than we saw in the last few trading sessions. There on your screens, some of these IT heavyweights, they're the top contributors to the Nifty today. But on the flip side, of course, there's ICICI Bank, UltraTech, Cement, Bajaj Finance, all of them exerting some downward pressure. Now, the Bank Nifty is holding up as well, apart from the IT pack, trading with gains of about 29 points. The broader market's also very much in the green, and the market breadth is also positive today, with about 1842 stocks on the advance versus about 1287 stocks that are declining on the National Stock Exchange. So that's how we're stacked up at the start of the trading session. There's lots of buying in IT, media, realty, auto, metals names. The only pockets of red sectorally are the FMCG and the energy names. But with that, let's focus on one particular name, Just Dial shares. Now, they're soaring in trade today after Kotak Institutional Equities issued a bullish note on the company. And they also said that the new management is looking to revive growth. Reema Tendulkar joins in with more details on this one.
Thanks so much for that. So for Just Dial, the story, as you rightly said, is a Kotak Institutional Equity note, which is betting on the new CEO. Remember, the founder and CEO, Chairman VVS Money, stepped down earlier this year, and the new CEO, Dinkar, has taken charge. Kotak's target price is 1,175, which is a steep upside from the current level. Basically, Kotak says the new CEO is looking to revive growth. The focus will be on paid subscribers. Now, the company today has 56 million listings, but only 10% of them are actually paying subscribers. So they want to bridge that gap. The second avenue of growth is focused, as I said, paid campaigns is one, new products, and even B2B merchant onboarding. So right now, when you think of Just Dial, you think of a B2C kind of a platform. We all call Just Dial to get access to a plumber or a salon close by. But the B2B is only 10% of the company's merchant base. So here also the company has a runway. And that, Kotak believes, will help the company revive the collections. So last year collections were very muted, less than 2%. In Q1, we've already seen a pickup, 17% or 14% Q1 pickup in collections. But the management focus should be on getting back to double-digit collections growth. But the big question for Just Dial is really the cash on the books, because the market capitalization is 6,000 crore rupees. The cash on the books is also 6,000 crore rupees. But Kotak's view is that as of now, at least the new CEO is not going to take a decision on whether the cash needs to be returned to the shareholders. If it does happen, that will be an additional trigger.
Indeed. Hang in there, Reema, because we have to speak about Vodafone Idea as well. Kumar Mangalam Birla, during the Vodafone Idea's 31st AGM, said that FY27 could be the year of execution and delivery. Reema, what were the key takeaways for you?
Thanks so much for that. So I think the key headline from Kumar Mangalam Birla at yesterday's Vodafone Idea AGM is FY27 is going to be the year of execution and delivery. The last couple of years, the AGM, so the investor perception about Vodafone Idea was always about an existential crisis, the company being in a survival mode. But now it looks like the foundation is shifted and the focus is now on capitalizing growth and getting into the execution mindset. The reason is why things are different this time is many of the legacy issues have been addressed. Now, one concern plaguing Vodafone Idea is that they kept losing subscribers ever since the merger in 2018. Q1 FY27 was the first quarter when the company reported positive subscriber growth. That's one. The second issue for Vodafone Idea used to be the large debt, the AGR dues. Now the moratorium gives the company leeway till 2035, which means for 9 years, the cash is conserved. They don't have to make payouts related to the AGR dues for the next 9 years. So that's enough runway. And also, in terms of the funding, but now you've got the promoters infusing money via warrants. So that's put in confidence capital. And the company said that they're actively seeking bank debt funding of 35,000 crore rupees. Also, it's not just stock. Right, you are actually seeing signs of the company making investments. Now, earlier this year, the company said that they're planning to invest 45,000 crore rupees in terms of investments, infrastructure upgrades in the next 3 years. Now, of that, 9,000 crore yesterday, Kumar Mangalam Birla said at the AGM, equipment orders have already been placed on it. And finally, on that big issue about tariff, Kumar Mangalam Birla did use the platform of AGM to talk about how there is a case for ARPUs to go up. ARPUs for Vodafone Idea are closer to 190, but he said periodic tariff rationalization is essential for the industry. And finally, I think the bottom line is where we went back to at the beginning. This is going to be a year of execution and delivery. He says that Vodafone Idea is in a better position than it has been in the recent years, and there is a reason to be optimistic.
Reema, thanks very much for getting us that update. Let's slip into a short break on that note, but when we return, we'll focus on the bond markets with Manisha Gupta in just a bit.
Hello and welcome to Bond Street. Today joining us in the studios is Mr. Dinesh Kumar Khara. He's Chairperson, Corporate Bonds and Securitization Advisory Committee, SEBI. Mr. Khara, hi, thank you so much for joining in. Really appreciate your time here. What does the committee really do, the one that you're heading? And there's one thing on the table right now, and that is about what would really change this market, deepen this market further.
Thank you very much, first of all, for having me on your show. Well, when it comes to Corporate Bond and Securitization Advisory Committee of SEBI is concerned, their major focus is in terms of how to really develop the corporate bond market, make it deep, and also bring in the sufficient liquidity. Because, you know, currently when we look at the size of the bond market, it is somewhere around 60 trillion. Right. But when we look at the trading in the bond market, it is just about 0.16 to 0.17%. So actually speaking, you know, majority of the bonds are bought and hold. So buy and hold is something which is a reality, and majority of the bonds which have got a liquidity are either into AAA or AA. You know, when we look at the Indian economy and when we look at the overall size of the funding requirement, so actually speaking about infrastructure itself would have about 800 trillion funds to be required in the next 20 years. So I think from that we really step up the bonds, or for that matter the spending, because if at all 40 trillion spending has to happen maybe every year, then we have to see that how best we can really deepen this market, and which actually means that we have to go beyond the AA, and also we have to see that the bonds are not only buy and hold as an instrument.
All right. You've now seen this market from both chairs, Mr. Khara, as the head of India's largest lender and as regulator's advisor as well. What does a banker understand about the bond market, and why hasn't it deepened as the markets would desire it to be?
Yeah, because, you know, all this while we have seen that when it comes to the investors, issuers are willing to actually raise the money through the bonds. But when it comes to the investors, the market was very skewed. As I was sharing with you that, you know, it's all institutions and they go for buy and hold kind of strategies.
Right.
So I think as a banker, when I used to look at bonds, obviously it was the yield which was of interest to us. And we were very keen to really, in place of loans, we felt that maybe we can actually, when it comes to our portfolio, we can diversify our portfolio. Part of it could be bond, and which will eventually improve our portfolio yield for the book also. But, you know, when we actually look at it in the market, I would say that when it comes to retail investor having invested would actually look for liquidity as well. So though as far as, you know, AA and AAA bonds are concerned, there is enough liquidity in the market. Even banks can offer loans against such bonds.
I'll just go a step back. And you said to fund India's infrastructure requirements in the next 20 or 25 years, you need way more than what is required right now. How much of that gap do you think bond markets can realistically actually fill in?
See, my sense is that, as I was mentioning, that about 800 crore is a requirement, and currently, if at all we look at it, majority of that is getting funded either through the central government or the state government. When it comes to the retail subscription or support to the infrastructure, it would be actually just about 20% only. So I think my sense is that this 20%, if at all, it has to go up considering the size which is required. So the 20% of this 800 crore is something which can jolly well be funded by the private players, and that too, they will have to go for the bonds, which would be the best of the instrument.
You talked about the retail market, and well, yes, this market has opened in more ways than one. One, of course, is the entry ticket size itself that has been brought down quite sharply. And then it also is about 40 plus registered OBPs now with SEBI. What channel do you see evolving from here if this market has to deepen further?
So I think OBPs have got a very important role to play in the days to come, because particularly when it comes to experience for the retail investor, how can it be the best of the retail experience? And that is something online bond platform can bring in. So I think to my mind, they have got a very important role to play. But again, they have got a responsibility also to ensure that the retail investors who are being brought on board, they should be adequately educated in terms of the credit risk, in terms of the liquidity risk, in terms of the tenor risk also. Because unless and until the retail investors understand these risks well and thereafter take a call, I think then we will be in a position to build up I would say, a committed investor base across the country. And I actually see that happening because the way the OVPs have come in, the 40-odd OVPs can actually play a very decent role. We have started seeing the initial traction, but yes, of course, they have got a long way to go.
So while entry for retail seems to be getting easier, but the retail also needs exit, and for that you need institutions on the other side. So what comes first, and how are you looking at that ecosystem developing?
No, I think maybe it will have to develop almost simultaneously. Because when it comes to retail investors, their liquidity needs would be significantly high. And as of now, as I was sharing, when it comes to bank funding for the liquidity against these bonds, it is only for AA and AAA. And not for the low grade. So there could be credit enhancements which can be done. There could be, some kind of backstop arrangement which is available. So these are the kind of things which will probably enhance the confidence into the instrument also with the retail investors.
What would you tell a 35-year-old Dinesh Kharon what his portfolio should look like?
No, I would say that he should keep his portfolio diversified. Equity, of course, he should keep, but nevertheless, bonds also, and also bank deposits. Because bank deposit is essentially the most liquid, though it offers lower return. But again, when it comes to if at all he can earmark his cash flow very clearly that he needs something after 5 years, maybe part of it can be equity, part of it can be debt. And then, in fact, he should evaluate his overall portfolio yield, including equity, bond, and deposits.
back. You're watching Trading Hour. Let's go across to Manglam Malu, who will get us the latest trends from the F&O space and what the cues there are telling us. Manglam.
Well, the market's doing well, Ritu, at least in the IT pack, and that's exactly what we're seeing as well. It's a bit of a tug-of-war that is going on between the Nifty Bank and the IT pack. As you can see, the Nifty Bank down about 20 points, the IT index higher by about 0.75%. That's Reliance. We're talking about the IT pack, so that's the one that should come up for you, up 3.5% right now as we speak. And we have the large cap IT names. So you have HCLTech, TCS, TechM, Infosys, Wipro, all of them bolstering the Nifty and the index ahead. And alongside that, the mid caps, don't lose sight of that as well. Even though at an advanced decline level, we have way more number of stocks advancing. These advancers actually belong a lot more to the IT pack. So we have LTM, Coforge, Persistent, Birlasoft. So among the top F&O gainers, 5 or 6 belong to the mid cap IT pack itself. The IT index, after today's gain, has actually crossed the 20-day moving average, and it's gone past the 31,005 mark, and that will be an important support to track on the way down for this index as well. So that's a level that we're tracking. But it's the the technicals that even the option writers are tracking on the Nifty. So 24,100 puts extremely active, 24,150 puts equally active, and you have the 24,200 call active as well. So the rough range that the street is working with is supply around that 24,250 to 24,300 mark, and demand around 24,000 itself, and which ties in with the 50-day moving average and the 100-day moving average on the Nifty. The only problem right now is that the Nifty Bank, which is underperforming, is fallen below an important support zone of both the 50 and the 20-day moving average between 57,630 and 57,635. So crossing and closing above that will be extremely crucial to track for the Nifty Bank. With that, we'll take a short break, come back on the other side. We have market fundamentals with Srinivas Rao Raburi from Bajaj Life Insurance. Welcome back. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. Just keeping an eye out on a couple of these stocks which are buzzing around right now. Apart from the IT pack, we do have a bunch of them. Fortis Healthcare, for one, has actually moved to the high point of trade. We are seeing some traction on Angel One as well as 361 VAM as well. So a lot of these capital market plays are doing extremely well too. But it is the IT pack which is surging, and mid-cap IT in that in particular. Cyient, Tata Tech, Birlasoft, all of them at the high point. Srinivas Rao Ravuri from Bajaj Life Insurance joins us now to discuss market fundamentals, his top sectoral picks. Srinivas, let's talk about the IT pack itself. I mean, overnight there was a big surge that we saw on Salesforce in the US, and that's largely because the collaboration that they did with Anthropic on announcing a new platform called Claude Force, where they've merged the Salesforce data into the Claude user interface. It's a bit of a win-win deal, but you're basically collaborating as against competing. So that's something that the street likes. Do you think Indian IT stocks can also find a similar middle ground with the AI stocks and have a bit of a play out there as against the narrative, which is that they will at some point get entirely disrupted?
Yes, first of all, thanks for having me on your show, Mangalam. I'm also in the camp that there will be an opportunity for Indian IT companies to benefit from what is happening, what you just discussed. See, Mangalam, please realize individuals can just adopt AI and use and be happy with whatever AI is giving them. But when it comes to corporates adopting AI, it can't be done that way. I think that's what I was seeing the survey done by Gallup in US. So only 8% of corporates are saying they're actually seeing benefit from AI as of now versus 65% by individuals, which in turn means they need another company, whether it is Indian IT companies, whether it is US IT companies, to integrate AI into their system. First, to make sure that the security aspect is taken care. I'm sure we are all reading what is happening in terms of AI hacking into systems. So you need to take care of that aspect. And second is to make sure that whatever data you are generating is verifiable. So to that extent, someone has to do that integration, coordination, AI and your existing enterprise system. So yes, it's not looking like a doomsday. I remember we were discussing this on last time also when I was there. So there seems to be a given where Indian IT companies are trading today in terms of 1 year forward earnings and dividend yield versus the broader market. And this convergence or this realization that only few AI companies are not going to take over everything is a positive sign for IT companies. Does it mean that suddenly now the coding jobs will not go? No, I think coding jobs will see a problem, but not bad for the entire IT industry is what I would say.
So, Mr. Ravuri, if you were to put your money where your mouth is within this IT pack, if it's not a doomsday scenario, where would you hedge your bets? Is it the large cap names that look attractive? Is it the mid cap names? Where do you see more opportunity?
Ritu, if you look at the mid-cap space is where I'm saying you start saying not just in IT anywhere. In a mid-cap company, you identify a new trend, you start investing on it, and you can see tangible benefits in the near term. For example, I think if I'm looking at the top 3 IT companies and whatever number they've given in terms of last quarter, their share from AI related, it is anywhere from 3% to 6%. So even if they invest big time, move very fast, for them to see that AI has a positive impact versus the deflationary effect that is having on the core business would be less. Whereas for mid-cap IT companies, I'm sure they can move faster and can also see tangible impact on their top line from AI related. So to that extent, any company which is doing more to make sure that they are relevant and do more on the AI side will benefit, and mid-cap would be a better play in that.
All right, take that point. The markets, off the highs right now. We have the Nifty holding on to gains of just 25 points. We've seen the mid-cap index as well pair a lot of its gains. The Nifty Bank is down by about 80 points. As you can see, 150 points off highs to the Nifty Bank, which has already been underperforming. But for the Nifty, it's over 200 points in terms of its decline from the highs. The latest entrant in the list of decliners is the auto pack. So the intraday chart of the Nifty auto index comes up for you. That's actually seen a cut of nearly, 0.75% from the top, and it's currently at the low point. We have M&M, and alongside that, we have Maruti, all of them actually currently at the low point as well. Srinivas, since we're speaking about, investable opportunities, one of the bigger beneficiaries of the GST rate cut was the auto pack, and a lot of these incumbents also turning into EVs. So, be it the auto stocks, auto ancillaries, all of them have actually been on a bit of a tear over the last 5 to 6 months. Do you think a lot of the upside has been priced in, or do you think going forward there is a lot more still to be captured because of the underpenetrated nature of this sector?
Mangalam, there is more to the auto story or the consumer discretionary space in the coming months and quarters. It's been a big change. If you see, Mangalam, the first quarter result that are out, we were all expecting there'll be margin impact, there'll be impact on top line, but overall corporate India has done so much better than expected. Within that, consumer discretionary, including autos, have done extremely well. And when we are talking to people on ground, even today, the demand seems to be fairly strong. And we are getting into, in the next 12 to 18 months, we will see more talk about this pay commission data coming in. The number that I'm hearing is the total impact on the economy can be anywhere from 3 lakh crore to 4 lakh crores, whereas the GST impact was about 80,000 crores. So the real impact on discretionary can be much more. I'm not saying it is going to happen next quarter, but the moment market has a visibility that this is what is going to happen in the next 1-2 years, people will start factoring in. I think that is what is happening. And for most people now, owning a car has become a necessity. I think it may not be good for environment, but it is very good for companies which are in that business. Mangalam, I just also wanted to make one point on this AI we were talking. We were seeing the NVIDIA numbers last quarter, $60 billion of profit. Entire Nifty 500 reported PAT was $45 billion. Nifty 50 was only 25 billion, but Nifty 500. So one company is making more profit than Nifty 500 companies. So it sounds great, but how sustainable is this is also a question that we should be thinking about.
All right. Interesting comments there, Mr. Ravuri. Out of time, but pleasure having you here. And thanks very much for sharing your views. We'll slip into a short break on that note. But up next, we're going to be discussing the Z founder and promoter Subhash Chandra's personal guarantee case. And we'll also be joined by Anup Rawat and of Shardul Amarchand Mangaldas and Ashwin Parekh of Ashwin Parekh Advisory Services. For more on that story, stay tuned.
Welcome back. The Nifty holding on to gains with just 12 odd points below 24,100 intraday, now holding around those levels itself. But Z founder and promoter Subhash Chandra's personal guarantee case is back in focus with fresh disputes over claim amounts and his net worth. Remember, the NCLT earlier this week had approved a repayment plan for Subhash Chandra and his personal insolvency proceedings, which at about 6.5 crore will be paid against admitted claims of roughly over 22,000 crore rupees. That's near 99.97% haircut for lenders. However, Subhash Chandra has now issued a statement on the matter to put across his point of view. Ritu gets us more details of his point and thereafter a conversation with experts as well.
Well, thanks very much, Mangalam. Yes, you have, Subhash Chandra issuing this statement to push back on that narrative of a near total bank haircut in his personal insolvency case before the NCLT. The statement firstly clarifies that he never personally borrowed money from any lender and that the case relates purely to the personal guarantees that he had given for loans to SL Group companies. Now, of the roughly 22,000 crore rupees in total guarantees that were signed, his statement says only 3,992 crore rupees is being actively contested by objecting lenders, not the full amount. Now, of that, he claims about 620 crore rupees has already been settled. That leaves a balance of 3,372 crore rupees, with the borrower entities even offering a further 1,063 crore rupees in settlement. Separately, the statement says the underlying borrowing companies have repaid close to 43,000 crore rupees of about 45,000 crores that they owed since the 2019 default, and they've committed to also settling whatever's left over. Now, on the contested net worth figure of 45,888 crore rupees, which is cited by the lenders as sharply then falling to about 31 odd crores, Subhash Chandra says that the number reflected the market capitalization of all the SL Group companies, and that was compiled by a third-party junior officer, he said. His personal net worth, he said, has fallen from 39 crores in 2016, a figure that he had disclosed to the parliament, to about 31.79 crore rupees now, and that includes a residential property worth close to 25 crores. Now, that, he says, is the basis for the roughly 6.5 crore rupee repayment plan that has now been approved by more than 80% of the voting creditors. So, just to clarify for our viewers, the statement stresses that he personally did not borrow money. It's actually, the case has always been about the personal guarantees that he gave for other loans. And it's the guarantee liability itself, of course, now that the lenders are contesting. So let's do one thing. Let's bring in, some experts to decode this statement and some of the repercussions of this. We're now joined by Anup Rawat, who's the National Practice Head, Restructuring and Insolvency at Shardul Amarchand Mangaldas, and Ashwin Parekh, the Managing Partner at Ashwin Parekh Advisory Services. Gentlemen, thanks very much for your time here. And, Mr. Parekh, just to start with you, this, the bone of contention in this statement by Subhash Chandra, that don't look at the denominator as 22,000 crore rupees in guarantee, look at the denominator as 3,992 crore rupees from the objecting lenders alone. Is that the right way to look at it? I mean, the fact that lenders would have recovered some of this principal amount, does it absolve him of these personal guarantees?
Well, I mean, it's an explanation that he has rendered, of course. I mean, let's start with that. And I mean, how much of that could be acceptable? I mean, we have to really go into the documents where he's actually offered personal guarantee. But if they do amount to 22,000 crores, I mean, he's not the borrower. I mean, he's very clearly indicated that he's not the borrower. He has just guaranteed that. And we're talking about the insolvency of his individual. That is his personal insolvency matter. So to that extent, I mean, say his explanation, he's made an explanation. I mean, we'll have to examine how much of that explanation is valid. However, the larger subject still remains that the lenders have lost, a substantial amount. I mean, 99.95% haircut is a huge haircut, quite honestly. And now, whether you blame the lenders, they kept quiet. I mean, it all started with Sony and then Z merger failure. And then the bulk of the value that we are talking about of 45,000 crore of market cap was actually from the entertainment business, which is a different entity, which are different corporate entities. And I mean, whatever Mr. Chandra going ahead, I mean, he is sort of, I mean, with the lenders kind of authority sold one stake already earlier, and now it comes down to only this amount, basically. So in some form, the lenders also have really not been able to really carefully examine that the underlying value has actually got significantly lost on account of that merger failure, basically, So, I mean, now the explanation is his explanation, Ritu. I think it is his own explanation. I think the way to look at it is there's still loss to be accounted for of 22,000 crores, basically.
Absolutely. And Anup, come in on that. Legally speaking, as I was asking Mr. Parekh, does it absolve Mr. Subhash Chandra of his personal guarantees? I mean, like Mr. Parekh was explaining, this is perhaps his own explanation, but the fact of the matter is guarantees still amount to about 22,000 crores of claims.
Yeah, Ritu, that is right. But, I think let us look at it from a different perspective. Okay. First of all, I must say that the Insolvency and Bankruptcy Code is intended to sort of, give a fresh start and look at the economic value of whatever is, whatever has been committed. Now, if the corporate debtor, who is the underlying borrower, has a particular value, that's as much you can derive from the insolvency process. And the same is true even for the personal guarantor. But I'm not looking at it from a perspective of, how much haircut and, how much is offered for payment. I think it's a much larger issue of process sanctity. I think there are serious issues raised on how the resolution professional admitted certain of these claims. And, how despite, some of the objections that were there, no in-depth analysis was done. That's more worrying for me, actually. You see, once the process sanctity is established, after that, whatever is the residual value, I think one has to accept. But there are serious issues, how the bankers and the financial institutions were completely ignored, and they're, pleased to, consider the related parties, associate companies, those were, completely ignored resolution professional. I think those are more worrying things than the amount according to me.
But where, Anup, you've gone through the NCLT order. Where do you find, that the sanctity of the process was not held up? I mean, on one hand, you have these lenders claiming that the net worth has suddenly disappeared from 45,800 odd crores to 31 crore rupees now. And they also claim that 62% of the voting share was controlled by entities that are indirectly or directly related to Mr. Subhash Chandra. Whereas, Mr. Subhash Chandra's argument, of course, has been that this was done in a manner that has been approved by more than 80% of the lenders. So, the due process has been followed. But where, to your mind, have been some of the loopholes that you see in this order, which will provide some sort of, backing for these dissenting lenders to go and contest the case in a higher court?
What I feel is that the manner in which certain conclusions were drawn, perhaps there could have been much more in-depth analysis around that. You see, when you talked about some of these corporate entities who have lent or sort of who have the benefit of these guarantees, ordinarily the way in which the personal guarantor comes into picture is that when the banks and financial institutions have lent, and then the guarantees have been extended. In this particular case, the guarantees being extended to some of the alleged associate entities is something perhaps would require some kind of an in-depth analysis, which was perhaps missing in this particular case. Ideally, the resolution professional, knowing the serious allegations around this whole issue, perhaps could have engaged some kind of a forensic analysis of how these things should be examined. So therefore, I think again I'll come back to the same issue that it's not about how much amount is being written off. I think it's always about the process sanctity, and the technical member in this particular case did differ from the judicial member, and it did say that there were sort of grounds to sort of look at it in a much more careful manner. The conclusion that these entities, the corporate entities, the beneficiary of the huge personal guarantees, does raise one question as to whether proper analysis have been done or not. I think these are the basis on which the creditors are also now saying that they would like to challenge this particular order.
No, absolutely. The establishing the liability, I think that has been the big point. But Mr. Ashwin Parekh, a quick word on the kind of precedent now this sets. And I'm asking because there are several live cases right now, whether there is, the Vadhavans, whether that is Anil Ambani, whether that is, the Bhushan promoters and so on and so forth. Does this set a precedent that historically you may have had a huge personal guarantee, but if you can prove that your current net worth is far lower, a fraction of that, could something like this be used to get away with paying a pittance?
No, so I'll tell you, when collaterals and guarantees are examined, the security and the guarantees are examined by the lenders. They also have to really worry about the underlying assets on the strength of which these guarantees are offered. Now, we can't have a situation where you go out and create, let's say, a loan book of the extent that we're talking about, and then suddenly find that the value of underlying that the person possessed, who's offered those personal guarantees, is only about 31 crores. And out of that also, there is this home, there's this house, which is 25 crores. So the balance of 6.25 crores is only available for the lenders. So that is certainly a flaw in fact, on the part of lenders as well, to see whether there was enough underlying available with the person who was guaranteeing that, even in his personal capacity, basically,
Yeah. Well, gentlemen, thanks very much. That was most helpful, but we've run out of time here, so we'll thank both of you, Anup and, Ashwin Parekh, for joining here and helping us go through this important case. On that note, we'll slip into a short break, but when we return, we'll get you more on the markets and macros.
Well, the Nifty is below the 24,100 mark. In fact, just flirting with that level as we speak, flirting between the red and green lines as well. We have the Sensex, which is lower too, alongside broader markets. If you look at the advanced decline, you'll see, almost as many number of stocks declining as the number of stocks advancing. And that number was skewed in favor of advances just 30 minutes ago, where we had 1,800 stocks advancing for about 1,300 stocks, and those lines are on the verge of kissing each other. We've spoken about, how the auto stocks are lower. Look at TVS Motors. Earlier in the day, they announced their leadership transition as well, where they will have a new CEO take over from Jan 27th. And you have that stock which is currently at the low point of trade. Some of the real estate names as well, the ones which were doing well yesterday, are now coming in for a bit of selling, an aggressive one at that as well. We have Prestige Estates at the low point of trade. We have Godrej Properties at the low point of trade. And we have Z Entertainment as well, which has moved lower alongside some of the other pharmaceutical names like Biocon and Jubilant Food. So a bunch of stocks now coming in for some selling. Looks like it is getting a little aggressive. The second half extremely crucial. But let's move away from the micro of the stock market and talk about the macro. Ritu joins in with the macro signal of the day. Ritu.
Well, let's as always start with the crude prices. They're falling today and they're on track for a weekly loss as well, driven by what's happening in West Asia. Brent crude prices have slipped around 0.5% to about $89 a barrel. That puts it on track for a near 5% decline this week, or perhaps even more. The rupee has been largely stable today. It's trading in a very tight and a narrow range-bound territory against the dollar. The rupee opened at about 95.51 before it consolidated, and now we're at around 95.56 against the dollar. So very marginal movement there. And finally, the 10-year GSEC yields, that's hovering around 6.81% or so, again, has been in a tight, narrow range. So that's the macro setup. And with that, Mangalam, we run out of time in this edition of Trading Hour.
Indeed, we have. And what we'll do is thank our viewers for watching, and at the same time ask them to stay on, because on the other side of the short break is the team of HTR, or Halftime Report, taking all the market action forward as the Nifty has just about moved into the red.
Stocks gain on some efforts as mediation between US and Iran continues. The Sensex, however, gains more than the Nifty after big divergence in closing levels following the wildcast session yesterday.
The closing auction session on BSE's F&O expiry day on Thursday saw the BSE Sensex plunge 2,000 points during the session, prompting market players to call it a lottery. SEBI chair Tuhin Kantapande, however, stood firm, saying gas will run as it is, adding that liquidity will improve.
And Hero MotoCorp revs up in its stake in Ather Energy to 32.8% from 29.88% with an investment of rupees 1,758 crores. This after a rupee 1,000 crore investment to up its stake by 1% last month is enough to fire up Ather Energy stock in trade as well.
Vodafone Idea chairman Kumar Mangalam Birla says after several challenges, the foundation has been laid for the telco to deliver and create value. He adds that FY27 will be a year of execution and there are many reasons to be optimistic. Hello and welcome to Halftime Report live from the CNBC TV 18 Motilal Oswal studio. I'm Ekta Batra and with me is Vinny Motiwala. Well, it is turning out to be a day where it is quite subdued at this point in time in terms of the markets. Remember that it is also a holiday for many companies and corporate offices today on account of Rakhi. So maybe there is a little bit of subdued trading on account of that. So we have the Nifty, which is just about flat. We have the mid-cap index, which is about flat as well, along with the Nifty, along with the Bank Nifty, which is marginally lower, down around 0.2% at this point.
Hi, Ekta. Good afternoon. So a bit of a muted day right now coming in for the markets. IT, obviously, that's the only one that's managing to hold on to very, very strong gains at the trading session as well. Globally, obviously, Nvidia's numbers. You had Salesforce that came in there as well. So commentaries coming in there is something that is keeping the stocks abuzz. Apart from that, when you look at it in terms of overall stocks that we've seen a move, specifically Tejas Networks, Ather Energy, we'll break up all of that for you all as well through the show as well. But first up, let's go across to Vivek, who is here to tell us which are the other stocks, which are the stocks he's watching out for in trade as well today. Vivek, good afternoon. Over to you.
Well, thank you so much for that. Especially in the last half hour of the trading session, we've seen an accelerated sell-off emerge, especially as far as the broad end of the markets are concerned. And especially in some of the heavyweight Nifty names, you're seeing quite a bit of selling pressure emerge. So that's ensured that the advanced decline ratio is quite weak. But in terms of what's actually doing quite well, have a look at the entire IT pack. Very strong numbers coming in from Nvidia, growth guidance of 70%. And Salesforce, more tied up with what Indian IT does, surged almost 22% overnight in NASDAQ last night. On the back of that, the entire IT pack today has taken positive cues. LTM, the top mid-cap IT gainer in the session today. Tejas Networks, large LOI that the company has signed with TCS is something that's ensured that this particular stock is higher by almost 9%. Great Eastern Shipping, after a while, a large buyback has been announced by the company. So that particular stock cooled off a little bit, but still higher by close to 2%. Fortis Healthcare, some positive commentary coming in from the company's parent IHS. They're talking about a creeping acquisition that they could do up to 5% annually to raise just take up to 51%. That stock higher by close to 2% today. And Tencent's Instruments, especially as far as the IPO market is concerned or a new listing is concerned, that particular stock at one point of time actually doubled investors' money on listing day itself. On the other hand, quite a few stocks seeing quite a bit of selling pressure emerge. Take a look at TVS Motors. There's been an announcement as far as the CEO change is concerned, effective Jan 2027. But despite that, the stock is taking out as a chin almost 4.5% lower. Whirlpool, this stock is the top small cap laggard in the session. ICICI Lombard from the insurance pack clearly underperforming in today's trading session.
Okay, all right, Vivek, thanks very much for that. So the lot of stocks are buzzing in today's trading session. In fact, let's narrow down on them. This is our movers and shakers segment where we track a whole host of stocks which are buzzing in trade. And we have Rima joining in on Just Dial first. Rima, over to you.
Thanks so much for that. So for Just Dial, the story, as you rightly said, is a Kotak institutional equity note, which is betting on the new CEO. Remember, the founder and CEO, Chairman BVS Mani, stepped down earlier this year, and the new CEO, Dinkar, has taken charge. Kotak's target price is 1,175, which is a steep upside from the current level. Basically, Kotak says the new CEO is looking to revive growth. the focus will be on paid subscribers. Now, the company today has 56 million listings, but only 10% of them are actually paying subscribers. So they want to bridge that gap. The second avenue of growth is focused, as I said, paid campaigns is one, new products, and even B2B merchant onboarding. So right now, when you think of Just Dial, you think of a B2C kind of a platform. We all call Just Dial to get access to a plumber or a salon close by. But the B2B is only 10% of the company's merchant base. So here also the company has a runway. And that Kotak believes will help the company revive the collections. So last year collections were very muted, less than 2%. In Q1, we've already seen a pickup, 17% or 14% Q1 pickup in collections. But the management focus should be on getting back to double-digit collections growth. But the big question for Just Dial is really the cash on the books, because the market capitalization is 6,000 crore rupees. The cash on the books is also 6,000 crore rupees. But Kotak's view is that as of now, at least the new CEO is not going to take a decision on whether the cash needs to be returned to the shareholders. If it does happen, that will be an additional trigger.
Okay, all right, Reema, thanks very much for that. So that's on Just Dial. But I'm looking at Metropolis, which is in focus on account of the analyst meet that took place by the company. So some important takeaways where for FY27, they've said that the revenue growth would be around 14 to 15%. So they've reiterated that, along with 100 to 150 basis points margin improvement, which is guided as per the management. Overall, for a longer term, they're expecting around a 300 basis points EBITDA margin expansion all the way from FY26 to FY29. In terms of growth targets for B2C, which is business to consumer, they have 1,000 owned stores by FY29. That's what they're targeting, which should go beyond pathology. We should probably look at vitals, diet and consults. True Health, which is their preventive testing arm, is currently around 25% in terms of revenue, and this is versus 18% currently. And B2B, the specialty testing, they are expecting to increase it to 45% versus 40% currently. Remember, it's all 17% growth in Q1. Inorganic additions are a strong part of their 3-year growth plan, so that's something that Metropolis is also guiding for. But that's on that particular counter, which is holding up with a gain of around 3-odd%. We have Sudarshan joining in on TVS Motors, which is slipped in trade. Sudarshan, over to you on that.
So you want to watch the impact of a leadership change. You can see the stock price fall that we are currently seeing in TVS Motor. The stock is currently down more than 4%. It's because the company has appointed that K.N. Radhakrishnan, who was at the helm since 2008, will be leaving, and new CEO has been appointed, and he is Payman Kargar, who is appointed new director and CEO effective January 27 to 2027. Now, currently, he serves as president of international business. Now, because of K.N. Radhakrishnan, who has been at the helm for the last 18 years, leaving the company, he has made a major transition in the company. In 2008, TVS Motor used to be just a domestic player. Now, he has taken company to international business, and now currently international business forms almost 30% if you talk about the total volumes. And each and every quarter, company has been performing. And just since 2008, if you take a look at the revenue, profit, at every place, it's more than 100x returns that company has given. So because of him leaving the company, you are seeing a knee-jerk reaction, and that's the reason stock is under pressure.
Okay, stock is down 4%. Thank you so much for explaining us that, Sudarshan. But now sources are saying that Tirumala Chemical is looking to raise around 400 to 500 crores. This is via preferential issue and sale of non-core assets. Yash is joining us, so take us through the details of this one. Yash, what are you picking up here?
Well, interesting fundraising developments happening at Tirumala Chemicals, according to our sources. What we've been given to understand is that the company is looking to raise anywhere between 400 to 500 crore, and this amount is likely to be raised through 2 ways. One is a preferential issue that is expected to be made towards a new investor coming into the company, and part of it is through sale of a few non-core assets. As I said, preferential issue, the the size of that is expected to be around 200 to 250 crore rupees. This is the information which is given to us by our sources. Also, as far as the second part is concerned, in terms of sale of non-core assets, the first thing that the company is considering is a sale of its investments as far as its step-down wholly owned subsidiary is concerned, which is called OOSB. The company expects to raise anywhere between 100 to 150 crore as far as a sale of those investments in OOSB is concerned. Another area which they're looking at as far as sale of non-core assets is concerned is some stake monetization when it comes to ultramarine and pigments. This is also a listed company where Thirumalai Chemical holds about 14.38% directly as the company shareholding, and a part of it could be sold or could be considered to be sold to raise about 120 crore rupees out of that particular investment. We had written to Thirumalai Chemicals on this particular development. The company has said that it is in the middle of a major investment cycle. The company has counted the various areas where it's making new investments in terms of fresh production. Also confirming our story, the company has said that it is working on raising capital through the most effective means.
Okay, all right, Yash, thanks very much for that. So that's on Thirumalai. We'll take a short break on that note, but we're going to focus on the hospital space, and we're going to talk about Manipal Health as the company has crossed the 1 lakh crore market capitalization since listing just earlier this month. We'll be back with more on that.
Welcome back to Halftime Report on CNBC TV 18. Nifty not seeing any sort of a recovery, still near the day's lowest point, 24,080. Around that mark what the Nifty is trading at. But let's keep it going with some of the individual names that one should focus on. Today we have Vodafone Idea also that one should put the spotlight on. Kumar Mangalam Birla during the Vodafone Idea's 31st AGM said that FY27 will be a year of execution for Vodafone Idea. Let's get more details on this one, and we have Reema joining us to take us through that. Reema, over to you.
Thanks so much for that. So I think the key headline from Kumar Mangalam Birla at yesterday's Vodafone Idea AGM is FY27 is going to be the year of execution and delivery. You know, the last couple of years, the AGM, so the investor perception about Vodafone Idea was always about an existential crisis, the company being in a survival mode. But now it looks like the foundation is shifted and the focus is now on capitalizing growth and getting into the execution mindset. The reason is why things are different this time is many of the legacy issues have been addressed. Now, one concern plaguing Vodafone Idea is that they kept losing subscribers ever since the merger in 2018. Q1 FY27 was the first quarter when the company reported positive subscriber growth. That's one. The second issue for Vodafone Idea used to be the large debt, the AGR dues. Now the moratorium gives the company leeway till 2035, which means for 9 years, the cash is conserved. They don't have to make payouts related to the AGR dues for the next 9 years. So that's enough runway. And also in terms of the funding, you know, but now you've got the promoters infusing money via warrants. So that's put in confidence capital. And the company said that they're actively seeking bank debt funding of 35,000 crore rupees. Also, it's not just stock. Right, you are actually seeing signs of the company making investments. Now, earlier this year, the company said that they're planning to invest 45,000 crore rupees in terms of investments, infrastructure upgrades in the next 3 years. Now, of that, 9,000 crore yesterday, Kumar Mangalam Birla said at the AGM, equipment orders have already been placed on it. And finally, on that big issue about tariff, Kumar Mangalam Birla did use the platform of AGM to talk about how there is a case for ARPUs to go up. ARPUs for Vodafone Idea are closer to 190, but he said periodic tariff rationalization is essential for the industry. And finally, I think the bottom line is where we went back to at the beginning. This is going to be a year of execution and delivery. He says that Vodafone Idea is in a better position than it has been in the recent years, and there is a reason to be optimistic.
Reema, thank you so much for that. Now, moving on from telecom to back to healthcare, back to pharma side. Manipal Health, that has crossed the 1 lakh crore market cap milestone, Ekta, and now has become the second largest hospital after Apollo. Take us through the details, and that was just recent everything time.
Well, yes, definitely. You know, this is quite a milestone for Manipal, considering that it listed just at the start of this month. So just to take you through the market cap, the updated market cap for Manipal is basically now it's crossed 1 lakh crore. Remember that at the time of listing, it was around 77,000 crores based on the issue price for Manipal. So that's definitely scaled up. Now, in terms of the overall, other companies with market cap similar, we do have Manipal at around 1 lakh crore. Apollo Hospital is the one which is above 1 lakh crore, so it's higher than Manipal. Fortis is at around 69,000 crores, and the others are on your list. Now, in terms of, a couple of key details with regards to Manipal, I just want to take you through the numbers. The numbers this quarter look strong, so they released it just a couple of days ago. On listing itself, the stock and rally is up around 36% since listing. And if you look at it in terms of the revenue which they reported recently, that supported the kind of growth or the upside that it's seen since listing. So revenue was up around 38% on a year-on-year basis. Margins expanded to around 23.8%, but it was still lower on both a Q-on-Q as well as on a year-on-year basis. And the profit was down around 4.2% on a year-on-year basis. The operating margin ex-Ayadri, this is something that they've been talking about, was at around 25%. Volumes really led the growth for them. So inpatient volume was up 39%, outpatient volume was up around 26%. Occupancy was at around 65%. 5%. Ex-Sayadri, the average revenue per occupied bed stood at around 77,200 rupees, which was up around 9% year-on-year. Interestingly, HSBC has come out with a report on Manipal where they've initiated with a buy and a target price of 1,000 rupees. They say it's India's biggest private hospital operator. It's set to sharpen its focus on profitability after doubling its bed capacity since FY23. They expect their profit to grow and the net debt to reduce, and the improving EBITDA margins for the acquired Sayadri hospital will be a key catalyst. Now remember that while Manipal has seen a strong upside since the time it listed, it's up around 36%. Like I mentioned, you have to remember that the valuations are quite punchy as well. So Apollo Hospitals is at around 25 times EV to EBITDA on an FY28 basis, Manipal at around 27 times, and the others similarly at anywhere between 26 to 29 times. So that's basically what the valuation chart looks like currently for Manipal. But nonetheless, it's been a swift ride for them since the time they listed.
Absolutely, a swift ride for them since they've listed, and interesting in terms of valuation as well. So watch out for that also versus other hospitals. But on that note, we're going to slip into a very short break. After break, we're going to have Nagraj Shetty of HDFC Securities who will join us to talk to us about his trading strategies.
Welcome back. Well, for the markets, it's consolidating at this point in time, but we do have a couple of these IT stocks which are managing to hold up very firmly in today's trading session. So take your pick. We have TCS, Infosys, Wipro, HCLTech, all of them which are holding up with good gains of anywhere between 2 to 3 odd %. In fact, as you can see, the IT index itself is showing a good strong gain of around 3 odd %. Separately, on the lower side, just watch out for a couple of these private sector banks. So IndusInd Bank, ICICI Bank, both these stocks are sulking in today's trading session. So we're seeing some amount of downside coming in on a couple of these counters. But then good time to get in some trading calls. We have Nagraj Shetty joining in from HDFC Securities to tell us what he's tracking today. Nagraj, over to you. It is a quiet day, but a lot of stocks in focus. What's your call?
Hi, good afternoon. Thank you for having me. Nifty has been in a consolidation phase over the last few sessions. Nothing has happened, just a range-bound action. And Nifty is nearing the important support of around 24,000 to 23,900 levels. Chartically, it doesn't look very great at this point of time. And I'm expecting an upside bounce from the lower levels, from the lower support of around 24,000 and 23,900 levels. That's for Nifty. And I have two stocks from alongside and the strategy. First one is from a pharma fund. That is Wakard Pharma. Chartically, this stock has been in a larger consolidation phase over the last couple of months and currently placed at the edge of breaking above the important resistance somewhere around 2020-2030 levels. Currently trading around 2014. One can look to buy at current market. The immediate target would be around 2120 levels and one can place a stop loss at 1960. Second one is Tata Tech. Tata Tech was in a consolidation phase, minor downward correction from the higher levels over the last couple of weeks, bounced back very well from the lower levels, somewhere around 800 levels after forming a higher bottom. The chart pattern is looking positive. One can look to buy at current market, which is trading around 824 levels currently, and the immediate target would be around 865. One can place a stop loss at 800.
Okay, those are your bets there, but Nagraj, good afternoon. Do you have any thoughts coming in on Newgen also, because this one is not stopping in terms of an up move. Today also, again, we are seeing a run up and with good volume. So what are you watching out for here?
Yeah, Newgen Technology practically looking very positive. After a range bound action, it has bounced back very well in today's session. The chart pattern is looking positive for Newgen. I'm expecting more upside. Probably around 600 is going to be the next hurdles to be watched in the near term.
Okay, all right. So Newgen is one of them that you're looking at. Vodafone, do you have a call on that one in terms of technicals?
Not so that great, actually. Currently showing some consolidation. I'm expecting some more consolidation or a minor downward correction is likely in the short term.
Okay, Nagraj, thank you so much as always for joining us on the show, speaking to us about the levels to watch out for in terms of the market as well as individual stock names. But on that note, we're going to step into a very short break. After the break, we'll have Manisha Gupta who will join us and she will be taking us through a conversation with Viral Shah of 361 on a whole host of commodities. Stay tuned in.
Welcome back. And joining us on the show now is Viral Shah. He's president and head brokerage 361. Viral, hi, thank you so much for joining in. And August clearly belongs to commodities in a big sense because almost everything seems to be heading for a strong monthly gain. But I do want to talk about the precious metals first, and the festival season in India is just about starting. With the volatile moves that we've seen in gold and silver, with the fact that you have Jackson Hole Symposium today, all eyes onto that one. What are you watching out for, and what's your sense on this category in an asset class?
Yeah, hi, Banisha. Good afternoon, everyone. As you rightly said, it's been a very interesting month. Started off where a little bit of technical bounce has happened in gold and silver from that 4,000 mark for gold in the international markets and about $56, $57 in the case of silver. But as the jobs data from the US indicate a little bit of softness, it resulted in the dollar index correcting a bit, and the surprise announcement by the Treasury Secretary Bennett for bond purchase is what really triggered this 15-20% move that we have seen in both these metals. We have now run into a little bit of a technical selling or a technical selling zone between at about $4,700 to $4,800 for gold and about $70 to $72 for silver. But as you rightly said, all eyes are on Jackson Hole as to what would be the future Fed direction. If the market sentiment starts getting ahead of it, it becomes a difficult issue. But I think at these levels, there is definitely some amount of buying momentum that has come back into the markets.
Would you say you're still bullish on precious metals from here? Would it still be a buy, let's say, for the next 6-8 months?
It is definitely warranting for because of the geopolitical developments that have come through, as well as more so with regards to how the US is approaching the higher bond yields. So if they kind of talk this down and we see a little bit of softness coming through in the bond market, then yes, definitely potentially another 10% move from here, and both these commodities cannot be ruled out.
Viral, how are you also looking at the dollar index? Because much of the gains in many of these dollar-denominated commodities seems to be coming in from that. With all the fundamentals that you just listed, whether it has been about bonds or geopolitics, US debt, do you believe that the dollar index can decline further from here?
Yeah, so I think it has been it's not been able to sustain over the $100 mark for an extended period of time. We have seen interventions coming in the Japanese yen as well. So there is definitely some amount of resistance that the dollar index is finding at about the 100-101 mark. And if at all we move back to about a 97 zone, then definitely there is a leg up for commodities. But having said that, apart from gold and silver, we have seen a phenomenal move that has come into base metals as well, including copper and zinc. And the fundamentals for both really do warrant for a closer look in terms of potential upsides from here as well.
Oh, that exactly was my next question, because in this week we've seen all-time highs yet again in US copper, and zinc, even as we speak, is trading at a more than 4-year highs. When you look at outperformance or when you look at fundamentals from here on, what is your sense on where are these two metals moving?
So I think copper has been in a structural bull trend for almost about a year or so, and obviously with regards to the demand on the AI part of it, the data centers, as well as the electrification requirements that is there across the world, definitely we are seeing fundamentals for copper driving the prices to almost $14,500 on the London Metal Exchange, and from here on it becomes a difficult task to kind of predict the potential upsides. But yes, there is definitely a lot of fundamentals behind this story. With regards to zinc, again, it's a little bit of play more from a fundamental perspective, but also supply side concerns, especially coming in from China, where a certain amount of flooding has driven for lesser amount of production. So, being one of the largest producers of zinc, that is now creating a huge amount of backwardation, a huge drawdown on LME related stocks. And, both these commodities, like I said, are also in huge demand because of this entire AI data center theme. So there is definitely more merit for a potential upside from here till the time the supply kind of catches up with the demand.
And how are you also looking at the crude oil prices? Because while the month of August hasn't been very kind, but we're still holding around that 85, 95 of a range for the crude prices.
Yeah, so I think in the case of crude, the immediate trigger obviously is with regards to what developments happen in West Asia. But having said that, they have climbed down from the heady highs of almost about $90 when it comes to the WTI contract and about $100 when it comes to the Brent. At this point in time, there is definitely some more information that is coming in from the Strait of Hormuz, where the flow of oil has picked up. But having said that, I think we are still at that zone where it's neither a very constructive buy or sell. I think the market is still testing the piece or testing the little bit of developments that are coming into the West Asia. And if the flow improves in terms of more crude and products coming through that particular Strait of Hormuz, then I think potentially another 7-8% correction in energy prices cannot be ruled out.
Well, that's exactly what the market seems to be working with. Viral, would you say that that is exactly what the street seems to be preempting? Because when you look at 2027 going forward, almost every bank is talking about a surplus. And Wall Street banks are actually putting crude prices in 60s and 70s for 2027. Is that what you're looking at in markets already getting baked in?
Yes, I would say to a certain extent, because when you tide over this particular crisis and the geopolitical developments, I think there is enough and more inventory that is likely to hit the markets. And in a trajectory where more supply will start coming in, I would expect that the prices would correct. But having said that, the world has offered a lot of crude through its strategic petroleum reserves. So at some point in time, you will start seeing a build-up on that again. So like many other commodities, although we can look for a tactical play for a 7-8% downside, but it can't be structurally on a negative cycle, because we have kind of used up a lot of strategic petroleum reserves world over. So, most of the developed economies would like to fill that back again.
That point is well taken. So another 7 to 8% downside not ruled out, but not on a structural decline when it comes to the crude oil prices. Well, Viral, thank you so much for joining in. Appreciate your time here at CNBC TV 18. And with that, we will also go for a break. When we come back, we'll talk about the latest moves in cryptocurrencies after this break.
CNBC TV 18 presents Crypto Corner, powered by Binance.
You're watching Crypto Corner, and joining us on the show today, Solana Foundation's Chief Product Officer, Vibhu Norby. Vibhu, hi, thank you so much for joining in. And data shows that Solana settled roughly $650 billion in stablecoin volumes earlier this year, capturing a massive chunk of AI agent payment activity. I want to understand on how much of this transaction is driven by actual retail commerce.
Well, we've seen a huge uplift on what we call agentic commerce. These are people interacting with their Claude or their OpenAI bots and asking them to do things. Recently, we rolled out a product called Pay.sh, which is a way for people to pay for anything with their AI agents. So imagine booking a flight or reserving a table at a restaurant. These are all now possible with stablecoins on Solana.
The real-world asset footprint on Solana has surged anywhere between 800 million to 3 billion. That is the latest number that I have. Which asset classes would you say between treasuries, private credit, or commodities that are driving this?
Yeah, actually, now more than 4 billion as of yesterday. We've seen huge growth. We've been consistently in the top, blockchains on that side. We're kind of seeing everything. I think what's happening in tokenization is pretty interesting. You're seeing treasuries and private credit funds from some of the biggest institutions in the world, all the way down to exotic long-tail assets. We recently had a startup on Solana deploying tokenized dinosaur fossils. We've seen a huge boom in Pokemon cards on chain. So there's a lot happening. It's not just those kind of traditional financial vessels, but we're also seeing many new things on chain.
Well, Pokemon card is something that we could look at as well. But Vibhu, you have frequently stated that Solana aims to be the home of internet capital markets. Where are we on that?
Internet capital markets is an incredible vision for the future of finance. It means anyone, anywhere from their phone can invest in something that inspires them, from a public equity to even a startup or a coffee shop that they visit. We've seen many people building and launching new things within that paradigm. There's been a whole class of, for example, AI startups that are tokenizing and allowing people to participate in the upside of what they're building. Internet capital markets is very much alive. I think it's the natural end state of where everything is headed.
Oh, absolutely. Tokenizing dinosaur fossils to Pokemon cards is something very amazing. Vibhu, how is Solana Foundation helping early stage Web3 protocols scale globally?
So Solana Foundation is we're an ecosystem steward for the Solana blockchain. We're sort of like capital allocators or investors in our ecosystem. And we spend the majority of our time working with smaller companies and startups. We have communities all over the world. We have an organization called Super Team, which has chapters in 29 countries, including India, Australia, and UAE, and so on. And here we have thousands of startup founders who are building together. They're getting capital through grants and venture. I think we've seen over $8 billion of venture capital raised within our Solana startups. And we help with distribution. We help them find people to buy their assets. We help get the word out. That's something that the foundation really does well.
India has one of the largest Web3 developer pools in the world. What specific localized grant programs or regulatory sandboxes are you deploying to capture the Indian tech talent?
Yeah, that's a great question. So India is a huge part of our talent base. We have many founders located all over India. In fact, Super Team, which was founded in India as a way for folks that maybe have struggled to access global markets, giving them the keys to success there. So yeah, we've been, I think our India community must be over 1,000 entrepreneurs strong today. And there we're providing funding. It's the most important thing. And, these days with AI, you can build anything. Anyone can kind of build anything and get it out there. So it's not just about funding; it's also about finding a global audience. And Solana really accelerates the trajectory of these companies by putting them all over the world. We distribute them into applications where people can find their products. We feature them all over our social media accounts, which have millions of followers, and we help them source content creators to kind of spread the message. So we really do take it seriously to take your startup wherever it is in the world and put it on a global stage.
I have one final question, Vibhu, and then how can Solana's tokenization rails bridge the gap for Indian entrepreneurs seeking offshore private credit without breaking local compliance rules?
Well, this is the beautiful thing about crypto networks. They're global. They are what we call permissionless. As long as you can get money into crypto in the form of a stable coin, you have access to global capital markets now by default. And those markets are really liquid today. You can access borrow-lend markets. You can access those private credit via vessels or treasuries. You can access fixed yield now. I think the story of crypto is really about making finance truly global and borderless, and Solana is really number one there.
Okay, Vibhu, thank you so much for joining us on the show, and Manisha, thank you so much for taking us through the conversation on cryptocurrency side as well. Thanks so much for that. On that note, let's take a quick check in terms of what the market has done. As of now, the Nifty is back to the green again. Slight bit of a positive bias, 24,100. About that mark is now what the Nifty is trading at. Is this going to continue through the day in terms of a recovery? That's something we have to watch out for. But as of now, at least it's come back to the green side. IT continues to see further more of an up move as well. 3% uptick more now for the Nifty IT. So let's watch out for that one, and IT names continue to see a strong up move in the trading session. Just a couple of names that I would like to highlight. In the last hour or so, we've seen Nugent Software. That's seen a sharp spike up as well from the day's low, or we've seen a good move coming in. 3% uptick there for Nugent Software as well. So watch out for that one, as well as TBO Tech. But on that note, we're going to step into a very short break. We'll come back after the break and more in terms of markets. Stay tuned in.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Welcome back to Halftime Report on CNBC TV 18. Nifty, like I said just before going into break, right, 24,100, above that mark is what the Nifty is trading at. But let's also take a look at what the broader end of the market is doing, the Nifty mid-cap and the small cap. While mid-cap seems to be flip-flopping between the red and the green right now in the last hour specifically, again, it's seen a bit of a decline. We'll watch out for where that's going to be headed. Small cap, though, comfortably managing to hold on to that green, 0.2% of gain. But the advance decline ratio, let's look at that. That's more in the favor of advances today versus declines. Almost on the NSE 1,600 stocks are managing to hold on to that advance side versus declines. As of now in the trading session, 1,500 stocks on the decline side. Now again, whether we see a crisscross will be key to watch out for, and how the broader end of the market keeps moving. But as of now, this is how the markets are looking like, and specifically stocks like Aether Energy, we have PTC Industries, Capri Global, NMDC Steel, all of them are managing to hold on to gains, and IT leading the charts for the day, and seems like IT will be going home with very strong gains even for the week as well, more than 2% gains if this continues throughout the next couple of hours of trade. Apart from that, for the week also we'll see metals and pharma maybe that could go home with gains. Apart from that, most of them are going to be in the red. But yes, that's how the shape up is looking like in terms of markets. You can see the contributors coming in for the Nifty 50 on your screen. But with that, we are absolutely out of time on this edition of Halftime Report. Thank you so much for tuning in. Up next to Business Lunch.
Stocks gain but give up some ground even as efforts at mediation between the US and Iran continue. The Sensex, however, gains more than the Nifty after a big divergence in closing levels following a wild cash session on Thursday. The closing auction session on BSE's F&O expiry day on Thursday saw the BSE Sensex plunge 2,000 points during the session, prompting market players to call it a lottery. SEBI Chair Tuin Kanta Pandey, however, stood firm, saying cash will run as it is, adding that liquidity will improve. Hero MotoCorp revs up its stake in Ather Energy to 32.8% from 29.88% with an investment of 1,758 crore rupees. This, after a 1,000 crore rupee investment to up its stake by 1% last month, is enough to fire up the Ather Energy stock. Vodafone Idea Chairman Kumar Mangalam Birla says after several challenges, the foundation has been laid for the telco to deliver and create value. He adds that FY27 will be a year of execution and there are many reasons to be optimistic. Hello and welcome to Business Lunch, live from the CNBC TV18 Motilal Oswal studio. I'm Arundhati Ramanan. Hi guys, good afternoon. The markets managing to show some green today. The Nifty absolutely flat with a slight positive bias, but unable to hold on to that 24,100 mark, currently at 24,095. The mid-cap index in line with the blue chip, gaining in line with the Nifty, absolutely flat, slight positive bias. The Nifty Bank, however, is underperforming. That index is about 0.3% in the red, feeling some pressure there. But if you take a look at the sectoral performance, all of those stocks that are helping the Nifty climb higher are those IT names. That index is clocking big gains, and if you bring that up for you, it's over 3% higher. And this comes on the back of that blockbuster number that we saw from NVIDIA, which is propping up hopes of the AI trade. If you take a look, the Infosys is up nearly 3%, TCS up over 4%, and Coforge nearly 5% higher. So that's how the IT index is doing today. But the top loser, those defense names, HCL down 1%, Bharat Dynamics down 3%, and Mazagon Dock is down over 1% in trade as well. FMCG stocks continue to lag, feeling the pressure. ITC, Tata Consumer Products, and United Spirits, all of them near 1%, nearly 1% lower in trade today. So that's how the markets are shaping up this afternoon. But first up, Kumar Mangalam Birla, during Vodafone Idea's 31st AGM, has said that FY27 is the year of execution and delivery. Let's go across to Reema Tendulkar to get us all of those details from that AGM. Reema?
Thanks so much for that. So I think the key headline from Kumar Mangalam Birla at yesterday's Vodafone Idea AGM is FY27 is going to be the year of execution and delivery. You know, the last couple of years, the AGM, so the investor perception about Vodafone Idea was always about an existential crisis, the company being in a survival mode. But now it looks like the foundation is shifted and the focus is now on capitalizing growth and getting into the execution mindset. The reason is why things are different this time is many of the legacy issues have been addressed. Now, one concern plaguing Vodafone Idea is that they kept losing subscribers ever since the merger in 2018. Q1 FY27 was the first quarter when the company reported positive subscriber growth. That's one. The second issue for Vodafone Idea used to be the large debt, the AGR dues. Now the moratorium gives the company leeway till 2035, which means for 9 years, the cash is conserved. They don't have to make payouts related to the AGR dues for the next 9 years. So that's enough runway. And also in terms of the funding, you know, but now you've got the promoters infusing money via warrants. So that's put in confidence capital. And the company said that they're actively seeking bank debt funding of 35,000 crore rupees. Also, it's not just stock, right? You are actually seeing signs of the company making investments. Now, earlier this year, the company said that they're planning to invest 45,000 crore rupees in terms of investments, infrastructure upgrades in the next 3 years. Now, of that, 9,000 crore yesterday, Kumar Mangalam Birla said at the AGM, equipment orders have have already been placed on it. And finally, on that big issue about tariff, Kumar Mangalam Birla did use the platform of AGM to talk about how there is a case for ARPUs to go up. ARPUs for Vodafone Idea are closer to 190, but he said periodic tariff rationalization is essential for the industry. And finally, I think the bottom line is where we went back to at the beginning. This is going to be a year of execution and delivery. He says that Vodafone Idea is in a better position than it has been in the recent years, and there is a reason to be optimistic.
All right, Rima, many thanks for taking us through those details. Now, Rajesh Baheti of Across Seas Capital Services also posed some questions of the volatility during the closing auction session. Let's listen in to his comments on that front.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever it has to do and it has no relevance. Then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well. BSE is clearly worse off, and I'll tell you why. While it has 30-35% of the F&O market share, it has only 5% of the cash market share. I don't think the passives are going to go to the BSE and put in their orders for index rebalancing or buying or selling their stocks. They will trade on the NSE. And the BSE indices do not get determined by NSE closing prices. They get determined by their own closing prices. So with a 5% volume, with absence of institutional players in the cash segment on the BSE, I think the BSE indices closing is going to be prone to such high volatility moves. And it's going to be really bad for BSE options trading because eventually people will stop trading the BSE options if they find that the price setting is all over the place. A lot of the price anomalies that we see is due to the fact that people enter orders and they withdraw it all of a sudden, or they then start modifying the orders. So I think maybe there should be some penalty for withdrawal of orders or modification of orders, because clearly you're putting in orders at 3% up or down initially, and just a minute before the closing period when you can withdraw or modify the same, you end up modifying those orders. And that is creating the journey, is creating a bigger mayhem than just the closing levels that we are seeing. At least allow cash to have 10% or 15% of the market's volumes and then link it to the F&O. I mean, what is the hurry of pushing F&O segment into the abyss? You know, it's a classic case. I feel that there's some stepmotherly treatment being meted out to the F&O segment.
Temperature sensors and specialized cables manufacturer Tempson's Instruments made a stellar market debut on the street today. We caught up with the management, Vinay Rathi, to get their guidance on the company's growth prospects. Take a look.
Regarding the export market, so last few years we started 3 companies outside India, and so those would be growing much faster because the initial years were just the seeding years, and now we are going to see the fruit. So like especially for UAE, what we did was it 3x'd last year. So we kind of see that similarly the geographies that we have started in Korea, Poland and Mexico, so they would be adding to this kind of growth. We got some specific approvals in the oil and gas segment from some large customers, so we would be going in that direction for those kind of products, and that would be significantly growing. Actually, last year the working capital days time also they were increased because of we kind of acquired some companies, and so those were done in the last days of March, and that is why the balance sheet got consolidated, and whereas it kind of increased the working capital days artificially. But if you see the year before that, so those were the normalized working capital days which would be continuing in future.
A recent Macquarie note says uncertainty over HDFC Bank CEO Shashidhar Jagdishan's tenure is weighing on the stock. Ritu Singh is here with all of those details. Ritu?
Well, there's still no clarity on the future of HDFC Bank CEO Sashidhar Jagdishan, whose current tenure ends on the 26th of October. That leaves just 2 months for the bank and the RBI to settle that succession question. And this has been an overhang for the HDFC Bank stock for some time now. Now, Macquarie's come out with a note where it says there are two equally probable outcomes. The first is a short, about 6-month extension for Jagdishan, and the second is a full 3-year extension. Now, Macquarie says a 6-month extension could signal that the board is looking beyond the current CEO, but they need time to identify and recommend a successor, and that could keep the uncertainty around the succession alive. So they point out that if there is eventually a new CEO, there could be a transition period as that person settles into the role. So a temporary extension could mean further downside for the HDFC Bank stock, according to Macquarie. Now, on the other hand, a full 3-year extension for Jagdishan will remove the immediate uncertainty around leadership. Macquarie believes the current levels could then provide a floor for the stock, with the focus shifting back to the bank's fundamentals and any improvement in performance. Now, Macquarie maintains an outperform rating on HDFC Bank with a 12-month target price of 1,150 rupees. The two key risks it flags are 1, a temporary CEO extension if that comes in, and 2, any further sharp compression in the margins.
All right, Ritu, many thanks for those details. But on that note, it is time for us to head into a short break. More news and updates coming up on the other side. Stay tuned. Welcome back. You're still with us on Business Lunch. All eyes now on the annual Jackson Hole Symposium, where Federal Reserve Chair Kevin Warsh is expected to make a speech later today. Investors will be looking out for policy cues about interest rates and inflation ahead of that. CNBC's Steve Leisman has a preview of what to expect.
The Fed chairman's speech in Jackson Hole is always listened to carefully for clues about his outlook for rates. Will he be hawkish? Will he be dovish? This year, markets are listening for whether Kevin Warsh talks about policy at all. He's held back on his views to get a cleaner message of market pricing not influenced by his own Fed speak. But Warsh's colleagues in CNBC interviews here in Jackson Hole have not been shy about offering their outlooks.
I believe now is the time to act. I believe that we've been in an inflationary situation for more than 5 years. It's been running well above our target. I don't see any restriction in policy.
I think we may be a little bit more accommodative, certainly more accommodative than restrictive in the policy rate.
Schmidt did say he thought Fed officials could talk less, while Hammack offered it was her responsibility, she thought, to share her policy views. Tobias Adrian from the IMF writing, quote, broader communication about reaction function remains essential as long as it is conditional, disciplined, and uncertainty aware. Risk should be clearly spelled out. Warsh may give markets at least some of what they hope for tomorrow, potentially making a distinction between what he's willing to say in a speech on his own compared to when he's representing the committee after a meeting of a press conference. Steve Leisman, CNBC Business News.
So Steve Leisman there with what we can expect later tonight. Here is some opinion from former Fed officials Loretta Mester and Stephen Moran on what to expect from the Kevin Warsh's Jackson Hole speech and the Fed's rate trajectory going ahead.
I think the public, too. I mean, it's an accountability issue. We want to see how a Fed chair is thinking about the economy. He doesn't have to promise us anything, but just how is he seeing it? What does he look at? How's he evaluating the current state of the economy? And an explanation of why perhaps they made the decision they made in July. And you know, what, not about September, but just explaining what he did in July and why.
Mm-hmm. And you continued to get better inflation data, which we've gotten now, a couple of months of much better inflation data. It would be weird to sort of say, okay, before I thought it was appropriate to hold, now we got good inflation data, and now I think it's appropriate to hike. There's no reaction function that gives you both a hold in June and July and a hike in September.
Earlier, we also caught up with Robert Subaraman of Nomura on what he expects from the Fed chair speech.
There would be a lot for the new Fed chair, Kevin Warsh, to talk about, but he seems to have a new communication style, which is minimum communication. So I think he's most likely going to stick to his new strategy, which is not providing much forward guidance. And so I don't think we're going to get too much new news from Jackson Hole, from Chair Warsh's speech. Look, Lata, I'd say the one thing that he could do, he doesn't want to give any kind of hints of what the FOMC is going to do, because his argument is, you know, it's very uncertain, we don't know. Forward guidance isn't as useful tool as it used to be.
On that note, it is time for us to head into another short break, but more news and updates coming up on the other side. Stay tuned. Welcome back to Business Lunch. Let's get you all the updates from West Asia now. Qatar's Prime Minister has met with officials in the Iranian capital to discuss critical issues such as the Strait of Hormuz amid international hopes for renewed dialogue between the US and Iran to end the conflict. Iran's chief negotiator and parliament speaker told Qatar's Prime Minister that the Trump administration makes incorrect decisions driven by misinformation which wastes US resources and destabilizes the region. Meanwhile, Iran says it is preparing a list of conditions to open the Strait of Hormuz following mediator requests, pointing out that the US must first take practical steps to fulfill these demands before the waterway reopens. Furthermore, a US Central Command stated that American forces have redirected 75 commercial vessels, disabled 3 and boarded 2 others to ensure compliance with the ongoing naval blockade. In Nepal, rescuers are racing against time to reach people trapped inside a hydropower tunnel. Arunima joins us now from the ground with the latest updates. Arunima?
Yes, this is the hydropower project tunnel. You must have seen those visuals from the Chinese side of the immigration center getting completely washed out. So this is the same broad locality we are talking about. The tunnel is also in that broad locality. So that is in a way the epicenter. And imagine 500 people rescued alive 3 days or at least 48 hours after this tragedy struck. It's a big win for the morale of the rescue forces. You know what, Dr. Upreti, who's the chief executive officer of the Nepal Disaster Relief Management Association here. He's like the man who's at the thick of rescue and relief. He says that, you know, it was very difficult because we might have put out those visuals as well of the tunnel, almost half covered with muck, and the entrance itself was difficult to reach. Most of these 500 people, it looks like that they were employees of the hydropower project, but he's not ruling out the possibility that there could be some tourists as well. Because if you see again the videos that have gone viral, there was some 2-3 minutes that some tourists had. You could hear them screaming that water is coming. There are some eyewitness accounts also that CNN News 18 has managed with people who were speaking to their family members who said, "Baad aa gaya, baad aa gaya." So they had a couple of minutes before the water actually hit. Now what Dr. Upreti and his team are hoping is that perhaps some people managed to enter the tunnel to save themselves from the water. Scrutiny of these 500 people is still on. Most are tunnel workers, but some could be tourists too. They're being brought to Kathmandu and airlifted to other hospitals. Once they're in a position to identify themselves, we will know for sure if there are any Indians, because a lot of Indians who are missing are from that area.
Arunima there with the latest from Nepal. But with that, it is a wrap on this edition of Business Lunch. Midcap Radar will take all the market action forward.
Good afternoon and welcome to Mid Cap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Vivek Iyer and with me today is Ekta Batra. Good afternoon, Ekta. We've started off the September series, especially on the FNO side, on a very positive note. Markets have been quite subdued and very volatile as well.
Hi Vivek, yes absolutely, it has been a little bit of a subdued trading sessions, not just one but quite a few. But nonetheless, let's take you through all of the top stories that we're tracking this afternoon. The first top headline is that the stocks gain but give up some ground even as efforts at mediation between the US and Iran continue. Sensex, however, gains more than the Nifty IT index, also gains more than 3%, Realty and FMCG drag.
Kotak Institutional Equities issues a buy rating or a bullish note on Just Dial with a buy rating and a target of 1,175 rupees a share, citing attractive valuation and expecting its new management to drive growth. The stock rallies 10%.
Tejas Networks receives a letter of intent worth nearly 1,600 crores from TCS, nearly doubling its overall order book. Once the purchase order is received, the stock rallies over 10%.
It's a stellar debut for customized temperature sensing solutions manufacturer TempSense Instruments. The stock more than doubles on debut, listing at over 600 rupees versus its issue price of just 300 rupees per share.
TVS Motors shares fell over 4% after the company named Payman Kargar as its next CEO, ending KN Radhakrishnan's 18-year tenure at the helm from Jan 2027. Okay, well, it is turning out to be a little bit of a subdued session at this point in time for the markets. Remember that the Nifty's just been hovering in a tight range, but the IT index has been doing very well in today's trading session. In fact, all of the top gainers within the Nifty space or the frontline space are a lot of these IT stocks. So leading from the front include the likes of TCS, TechM, HCLTech, Wipro, Infosys. Now, on the downside, however, it is a little bit of the banks which are having a subdued session. So ICICI Bank, for example, is down around close to 2% IndusInd Bank has lost around 1.5% as well. From the other segments in terms of sectors, we have ITC, which is down around 1% Tata Consumer Products, which is down around 0.9%, and even something like an Asian Paints, which is sulking from the FMCG space. So that stock is down around 1.5%. For the Bank Nifty, like we mentioned, it's a little bit of an underperformance, down 0.3% currently for the Bank Nifty. That's how the frontliners are placed. For the broader markets, we have stocks such as Credit Access, which is down around 4%, Physics Vada, which is showing a bit of a subdued session, down around 3%. But we do have Sudarshan joining in to tell us all of the mid-cap movers he's tracking this afternoon. Sudarshan, over to you.
It's a subdued day of trade. The entire Nifty is just trying to hold on to the levels of 24,100. But we are seeing an action in the mid-cap space, and some of the stocks are seeing a huge gain, or also some of them are under pressure. So we'll start with the stocks that are largely higher. So on top of the list is Ather Energies, because Hero MotoCorp has announced that it has invested 1,758 crore and has raised stake to almost 33%, and existing shareholder has paid its stake. Next, with Tejas Networks, on the back of big order wins, stock has moved sharply higher, currently up more than 8%. IFCI, because there was a comment yesterday from SEBI chairman that NSE approval, NSE IPO approval can be expected very soon, and that's the reason IFCI is sharply higher. Ola Electric, on the back of positive news development, this stock too is up almost 4%. GE Shipping, on the announcement of buyback, stock is currently up almost 1%. Some of the other mid-cap gainers, TempSense has a strong listing, double on the first day of the listing, currently up 92% against the issue price. Precision Wires had announced that it will be issuing shares via preferential basis. Stock is up almost 18%. Cient had a positive outlook for FY27 and for the next 3 fiscal years, and that's the reason this stock too has been extending gains, currently up almost 5%. And Sagility too, because on an expectation of a corporate development, the stock has moved 4% higher. Some of the mid-cap losers, TVS Motor, because the era of KN Radhakrishnan comes to an end. 18-year term is ending. Company has announced new CEO. Stock has reacted negatively, down almost 4%. Bharat Dynamics has been extending losses today, also down almost 3%. And some of the other mid-cap losers with healthy volumes, D Development, Advait Jewelers, and Physics Wala.
Well, thank you so much, Sudarshan. And I know we'll get back to you a little bit later to speak about TVS Motors, who's leaving, who's coming in, and what will be the task at hand as far as the new CEO is concerned. But it's a good time to get a quick technical check on the market. Heymen Kapadia from DR Choksi joins us. Good afternoon, Heymen, and thank you so much for joining us. Always a pleasure to see you. In terms of the Nifty, we've been range-bound for quite some time. Apart from the volatility we've seen during the CAA sessions, where do you see markets headed from here on?
Very good afternoon, Vivek. Thank you for having me on the show. It's always a pleasure. Well, I think it's 21st to the 22nd trading session, Vivek. Since 3rd of August when CAA started, nothing to do with CAAs, but markets going nowhere. The VIX is dead. It's not even somnolent anymore. It's dead. I mean, if the VIX is below 11 and the markets don't even rally 200 points, I mean, that does sound strange, but that's the way it is. Lower tops, lower bottoms. Paradoxically, the mid-cap and the Nifty mid-cap 100, the mid-cap small-cap index 100 have posted fresh all-time highs in this week. So, I mean, the mainline stocks are floundering, going nowhere, and the mid-cap, small-caps are at all-time highs. So, yes, there is a discrepancy over there, a lot of divergence. But, yeah, as far as the Nifty is concerned, Vivek, I think 24,000 holds, it's good. If anything needs to happen positive, we need a close about 24,344. And if I were to look at the Bank Nifty, same thing, ranges between 58,000 and 57,000. A breakout on either side, we see some momentum coming in, but otherwise markets are completely lackadaisical.
Okay, absolutely. A little bit of a lackluster session, but IT is doing well, continues to do so. Do you think it can recoup a lot of the underperformance we've seen on a year-to-date basis?
Yes, Ekta, I think IT in the last month gave technically was an upward key reversal. And, it peaked at something like 46,000 in December of 24. So it's quarter to 2 years. And I believe the longer term picture is finally on the mend. It's posted a medium term bottom without a doubt. But now things are looking a bit copacetic on the monthly chart. So I think I'd agree with what you say. It's working. It's going to recover, recoup some of the losses. I'm not saying it's going to be a complete recovery, but yeah, I think things are beginning to look positive. Technically, it's ticking the right boxes. So yes, a further upside, yes, some recovery for sure. All the way, not yet confirmed.
And Heymen, what are your topics for the day?
Okay. Firstly, I have a buy call on BSE, Vivek. It's a short-term trading call. One can buy BSE at around 33.90, stop loss of 33.40, target of 35.90. Upward bar reversal coming in today. Stock is oversold. There is positive divergence. The oscillators on the daily chart have given signaled a crossover buy. So we're playing for a bounce from the decline has been pretty severe. 44.50 to 32.25. A recovery is on the cards. And I believe the recovery has already commenced. The second one is more of a positional call with CDSL. It's made a nice base on the weekly chart. It's on the cusp of overcoming a 1.5 year supply line. It's not yet broken out, but everything seems to suggest yes. In the next few trading sessions, it's going to make a sincere attempt at taking this line out. So buy on CDSL at 14.10, stop loss 13.80, target of 14.70. It's a modest target, I believe. Once this breakout comes in, we should be crossing 1500 also. Vivek.
Okay, all right, Heymen, we're going to let you go on that note. Thanks very much for joining in and giving us all of that perspective. We'll take a short break, but up next, we'll get you a lot more in terms of specific stocks and the market. Stay tuned. Welcome back. Well, for the markets, like we've been mentioning, it's been quiet, but we do have stocks such as Spark, which are managing to hold up quite well today. So do watch out for that. That's the R&D arm of Sun Pharma. That stock is up 5.5%. Metropolis is doing well after that analyst meet. So that stock continues to gain. It's up around 2.8% at this point, and in fact done well on a year-to-date basis as well. But we do have Sudarshan, who's going to tell us about TVS Motors and why he's looking at that stock. Sudarshan, over to you.
So TVS Motor has announced a leadership change, and it's a major change that company has announced, and a new CEO will be joining from January 2027, and he is currently President of International Business, and his name is Payman Kargar. Now, who he replaces? He replaces the man who has been at the helm for last 18 years, is K.N. Radhakrishnan. Now, just talk about the three headline numbers, what exactly TVS has seen in last 18 years. Revenue. In 2008, it used to be just 3,000 crore rupees. In FY26, it's increased to almost 50,000 crore rupees. Profit, it used to be just 32 crore rupees, increased to more than 3,600 crore. Volumes used to be less than 13 lakh units. Now it's more than 58 lakh units. That's how company has performed on major headline number. Some of the major decisions that K.N. Radhakrishnan has taken in the last few years. First one, global expansion. In 2008, TVS Motor used to be known as Indian mobility player, Indian two-wheeler player, but he's expanded to make sure that TVS Motor becomes a global mobility player, and now international business forms almost 30% of its total volumes. On the premiumization front, he has taken several major decisions. EV push with iQube. He was an early EV player, and now currently TVS is a #1 player with market share of as high as 26%. Norton acquisition, it had acquired in 2024 16 million pounds, and now today that is playing a major role on premiumization front in the global market. So it won't be wrong to say that an era has come to an end, especially at TVS Motor.
Very well put, Sudarshan. Very large shoes to fill as far as the new CEO is concerned. But moving on, Tirumala Chemicals is in focus. Yash is picking up some exclusive details on this particular name. Yash, over to you.
Well, very interesting fundraise as far as Tirumala Chemicals is concerned. What we've been given to understand from our sources is that the company, that is Tirumala Chemicals, is looking to raise anywhere between about 400 to 500 crore. And this amount is expected to be raised through a combination of preferential issue as well as sale of non-core assets. I'll speak first about the preferential issue. What we've been given to understand from our sources is that about 200 to 250 crore is expected to be raised towards through the issuance of preferential shares towards a new investor who would be coming into the company. And the next part of it, that is sale of non-core assets, about 100 to 150 crore is expected to be raised by the company via sale of its investments in its wholly owned step-down subsidiary, which is called OOSB. As far as the balance part of it is concerned, what we've been given to understand is that Tirumala Chemicals could also consider stake monetization in another listed company where it holds about 14.38% stake, and that is Ultramine and Pigment. So that is one important segment to look at. A total of 400 to 500 crore of fundraising, of course, through a combination of preferential issue and sale of non-core assets. We've written to the company on this particular query. The company has replied to CNBC TV18 saying that they are in the middle of major investment cycle, and the company is working on raising capital through the most effective means.
Okay, all right. Thanks very much for that. So that's on Tirumala Chemicals. But one stock that I'm looking at is Fortis, and Nomura and Morgan Stanley have written on it. That is because the parent company of Fortis has come out with some statements, which is IHH, on Fortis. So what IHH has said, interestingly, is that they've reiterated their plan to increase their stake in Fortis from 31% to 51% in the next 3 to 5 years. This could be done through fresh capital infusion or creeping acquisitions. Any increase in stake needs to be ROE accretive by year 2 or 3. Morgan Stanley has said Fortis Gleneagles integration is progressing well with systems and operations which are largely integrated. IHH has reiterated the 3 to 5 year ambition to reach 51% effective stake. And like I mentioned earlier, it should be ROE accretive. And it should be, maybe through a mix of primary capital and opportunistic secondary market purchases. So at one point in time, after all of the hurdles with regards to the open offer, finally, we do have, IHH committing their stake in Fortis and their long-term plans in the
So
company.
creeping acquisition means they'll actually buy from the open market,
Yeah.
then less than 5% is allowed, without any approval per financial year. So very interesting story. Fortis Healthcare, one of the better performing healthcare stocks or hospital stocks in today's trading session. Well, with that, we'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Midcap Radar. Well, a couple of stocks from the midcap IT space doing very well. Coforge clearly outperforming, up almost 6% in the session at the day's highest point. Coforge is the name that we're talking about. But on the other hand, Jubilant Foodworks in the last hour has seen a sharp dip and now down almost 2% in the session. But one stock that's been quite steady today has been Great Eastern Shipping, or GE Shipping, given the fact that the board has approved a 900 crore rupees buyback. Devyani joins in with more details.
Well, GE Shipping has announced a 900 crore buyback at a maximum price of 1,530 rupees per share. Now, this particular buyback is priced at 16% premium to its last close of 1,317 rupees per share, and the buyback represents roughly around 4.12% of the total paid-up equity share capital of the company. Now, it's an open market buyback, so the price could also be lower than the 1,530 rupees per share mark, but the promoters are not participating in this particular buyback, and as a result their holding could increase from 30% levels to 31.4% post buyback completion. The company is set to utilize at least 75% of the approved buyback size, implying a minimum buyback of roughly around 675 crores. Now, this comes after a strong Q1 for the company, where revenue crossed 2,000 crores, EBITDA doubled to 1,326 crores, and PAT crossed 1,300 crores in Q1 of FY27. Now, this was largely on the back of the shipping segment, where revenue doubled and PAT tripled on a year-on-year perspective. In fact, the debt has also halved for the company on a year-on-year perspective, from 1,850 crore levels to 800 crore levels. So all in all, it was a strong quarter for the company. Now, the stock has already seen a 21% up move year till date, while the one-year return stands at around 44%. But it is still down 27% from its 52-week high of 1,798 rupees per share levels.
Okay, all right, Divyani, thanks very much for that. Let's go across to Rima now. She joins us on Just Dial.
Thanks so much for that. So for Just Dial, the story, as you rightly said, is a Kotak institutional equity note, which is betting on the new CEO. Remember, the founder and CEO, Chairman BVS Money, stepped down earlier this year, and the new CEO, Dinkar, has taken charge. Kotak's target price is 1,175, which is a steep upside from the current level. Basically, Kotak says the new CEO is looking to revive growth. The focus will be on paid subscribers. Now, the company today has 56 million listings, but only 10% of them are actually paying subscribers. So they want to bridge that gap. The second avenue of growth is focused, as I said, paid campaigns is one, new products, and even B2B merchant onboarding. So right now, when you think of Just Dial, you think of a B2C kind of a platform. We all call Just Dial to get access to a plumber or, a salon close by. But the B2B is only 10% of the company's merchant base. So here also the company has a runway. And that, Kotak believes, will help the company revive the collections. Last year, collections were very muted, less than 2%. In Q1, we've already seen a pickup, 17% or 14% Q1 pickup in collections. But the management focus should be on getting back to double-digit collections growth. But the big question for Just Dial is really the cash on the books, because the market capitalization is 6,000 crore rupees. The cash on the books is also 6,000 crore rupees. But Kotak's view is that as of now, at least the new CEO is not going to take a decision on whether the cash needs to be returned to the shareholders. If it does happen, that will be an additional trigger.
Okay, all right, Rima, thanks very much for that. So that's on Just Dial, the stock doing handsomely well in today's trading session, up around 10% for that particular counter. Not so much for the markets, extremely quiet at this point in time. The advance decline ratio just about trending on the advancing side. So we have around 2,200 stocks advancing to around 2,000 stocks which are declining at this point. You want to make a point, Vivek?
That's right. One of the newsmakers this particular week was a company called Rashi Peripherals. There was an independent director who had actually quit, and he had quite a few accusations to make as far as the functioning of the board was concerned. That particular stock on that day saw almost a 12% downtick. But in the last 2 to 3 trading sessions, there's been a very sharp up move as far as Rashi Peripherals is concerned. And BSE is the other name, that's moved to the high point of the day.
And even Mastech, that stock has jumped around 16% in today's trading session. So a lot to talk about in terms of specific stocks. That's all the time that we have on Midcap Radar. Special programming on the closing auction session up next. Stay tuned.
and welcome to the special edition of CNBC TV 18 Explains CAS Conundrum, and we'll be talking about, CAS, the closing auction sessions. How has it moved in during this time as well? What should you be doing as traders, retail investors? We'll be taking some of your queries as well. I'm Vinny, along with me is my colleague Mangalam, and we'll be decoding all of that with our experts as well, Mangalam.
Indeed, we will be decoding all of that. The CAS Conundrum has had a lot of the retail investors and a lot of the institutional F&O investors and traders as well in a bit of a tizzy, particularly on big days like expiry that took place as early as or as recent as yesterday itself, which was the 27th of August. The BSE's new closing auction mechanism is facing its biggest test yet, and it's triggered a fierce debate over market stability. On Thursday, which was yesterday, the first monthly F&O expiry under the new closing auction session saw the Sensex swing wildly in the final minutes, plunging more than 2,000 points to some actually even calling it a flash crash in the last 15 minutes to eventually only settle about 250 points lower. The sharp move has left market participants questioning whether the mechanism is actually improving price discovery or creating more volatility in a market where liquidity during the auction window is still developing. Some traders have gone as far as calling the closing session a lottery. But despite the criticism, SEBI chairman Tuhin Kanta Pandey is standing firm. He has defended the closing auction session and made it clear that there is no immediate plan to roll back or alter the mechanism. The regulator maintains that greater participation and improving liquidity will help the system settle into place. So is Thursday's extreme volatility simply a teething issue for the new market structure, or does it expose deeper concerns around liquidity and price discovery? We'll discuss that. We'll also listen to the SEBI chairperson. But before that, let's just pull up that graphic once again of the volatility that we've seen on Thursdays in particular. Yesterday was obviously a lot more pronounced because it was the monthly expiry. But if you look at it, on the 6th, 13th, 20th and 27th, the swings have been a lot wilder. So every time there has been the closing auction session, there has been a move which has been slightly limited. Yes, it has been a move nevertheless, which is what is intended. But particularly on expiry days, which are the yellow bars as you see on your screen, they have been a lot more pronounced, which is exactly the issue that we're looking to delve into. Before we do that, let's listen in to the SEBI chief's comments.
नहीं, अभी हम कोई चेंजेस नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी ऐप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
All right, you've seen the volatility and you've seen it for the last 1 month or so, last 4 Thursdays. And we have, heard from the chairperson of SEBI himself saying that they're standing firm behind the CAS. To decode this and to see whether this continues, these are just teething troubles or there's something structural, we do have a bunch of experts who are joining us on the show today as well. Rohit Srivastav, who's the founder and strategist at IndiaCharts.com and Strike Money. Alongside that, we have Chandan Taparia, who's the head of derivatives and technicals wealth at Motilal Oswal Financial Services. Both of them joining in. Thanks a lot, gentlemen, for joining in. Let's start with Chandan first. Chandan, what have you as an institution made of this when it comes to a lot of the client orders that come in, the kind of volatility that we see on expiry days? What have been some of the issues that you guys have been facing? And do you have any suggestions to give to the SEBI?
Yeah, thanks for having me, Mangalam. So what we noticed that because of the CES, the trading mechanism and the trading modus operandi has recently changed. Earlier, people used to do the option writing with the view that option is the theta decay property and it keeps on declining towards the end. But now as in CES, participants can bid the order at 3% range, and because of that sudden spurt happens, which usually in range of 70 to 220 points in Nifty and 200 to 500 points in Sensex. So nearby strikes are getting the volatility. So what we noticed, in fact, in last 1 month, that we are advising our traders to reduce the option writing or go with the option strategy. And in fact, in last 2-3 weekly expiries and monthly expiry, we got some opportunity to go with the long strangle. Usually, as per the theory, the option buyers only make money by 33%, and that is the probability, but the scenario has totally changed. So the option writer who was really working as a system trader to make the consistent return in the market, but the scenario has totally changed. So one suggestion is that in CS, the order can be put at range of 3% plus minus to the reference price which is taken from 3 to 315 volume weightage average. If the regulator reduces the price band of 3% to let's say 1.5%, then there will be the chances of comparatively less volatile move in the last 15 minutes in the market. I worked on 3-4 points. Let me just give some sense on that. First thing is that market moves as per the put call parity concept, but as index sets, the spot trading sets at 315 to 320 and future only trades. So there is no correlation in the put call parity that time. In Indian market and other global market, we see the W kind of pattern in the volumes. But because of the CS, last 30 minutes, there is no volume, only 1 to 2% volume of the entire day is happening. So because of this, I don't think the relevant price discovery is happening in the last hour. And suggestion is how, like let's say in the bank Nifty, there are only 14 counters, same in the bank X. So one counter which is having heavy weight and more weightage to the index, if that gets the build of, let's say, matching equilibrium at 3% higher, that can give the movement of 1.5 to 2% in the index. So I think these concerns needs to be addressed, and cap of 3% if reduced, then there will be chances of comparatively less volatile swing in the CS.
Obviously, cap reduced, then maybe less volatility during the cash session is something that we could see. And also in terms of volumes, which are significantly lower, right? Rohit, coming to you on this as well, right? Volumes significantly lower during this time. I think everyone's going before this cash session, they're doing most of their volume trades. What is your suggestion here? What is maybe more can be done to improve as well? And what have you seen over this period of time with your clients as well?
Basically, I don't think this is an issue of intent. SEBI has a clear intent of bringing a global methodology to the Indian market that they want everyone to follow. So I don't see intent as the issue. I think the issue that we are all facing is in the implementation part of the story. And, we can take many different angles to it. For example, you're asking, how do you improve this? Maybe there's nothing to improve because after all, you're copying something which is being done around the world. Even the 3% limit is there in certain markets around the world. So is that the issue? Or is it really an issue of participation, which is what he's bringing out? And if it's an issue of participation, then all you're saying is that the brokers, because right now, individuals for us who are sitting and probably using broker terminals, online apps, or the desktop terminals, are not able to participate unless you have a direct NSE terminal in which you can place certain types of orders. So if you're not using a direct terminal, which is now most of the market because everybody's transitioned to online, then those systems are not able to adjust to the happenings that are there right now. And that is one source of liquidity drying up. So it's very easy to blame that part that, okay, there's no liquidity. So my simple answer would be, then why didn't we get the exchanges to implement that first? Because what is happening is that individual traders and investors who have set up systems to trade based on what was there before definitely cannot adjust to what is going on right now, and which is what is leading to the noise. You can go to any forum or any WhatsApp group where there are traders and investors, and they are all not saying good things about what is happening right now. They're taking various angles to it, including manipulation, etc. And it's not helping that you have a global system which is supposed to work smoothly. And then we say that, well, it's because participation is not there and the brokers did not implement the updates that they were supposed to do. Now, why didn't we get the brokers to do the updates first? That becomes the first question. Were they willing to, unwilling to? I'm not sure if you've asked the brokers, are they willing? Do they have a timeline? If that timeline is 1 month, it means that, or 2 months, because it takes time to implement changes to the software. Then for that long, individual investors and traders have to take the brunt of it, which means that all the systems and methodology that they have worked upon for months or years is suddenly has to be shunned. They have to probably just pull it down and stop executing, or probably completely change. Like you just heard what was being said, that you change the strategy and you do a different type of strategy. But people have raised funds under particular strategies that they're supposed to execute. And if you're running a strategy or a book, say, for example, and I've raised, say, 200 crores to run an options or derivative hedge book, and I'm looking at things like delta, theta, gamma, which is not only expiry to expiry. See, I think another wrong angle to this entire story is that you're saying that it only matters on expiry days. No, because your closing price is being varied every day. So when you're running a book and you need to make adjustments to various positions based on, the factors that are important to you, whether it's theta, whether it's delta, you'll need to increase or reduce exposure somewhere.
Right. No, Rohit, we entirely take your point. We understand your point that this is a system. Currently, it's facing teething problems, and we're not for even once saying that this is an issue of intent, because the intent is fairly clear. Earlier, it was weighted average, volume weighted average on a closing price, and all the funds and all those traders would actually try to match the closing price basis the volumes, and on those softwares, you would actually see the tick by tick data, and you would get a predictive close as well. Right now, to avoid someone gaming this system is where cash has come, and because of lack of liquidity right now, lack of perhaps understanding as well right now, maybe people are just taking a bit of a backseat to see where this goes. We are seeing these wild swings. The question is,
Mangalam, yes. I get your point as well. Why should I pay the price for the testing?
Exactly. So then now the question is, now this has happened, right, what should you do? Yeah, no, I completely agree with you.
So you come up with a timeline for all the brokers to implement these apps, and for that time period, you step back. You go back to the old system till you have everybody ready.
Okay.
And they better give you a timeline. I mean, if this is something you want done, then you give a date and you give a timeline to complete. And then you go live with it. And there's absolutely nothing wrong with having cash with all the systems in place. Then we can make a better judgment as to, what is right or not working. But right now, with an incomplete system, we are trying to make a judgment on something which doesn't work. And across different things, like I said, don't just put it on expiry day. I'm someone who looks at charts. You know that. I look at charts every day. If my everyday's closing price is whipsawing from one level to another, then say, for example, I've created a system that gives me buy and sell signals on the closing price. The system is failing every day. It will give me wrong signals. So for me, suddenly the closing price has lost meaning. I need a new system.
Absolutely, point taken there, Rohit. But we're going to, on that note, actually sip into a very short break. We'll come back after the break as well and continue this conversation. Stay tuned in.
Welcome back. You're watching us on this special show, The Cash Conundrum, where we explain to you, the issues that the street is facing currently with the closed auction system, and at the same time, what are the remedies or suggestions that a lot of the participants in the market have for that as well. We've been speaking with Chandan Taparia as well as we do have Rohit Srivastav as well with us. Gentlemen, we'll come to you. We'll discuss a little more on this as well. But we've been having continuous conversations. You've heard from the SEBI chair earlier saying that they are steadfast on this. It's not moving away from here on. But we also had Rajesh Baheti of Cross Seas Capital join in and give his views too. So let's hear that out before we continue our conversation with Rohit and Chandan.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever it has to do and it has no relevance. Then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well. A lot of the price anomalies that we see is due to the fact that people enter orders and they withdraw it all of a sudden, or they then start modifying the orders. So I think maybe there should be some penalty for withdrawal of orders or modification of orders, because clearly you're putting in orders at 3% up or down initially, and just a minute before the closing period when you can withdraw or modify the same, you end up modifying those orders, and that is creating the journey, is creating a bigger mayhem than just the closing levels that we are seeing. At least allow cash to have 10% or 15% of the market's volumes and then link it to the F&O. I mean, what is the hurry of pushing F&O segment into the others? It's a classic case. I feel that there's some stepmother treatment being meted out to the F&O segment.
Right. Firm and clear. Those views coming in from Rajesh. Rohit, coming back to you, you were making a point on if it's not bad intent, there are people who are still losing a fair amount of money. It's a zero-sum game. There are some making outsized gains from this as well. What do you say happens now? I mean, what has happened so far, obviously a lot of people have lost a lot of money. Lots of people have got a big windfall as well. You're saying that the SEBI should now perhaps, go back to the old system. We've heard from the SEBI chair. They don't intend on doing so. What happens?
No, what they really meant is they don't want to roll it back. I'm not even talking of a rollback. I'm just saying get system ready. And system ready means get the broking side, everyone to implement the availability. If you want more participation, all participants should have access, which is today through online, mobile apps, desktop, etc. Everything be ready. And then go live again. I don't think people will mind if they are able to see actual prices of everything and participate in that between 315 and 320 till they get the real numbers and adjust their positions. But suddenly after 10 minutes, if you see the Nifty up 100 or 100 points up or 100 points down, then making those adjustments, especially where a lot of calculations are involved, is often difficult. I mean, I'll give you an example from very, very long back. We would run a delta hedge book. When I was in Sherkhan, I spent 18 years there. And this is 2006. We believed that the people who were running it would never lose money. And they always would be able to hedge their delta. But the problem came when you had overnight gaps. So when the market started to crash in May of 2006 and you had a gap down every day, then those gap downs you cannot adjust on delta. You have to do it by taking some hit on your book. And if it happens for 3 consecutive days, the loss can become massive. Now you're doing the same thing because in 10-15 minutes, when the market is opening one way or the other by a large amount, people who are system-based or based on certain logic suddenly can't adjust for those things.
Okay, point taken there. Maybe weave it into the system as well as what you are saying. Give it some time to get adjusted to it as well. But we have a few queries also that have come in from our viewers. And Chandan, I want to ask this one to you. Abhishek is writing to us from Patna. He's used to selling normally at 3:25 p.m. and wants to know now, with the cash system coming into place, when and where can he place that order? Further, he's asking if the auction price can move as much as 3% from the reference price, right? then how should he be viewing this as well, and what is the price that he should be looking at? When is that can he place this order and look at the pricing finally as well?
Yeah, so very nice question. What I believe that till the market doesn't digest this new CS system, try to reduce the option writing after 315. What we have noticed that in Nifty, if your strike is near to 150 to 200 points, you should reduce the exposure, and same applies in Sensex when you have a strike in between 400 to 500 points. As per the standard deviation, one can bid the price in a range of 3% plus minus. So my suggestion is, if you are doing the writing, try to exit it before 315, or otherwise you can go into the next expiry to creating some spread and all. If you are looking for buying strategy, you need to keep in mind either your premium will blast if you are having the nearby strike. So my advice is, in Nifty, try to keep 150 to 200 points safer point. In Sensex, try to keep 300 to 400 points if you want to carry any option writing. Otherwise, try to reduce till the system doesn't get digest the new CS.
Right. Thanks a lot, Chandan, for that. We've gotten both yours as well as Rohit's views along with Rajesh, and we also heard what the SEBI chair had to say. We got in a viewer query as well, but this is the first of many shows around the closed auction system that we will continue to do here on CNBC TV 18. Thank you so much for watching. For all your queries, keep writing to us. We'll obviously get them, answered by a lot of the experts that come with us here on the channel. But what we'll do is wrap up on this edition of the special show, the Cash Conundrum. Take a short break, come back on the other side. Closing bell takes you through the last hour of this trading week.
on market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Taiwan index again managing to hold on to strong gains in the trading session.
Oil's at what, 89, actually 89.5 now, right?
लोग सीखेंगे और इस मार्केट में आएंगे.
So the Nifty is at 24,120. The
manufacturing opportunity, electronics was always there, and we liked it. We still like it selectively.
It has been going up every single day, 7% higher.
Pushing the margins in the same direction.
The market looks a lot better than what it was over the last few trading sessions.
But now you've got the promoters infusing money via warrants.
Yes, absolutely. It has been a little bit of a subdued trading sessions.
Well, that is the day so far. The last hour coming up. Last hour not just for today, but for the week as well. We're flat, 30 points on the Nifty. This is a closing bell coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Nigel. Nigel, hi.
Well, hi, Prashant. The markets appear more or less flattish or quietish, but actually from the broader markets, a lot of stocks are moving around. If I look at it, SAIL is at around 200 rupees. Big move is what you're seeing on that one. The big listing today, Tempsons, well, that is up. That's doubled your money just in a single trading session. And the other one is Lalita Jewelry that listed earlier this week. And that's up close to around 30% from the IPO price. So promoter entity and the bankers decided that maybe we lower valuations. It got a lot of interest at around 12, 13 times thereabouts, the forward earnings. And that one is just moving from strength to strength at the high point of the day. Even some of those stocks that actually have been underperformers. Whether you look at a JTL, well, that's at the high point of the day. I think it's at a 52-week high. So big move is what you're seeing on that one. And Morpin Laboratories, I don't know when the last time that stock was at 100 rupees. So from the broader markets, fair bit of action, just citing some of these examples. But these stocks are just taking off.
Absolutely. And I think numbers were super strong. But, it's a company with a long history. And for a long time, it was kind of sort of down and out, but has actually made a comeback in a dramatic fashion, actually. I think it's doubled pretty much, from where it was about a year and a half ago or so. So it's been a big one. Well, let's just quickly run you through what's lined up here in terms of the movers, in terms of what's coming up here on the show. So we'll, of course, talk about markets and at a headline level, there's a bit of a struggle going on still. There's no break, or rather breakout in that sense. Broader markets, better, definitely much better compared to yesterday. 1,800 up and about 1,670, 1,700 stocks lower. It's actually pretty evenly balanced still. IT is up and about, and we'll try and explain. We'll put some reasons up on the board. We'll see if they're convincing enough to explain the move that we have got on the stocks. TVS, Sud will put the spotlight on the changes at the top. Stocks recovered from the lows of the morning, but still down about 3%. Aether is having a very, very sharp move once again. Aether is, I think Hero MotoCorp likely to have picked up a hiked stake. That was essentially what we were looking at. And we've got Tempsons, which we will put a primer out on to tell you what the company is about, where valuations are, and more. How should you position yourself is the question in the last hour. And let's take it to Mitesh for answers there. Mitesh, good afternoon. What's your advice?
Good afternoon, Prashant. So, I just heard you talking about the struggle in the index and no breakout or breakdown. I think the only breakouts and breakdowns are happening in the last 15 minutes of trading. I think that's when the stronger moves happen. Surprisingly, I think, it's a kind of scenario when retail can not really participate aggressively over there. So I think, the impact is definitely felt, and the market is yet to decide which directional bias or which directional move it wants to take. So for the time being, we'll keep the boundaries at 24,000, 24,300, and we're still in that range. On the stock side, I have a buy on Axis Bank with a stop at 1246 for targets of 1292. And the sell call is on Indian Hotels. Keep a stop at about 721. Look for targets of 670.
So Axis is the first, and which is the second, and which is the first one?
is back. And Indian Hotels is the sell call.
Okay, Indian Hotels is the sell call coming through right now. You know, we are going to put the spotlight on Aether. I mean, it's got some trading, fair bit of trading history now. How would you look at something like this? Just, you know, charging ahead.
So I think, the stock Prashant has, ever since it broke about the 750 mark, it's been showing a very strong uptrend. And while all the near-term targets have been met, typically stocks like this, wherein there's obviously a feeling that the stock could be extremely valuable in the coming few years. I think the way to trade it is, possibly look at the reference point and see if you can have a long trade with some kind of a short-term or a near-term stop loss. The last high which the stock made was around 1570 on the 12th of August, and then we have cleared that. So 1570 or any declines or pullbacks to the 1570 should be your buying zone. And today the stock gapped up, and below that gap should be the stop loss. So around 1500 should be a stop loss. Now, if you're looking at 1570 as the buying zone and 1500 stop loss, I think the target should be in excess of 1750 over here.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's focus on IT stocks. They are surging as SaaSpocalypse fears subside following Salesforce strong numbers and its partnership with Anthropic. Rachna joins in to break all of that down for us. Rachna?
Well, that's right. But the IT rally today is more than just one night of trade and more about the fears that we are seeing getting easy. Now, from the start of the year, there was one worry that we were seeing in trade, which was that if AI can reason and act on its own, does anyone really still need the software layer sitting on top of the data? But now we have an answer. This phenomenon, from the start of the year, we were calling it a SaaSpocalypse, but now the SaaSpocalypse fears have clearly eased out as Salesforce has announced a partnership with Anthropic. Now, this together will be known as Claude Force, where Claude becomes the reasoning engine inside Salesforce, and Salesforce becomes a plugin inside Claude. The model does the thinking, whereas Salesforce still holds the data, the workflow, and the controls for it. Now, the numbers back up the rationale for it. In its earnings, Salesforce revenue was up 11% to $11.3 billion, subscription revenue up 12%, operating margin up 34%, and the guidance for the year was also raised way above the street's expectations. All of this simply indicates that enterprises are not spending less on enterprise software, they're in fact spending more. So what does it mean for our Indian IT services? Well, the business here is built on implementing and running client platforms. That revenue holds as long as those platforms stay the backbone of the enterprise, which is exactly the takeaway from the Claude Force deal, that the platforms would adapt and not be replaced, and so the rally.
You know, this deal, Rachna, so customers who use, customers will pay tokens, as I understand it, to both companies if they access Salesforce data through Claude, right? That's essentially what's happening.
That's right. So now it's not just accessing Salesforce data through Claude, but also Claude being available on Salesforce's platform. So it's a two-way deal. Now, earlier this year, we'd also seen Palantir CEO where he voiced out his concerns that the problem is who will own the data ultimately, because you put in everything that a company has into AI. AI can very well replicate it and replace the software, the data layer of the software company, which is why the SaaSpocalypse fear had started, which is why token maxing had become an issue. But this deal sort of simplifies those fears that the companies had, because here the company would still hold on to the data and the need for a software layer continues.
And get paid for it as well. Thanks very much, Rachna, for that. That is the IT story. I'm sure it's like one of the inputs going into what we are seeing. Stocks have done very, very well. I mean, actually, if you look at some mid-cap names like Coforge, etc., they've really run hard. From recent levels, I think Coforge should be up 60-70%. And of course, I mean, others have done far less, but this, of course, has been the clear leader. So it's come back in a big, big way. Gurmeet Chadha is with us. Gurmeet, good afternoon. Good to have you with us here. Just your thoughts on IT services. You know, still, we speak with so many CIOs and fund managers on the institutional side, and very few still willing to, essentially back IT services. A lot of skepticism still, and maybe fairly so. But what's your thought?
I agree, Prashant. And market is also on odd days thinks that AI will disrupt, and on even days thinks that it's it's a partnership going. But one thing which is clearly emerging is companies who are using cash for acquisitions or forging partnerships, investing in platforms. I think eventually will gain once the dust settles. We remember Coforge investors getting spooked when they announced a very aggressive inorganic acquisition, and now the price is crossed 2000 today. So I think midcap IT to me is more agile. They have the ability to pivot and forge these kind of partnerships. So I think that is where you got to be selective, but it's just that the valuations there are not cheap. Amongst large cap, I think HCL has a good software business. Sometimes it's a little underrated. They almost do 20% of the EBITDA. It's much more diversified. So in our portfolio, we have HCL. We've nibbled into KPIT when the stock went below 600. We believe, negative news and the founder passing away. But eventually, again, it's a very IP product. It's more an auto software kind of a company. So we are selectively nibbling into it, around 3% odd exposure all put together, but more comfortable with new age names, which is where you can have clear visibility of growth. The likes of Eternal, we've just added Misho in our portfolio. So, the new age digital business is where we find more comfort right now rather than, bottom fishing these names.
Got it. Okay. All right. Hi, Gurmeet. Good to see you, Ben. Let's focus on TVS then. Sudarshan joins in to tell us about the rejig at the top. Sudarshan?
So TVS Motor is going to see a major leadership change. It's not anything normal because the person who is going to replace and the person who will be replaced, K.N. Radhakrishnan will be replaced, and he has been at the helm for last 18 years or say since 2008. And new CEO is going to be Peman Kargar, who is currently president of international business. Now, what exactly has happened in last 18 years and some of the major decisions that K.N. Radhakrishnan has taken, and that has made TVS Motor what it is today. So in 2008, revenue used to be just rupees 3,000 crore. Now in FY26, it's increased to almost 50,000 crore, an increase of almost 15 times. Profit used to be 32 crore. Now it's increased to more than 3,600 crore, up almost 100 times. Volumes used to be 13 lakh units. Now it's more up. It's at almost 59 lakh units, up almost 5 times. Now, some of the major decisions, or say strategic decisions that he has taken in the last 18 years. First, global expansion. In 2008, TVS Motor used to be just domestic two-wheeler player, but he has expanded to global markets. Now, currently, international business forms almost 30% to its total volumes. Remember, just 2 or 3 years ago, when the whole sector was moving towards premiumization, TVS Motor has taken a huge move, and that move has not impacted like other players like Hero MotoCorp or Bajaj Auto. They were impacted by the move towards premiumization, but TVS Motor was not. EV Push made an early entry with iQube, and today company's #1 player with market share of more than 25%. Also, to focus toward privatization in global markets, company had announced the acquisition of Norton in 2020 for 16 million pounds, and that also helped to expand into the global market. So it won't be wrong to say that an era ends at TVS Motor.
Absolutely, and the stocks may be reflecting a little bit of that this afternoon. Ather is the other one, right, Sud? The stock's running away once again, and Hero MotoCorp is likely to pick up additional stake in Ather. Tell us more.
So yesterday late in the evening, Hero MotoCorp has announced that it will be making additional investment of around 1,760 crore in Ather Energy, and its stake will increase from 29.8% to almost 33%. Remember, just last month, Ather Energy had allotted preferential warrants to both promoter of the company, and also because Hero MotoCorp is also one of the promoters, to a stake of around 1.2%, and that investment was done of rupees 1,000 crore. Now Hero MotoCorp has gone ahead and made an additional investment, but that has happened via block deals, and today's block deal window. They had not announced name of buyer or the seller, but I have checked with both the companies. It's confirmed that Hero MotoCorp has bought the stake in the block deals, and one of the existing shareholders has paid its stake by almost 2.9%. So now, after today's share buy, Hero MotoCorp's stake has increased to almost 33%, and because of that, you are seeing a big move in Ather Energy.
Got it. All right. Thanks a lot for that, sir. Gurmeet, what do you make of this one?
Nigel, we invested too little, to be honest. Always, we entered, but we thought it's a little expensive. But it's just tear away rally in Ether. I think the trigger was when they became EBITDA positive in Q1. I think that was a big trigger, doubled their revenues, and I think they doubled their store count. I think what the street is now betting on, one is the new model they are launching tomorrow, which is the Connect, which is the EL platform. You'll see more models, and this is the mass premium segment of scooter, which is 1 to 1.25 lakh, which is what the 60% of the market is. So I think that is exciting. And I think the other thing is their spare revenue is just like 1.5% versus spare and service revenue of 10-12% for other OEMs. And then there is a software angle, which is the Ether stack, which you use to ride on the hardware they have for connectivity, etc. So new age business doing well, street getting excited, and I think, as I said, bought too little, hardly had 1% in the portfolio.
Yeah, one of those things, right, where you and of course, I mean, once it runs away like this, even if you think it's a great one, it's very difficult to go in and buy, right?
Yeah, it's Prashant, still textbook, old school, difficult to value some of these names, right? And that's why we've created a new portfolio, so that that reflects the changing trends in the market. So I think we've been very bullish on auto. I think I'm very surprised with what the auto numbers have been. I think partially it's due to the GST cards, auto loans at 7 quarter. I mean, there's very robust demand. We do regular dealer check. Ether, in fact, had stopped punching orders, the dealers some time back when we did a bit of a dipstick. So very, very robust demand. Even M&M, Hyundai, very strong inquiries and numbers. So I think auto ancillaries are due, in my view. OEMs have done well. I think there's a lot of catch up there.
Got it. Okay, all right. Stay with us. Gurmeet, the temperature sensors and specialized cables manufacturer, Tempson's Instruments, made a stellar debut. For those that got allotted, you doubled your money on day one. Vinny joins us to break down the company for us. Vinny, tell us more about this one. Imagine doubling your money. Wow.
Absolutely, it's a wow listing that's come in here today. And do not forget, the subscription itself also indicated the interest that was coming in. Qualified institutional buyers, whether you look at it, or non-institutional buyers, retail investors. There was an oversubscription clearly there, 185 times overall. It was oversubscribed as well. Now, obviously, in terms of the company is mainly into thermal engineering and specialized cable manufacturer. They are engaged in the business of designing, manufacturing customized temperature sensing solutions, electrical heating solutions, as well as specialized cables. In terms of a breakup that is coming in for the earnings of the company, how has the growth been so far as well? So the last couple of years, they've managed to see a decent growth, around 20% growth. One would FY26 year-on-year basis growth versus FY25 was around 18%. FY25 it was around 38% growth. 444 crores approximately was the revenue in FY26 for the company. Margins of the company are around the 25% range in the last few years as well. Cash flows, they are holding on cash from operation at around 42 crores of FY26 as well. So interesting company there. They have three segments mainly: temperature sensing solutions, electrical heating, as well as specialized cable segments. These are the key segments for the company, and this is where the growth of the company is now coming in from. We'll watch out more in terms of that as well. We spoke to the management today. Let's listen into what they had to say in terms of the outlook of the company now going forward.
Regarding the export market, so last few years we started 3 companies outside India, and so those would be growing much faster because the initial years were just the seeding years, and now we are going to see the fruit. So like especially for UAE, what we did was 3x last year. So we kind of see that similarly the geographies that we have started in Korea, Poland and Mexico, so they would be adding to this kind of growth. We got some specific approvals in the oil and gas segment from some large customers, so we would be going in that direction for those kind of products, and that would be significantly growing. Actually, last year the working capital days time also they were increased because of we kind of acquired some companies, and so those were done in the last days of March, and that is why the balance sheet got consolidated, and whereas it kind of increased the working capital days artificially. But if you see the year before that, so those were the normalized working capital days which would be continuing in future.
Okay, all right. Gurmeet, what do you make of this one? Tempson's, they're guiding that they can continue to grow at this sort of a clip that is around 20%. Last year's PAT was around 70 crores. This year, because of the listing pop, they're at 4,900 crores already. But the margin believes that working capital days comes down to 130 days odd. They also say that the top line growth is going to be solid and margins will hold at around this 25%. Your view on this name?
So, Nigel, we are evaluating this. We were hoping for a slightly more tepid listing, but a very strong listing. And, precision engineering, making very technical stuff with end users, manufacturing, capital goods, power equipments, etc., is the flavor actually. And I think that's what happens. It was happening with clean energy names maybe a year back, and now it's happening with this precision engineering. So looks interesting, but probably may not be at this price, but keeps on our radar. There's another one coming, which is glass wall systems, which makes these glass facades and fabricators and does high end building, including I think Antilla. That's something. So again, a small IPO looking forward to. So very specialized niche precision engineering manufacturing play, good margins. I think that's something which seems to be the flavor of the season.
Yeah, I've got that. The IPO which is on today, which is ESDS, right? I don't know if you've looked at that one. A lot of interest in the anchor book, and the IPO is open today. But essentially, again, they are like a data center on demand kind of service. They set up data centers and lease out space. Pretty much, that's the business model. Growth rates, etc., have been pretty strong. Any thoughts, Gurmeet?
No, looks interesting, Prashant, but we as PMS can't apply an anchor book. There's a bit of a technical thing here that only insurance, AIF and MF can do. As a QIB, you have to be a qualified institutional buyer for that. So we're working around it, but looks interesting. We are more comfortable adding post listing, but looks interesting. I mean, we are on it, and it's part of our watch list right now.
Gurmeet, I spoke to the management earlier today, Mr. Piyush, and last year they did a revenue of little less than 500 crores. Now, because they've got into that deal with Sharon AI, which is a $1.25 billion deal, the money that they get, if you just do a back of an envelope calculation, that they're going to be getting around $5.50 per hour per GPU. Then, in fact, and Sharon takes around $3.50. Then you have around $2 that is remaining, and out of that, 50% is what they get. So you take $1, you multiply by the number of hours. The rough PBT that they could be earning is around 500 to 600 crores or thereabouts. 500 to 600 crores in the coming year is more than what the current revenue is. The street, though, can't believe these kind of numbers, though, because it's looking very, very good, at least for now. And the fear is that at some point of time, it's going to catch up. The price of GPUs as well will fall. So that's why, in fact, the gray market premium is very, very high. Anchor book was reasonably okay, but those bigger names actually were missing out, though the promoter entity sounded very, very confident with regard to the company. So subscription was solid, but we'll have to see how it goes. Last year, 500 crores of revenues. We pushed the management, we asked them, FY 28, can the PAT be more than 500 crores? They said probably yes, because of the kind of deals that they have signed up. Well, Gurmeet, we'll thank you for joining in and giving us your take. It's Raksha Bandhan, North India in particular. I think there'll be a lot of celebrations. Many offices must be shut. So have a good remainder of Friday and see you soon.
Thank you. Thank you.
Well, we'll take a short break. On the other side, the Alpha Manager of the Day, Dinshoy Rani of Helios Mutual Fund, will be joining in. Stay with us.
Well, all eyes will be on annual Jackson Hole Symposium, where Federal Reserve Chair Kevin Warsh is expected to make a speech later today. Investors will be looking out for policy cues about interest rates and inflation going ahead as well. CNBC's Steve Leisman has a preview in terms of what you should be expecting.
The Fed chairman's speech in Jackson Hole is always listened to carefully for clues about his outlook for rates. Will he be hawkish? Will he be dovish? This year, markets are listening for whether Kevin Warsh talks about policy at all. He's held back on his views to get a cleaner message of market pricing not influenced by his own Fed speak. But Warsh's colleagues in CNBC interviews here in Jackson Hole have not been shy about offering their outlooks.
I believe now is the time to act. I believe that we've been in an inflationary situation for more than 5 years. It's been running well above our target. I don't see any restriction in policy.
I think we may be a little bit more accommodative, certainly more accommodative than restrictive in the policy rate.
Schmidt did say he thought Fed officials could talk less, while Hammack offered it was her responsibility, she thought, to share her policy views. Tobias Adrian from the IMF writing, quote, broader communication about reaction function remains essential as long as it is conditional, disciplined, and uncertainty aware. Risk should be clearly spelled out. Warsh may give markets at least some of what they hope for tomorrow, potentially making a distinction between what he's willing to say in a speech on his own compared to when he's representing the committee after a meeting of a press conference. Steve Leisman, CNBC Business News.
Okay, well, so we'll hear, of course, at 7:30 today evening from Fed Chair Kevin Warsh. I mean, lots of things to watch, but September is, of course, top of mind in terms of what they do in terms of rate decision. Dinshaw Irani is now with us, CEO, Helios Mutual Fund. Dinshaw, great to have you with us here. Thank you very much for joining us. You know, it's macros, all these macro factors, etc. They kind of appear once in a while, and then but they're not the dominating driver, right? It's such a micro market, and you know, these individuals, not even about sectors anymore. Just you know, rocket here, rocket there, that kind of a market. You would agree. What has been keeping you busy in terms of focusing on, and what are you working on, Dinshaw?
First of all, thanks for having me on your show, and a very good afternoon to you and your viewers. So, Prashant, the fact is that the quarter gone by was the real, I think, turning point for India per se, because you saw quite a bit of surprises. I mean, as in the positive surprises, that's a good part. In fact, the last I read, one of the big broking houses saying that 2/3 of the results were positive surprises, and the neutrals were some 10% or so, and the rest were negative surprises. It was like way in favor of the positives as such. So basically, this is what I think India needed also to push the foreign investors to come back, the FPIs to come back to India per se. And you've seen them coming back in a trickle. I think that is what has set us apart. Unfortunately, though, as I've always been saying, as we've always been saying, that the large cap cohort, the problem is the set of companies out there. I mean, the set of industries out there. Fairly saturated players, or export driven where there's no services, rather like IT services, where there's no growth happening as such. I think that is what is pulling down, at least, or rather the passives are not getting excited about India for that. And as you rightly mentioned, I think it's all result driven today. And frankly, I mean, you've seen that in the mid cap and the small cap space. Both these cohorts have been doing fantastically well, obviously pockets within those, where there's been growth in this quarter. I think that will continue. And that's what we are digging into.
All right. Hi, Dinshaw. Good to see you. And Dinshaw, what about the big daddy? Imagine we are talking about, you know, stocks moving up, individual stocks. Maybe the market goes to fresh all-time highs. But HDFC Bank is keeping its record intact. I mean, it's a large proportion of many portfolios. And it's not dancing. It's not participating at all. You know, what's your reading of it? Time has come. We've debated about this numerous times. But just when people throw in the towel, probably it gets its act together.
Okay, Nigel. The fact is that we threw in the towel, I a couple of months back. And you see that in our portfolio also. I mean, we've been reducing weight quite constantly in that particular. And we've been talking about it. It's not that we have not been. I think from Feb or March onwards, we've been cutting our weight quite a bit in the banking sector per se also. HDFC was a big part of that. And we've been doing that constantly, and we're moving more into financial services. It's like, by the way, our belief is it's like buying history vis-a-vis buying future, right? I mean, all these banks could have done fintechs if they wanted to. RBI never stopped them from doing that, but they never did so. They were more inclined towards their own traditional businesses, and obviously the fintechs took away a big chunk of that business from these guys. CASAs have been constantly reducing, NIMs have always been under pressure. So I don't feel there's a big change coming along there. And that's why we're being a bit lightweight in that segment. It's not that we don't have HDFC Bank, we have, but it's reduced quite a bit in weight for our portfolios per se. And that's why we're I think, more on financial services than on the banks part. So of the BFSI, the B has reduced and FS has increased in weight, though the overall weight for BFSI has remained more or less constant for us.
All right. A couple of other interesting names. Shadowfax, that's another one that's I think you'll have been holding on to. Give us some details with regard to some of these themes. Shadowfax, Car Trade, not too many listed peers as well, but these stocks actually have done well.
So actually, Nigel, we are very excited about the new age companies. And I think that's where the whole outperformance of the small cap space is coming from. All these new age companies is full of, the small cap space is full of those. And that is where the real growth drivers are. In fact, we've always been calling it out quite verbosely rather. Eternal is the only large cap probably, and Paytm is maybe the only mid cap in that space. But the fact is that the small cap is full of these kind of platform companies we're very excited about. All these, the participants to e-com, e-coms are mostly mid-cap or large-cap, the quick-com, players. But the real fun lies in the logistics business so that's why we got delivery also, by the way, not only Shadowfax and such. That's why we are very keen on that space and we continue to remain so. You'll see very shortly, we're also going to apply for a new age fund. And I think that is where the excitement is coming from, because this is the area which India has a real edge over the world as such. Whenever we go out, we don't even talk about our steel companies or cement companies. We just talk about our new age companies, which excites the investor out there.
I feel that pain. I'll tell you what, Dinshaw, I feel that pain. As a beat, I've been given steel and cement, and the world is moving on and missing opportunities. At times, those old age economy companies, no one talks about them. There's no interest. Juice, the masala. Part of the game.
No growth also, actually, Nigel. That's a
growth also. No excitement. In fact, I like it when UltraTech is getting into cables and wires. For me, it's like, wow, now they're doing something interesting for me. I've got a big press conference next week to attend. That kind of thing. Let's talk about the other side. Ather Energy. That you all got in, very well, and you all have been quite candid about booking losses, I think, or getting out in time with regard to Ola Electric as well. You all said that the story is not playing out, you all just got out. Now there's an interesting proposition. Hero's putting in more money as well at these 52-week highs. The stock is just running along. Do you all see a long runway, and bulk of the value is still there, because at current valuation wise, it's difficult to justify it, right? But it's not stopping.
So Nigel, actually, as a house, we follow this policy to the hill that there's nothing like long term in any business. Forget about whatever you're talking about, but any business. And how do we overcome that hurdle? Because we are also biased toward long term. So what we do is we add up these series of short terms. Every short term, we review the positions that we have. And if we like it, we carry it forward. And that's how the long term adds up. A series of short terms add up to a long term. As of now, Ather looks like a clear winner in the EV space. And frankly, looking at his market cap and the proportion of market share he has in the EV space, I think it's got a long runway to go. And that's what's keeping us very much interested in that counter. We've not been adding to it because anyway, the price growth has made sure that it's disproportionately growing faster than the whole portfolio. And as a result, the weight is moving up. So that's the whole thing, and we're not adding actively to it. Maybe we'll wait for if there is a correction or something to add to the position, but we are very happy with the way it is today.
Long way ahead. The bike has just started, and revving up the engine. Well, thanks, Dinshaw, for joining in, giving us your view on a lot of those stock sectors as well as the markets. I look forward to chatting up with you rather soon. Okay, let's focus on the F&O trends very quickly then. You have the premium on the 24,100 put. That's come down to around $50. The premium on the 24,200 call as well. You've got the direction right, but that premium as well is a little bit lower, while the 24,100 put premium is more or less flattish. So basically, the writers actually are having a better time in today's trading session since the markets are just trading with a very mild positive bias. If you look at levels, 20 DMA is a reference point on the upside. The reference point on the downside could be around the 100 DMA, and we are pat in the middle of both those two levels. So that's the range you're looking at. Individual stocks, Coforge, beautiful looking stock. I think it's up close to around 80% in the last 3.5 months. That continues to see a good amount of long build up. But one of the shorting candidates has been TCS. That's relatively underperformed. Valuations as well have got compressed, but first signs actually of short covering on that particular name. Sagility is a stock that, it's just come into the F&O ban, into the F&O, apologies for that, from this series itself. And there is a fair bit of open interest build up actually, and it's quite active out there. One would have feared that in case there is any negative news, that the stock gets hammered down. But that's seeing a good amount of buying as well as backed up by long build up as well. So I'll keep an eye out on Sagility. I don't know whether the street is sniffing something on that one. While on Havells, that's coming for some fresh shorting in today's trading session. In fact, that's down close to 2.5%, and open interest as well has swelled up. We'll take a short break, come back. We'll get you a check on what's Nimish picking up in Dealing Room Chatter. Stay tuned.
Okay, welcome back. 30 points higher, 24,120. Not very much going on, at least at an index level. D Street chatter now, and Nimesh is joining in with exactly that. Nimesh, take it away.
Hi, Prashant. Flat on the Nifty, but it's the IT which has been buzzing in trade. The IT index is up nearly 3% and big moves in the IT stocks. So barring IT, it's been pretty much quiet and lackluster from the overall market point of view. Interestingly, the flows are positive from larger FIs, and within that, my sense is there is buying back in the PSU bank stocks in today's market. So expect high volumes, and there is a bit of buying interest back in the PSU bank stocks in today's trade. Even in the broader market, where the index looks flat, there is a lot of interest in the recent listings. A lot of the small cap stocks are buzzing as well in today's market. So there is no clear direction or momentum in the overall market. Select pockets are doing good, but I guess today for a change there is buying flow from FIs, and that too towards some of the PSU bank stocks.
In terms of individual names, Nimesh, what's making the cut today?
Well, a lot of stocks which are reacting to the block deals are buzzing in trade. So the first stock is Capri Global. That's a 5% on large volumes. There was a 1.5% block in the morning trade, and after that we've seen a big rally in that name. My sense is one of the leading US-based long-only fund was a buyer in today's block deal. So any disclosures could be interesting in Capri Global. Similarly, SP Apparels, even that's been buzzing in trade of 5% after a large block, and there I believe one of the domestic AIF was a buyer. Interestingly, it's not part of my list, but even in Genus Power, there was a large block in the afternoon in a block window. Nearly 40 lakh shares got changed hands, and after that, we've seen a bit rally in Genus Power as well. My sense is even in Genus Power, it was a clean out trade from the potential seller who was selling out in the last few weeks. So maybe disclosures there also could be interesting in today's market. So these are the three names which are stocks which are reacting post large block deals. Second, EPL, again, while the stock has been consolidating, the sense is there could be a large block deal in EPL very soon, so watch out for that. So that's the second stock. Third stock is Yatharth Hospital. We've seen a big rally in this particular name in the last 3 odd months. Even the interest is quite high from larger HNIs, is my sense is. And the city is anticipating some corporate development as well in the Yatharth Hospital soon. And the last is Imami. That's been under pressure of late. In fact, even today the stock is down 2%. Almost close to the 52-week lows. My sense is one of the domestic mutual fund was a large seller. There could be a potential clean out trade soon from that domestic mutual fund. And even there, along with a couple of other mid-cap names, there has been an anticipation of a corporate development. A potential buyback is rumored in Imami. So that apart, my sense is that the selling from the domestic mutual fund can get very soon in Imami.
All right. Well, Nimesh, thank you very much for that. I mean, Imami at the lows, and most of the others, of course, have on the list there a bunch of blocks and some corporate development in Yatharth expected as well. Well, let's get you some trading ideas now, and we have Mitesh Thakkar joining in with those trades. Mitesh, what do you have?
I have a BTST on Oil India with a stop below 479.5 for a target of 490. And as Nimesh was also highlighting, the IT names are buzzing. Persistent is a BTST with a stop below 58.43 for a target of around 58.95.
Okay, all right. Mitesh, thanks very much for that. So those are some short-term trading ideas. Metropolis is higher. There was an analyst day and the management has sounded positive. Ekta is here with the top highlights. Ekta, take it away.
Well, yes, for FY27, they've reiterated their guidance. So they're saying it's a revenue growth of around 14 to 15%, 100 to 150 basis points. EBITDA margin expansion is what Metropolis is guiding for in FY27. Now, on a 3-year basis, they are expecting better network utilization, tier 3 growth, specialty growth, M&A, as well as stable volumes going forward, as well as margin expansion on a larger 3-year perspective. Now, in terms of other growth targets, B2C, they're expecting around 1,000 owned stores by FY29, and that should go beyond pathology. They should probably look at vitals, diet, consults. Separately, True Health, which is their preventive testing arm, should probably focus on 25% of revenue versus 18% currently. B2B, which is their specialty testing, should move to around 45% of revenue versus 40% currently. And they are also keen on growing via inorganic growth. So the next 3 years, they will be looking at that route as well.
Okay, all right. Thanks a lot for that, Ekta. Well, the other stock that Nimesh has highlighted is Genus Power. That's moved to the high point of the day. GIC around 45 days or so ago, a little more than that, I think they had gone ahead and sold part of that block. And going by today's volumes, Ramesh said this could probably be a cleaner trade. So we'll have to wait for further clarity on that front. The earlier deal had happened sub 300 rupees, where you had a couple of large names that did come in. I think Buoyant as well, Jigar Mysteries Fund, they had bought it around 290 rupees. I'll tell you what, let's slip into a short break, come back, we'll continue to focus on markets and stocks that are moving around. Welcome back. Well, let's get in a word coming in from Rajesh Baheti of Cross Seas Capital Services. We posed some questions to him earlier today with regard to the volatility we saw on the closing auction session yesterday. He had some suggestions. Let's listen in to what he had to say.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever it has to do and it has no relevance. Then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well. BSE is clearly worse off, and I'll tell you why. While it has 30-35% of the F&O market share, it has only 5% of the cash market share. I don't think the passives are going to go to the BSE and put in their orders for index rebalancing or buying or selling their stocks. They will trade on the NSE. And the BSE indices do not get determined by NSE closing prices. They get determined by their own closing prices. So with a 5% volume, with absence of institutional players in the cash segment on the BSE, I think the BSE indices closing is going to be prone to such high volatility moves. And it's going to be really bad for BSE options trading because eventually people will stop trading the BSE options if they find that the price setting is all over the place. A lot of the price anomalies that we see is due to the fact that people enter orders and they withdraw it all of a sudden, or they then start modifying the orders. So I think maybe there should be some penalty for withdrawal of orders or modification of orders, because clearly you're putting in orders at 3% up or down initially, and just a minute before the closing period when you can withdraw or modify the same, you end up modifying those orders, and that is creating the journey, is creating a bigger mayhem than just the closing levels that we are seeing. At least allow cash to have 10% or 15% of the market's volumes and then link it to the F&O. I mean, what is the hurry of pushing F&O segment into the abyss? It's a classic case. I feel that there's some stepmother treatment being meted out to the F&O segment.
Okay, well, strong views as always. Rajesh Baheti there talking about what should be done. Let enough volumes be there in the cash segment before you link it to the F&O. If you don't want to sort of delink it in its entirety, which of course has been his first suggestion. Anand Tandon is with us. Anand, good to have you with us here. Have you been watching from the sidelines this entire cash debate?
I've been watching it. Fortunately for me, I have stopped doing derivatives for several decades now, so it really doesn't bother me too much.
Yeah. That's the you can. But do you have a view on it though? I mean, any thoughts?
I would leave it to the experts who are actually dealing with it on a day-to-day basis to comment. I don't think I have any significant value to add.
Yeah. Any of these IPOs have caught your attention? Lots of them, right? Some have been kind of routine. Lots of jewelry companies, for example, are making a beeline to the primary market to get listed. But then there are some others, right? This ESDS is a new company on the data center side. We've had niche manufacturing companies. We've had actually a pretty interesting lineup, all told.
Well, I don't track the IPO market very closely, but clearly, things like what you mentioned, data centers, etc., will get listed in India. Though I have always had my doubts about what it is that we offer in this country for data centers, which makes it exceptional.
Power, Anand, power, cheap electricity. Of course, it's relative to power elsewhere. I'm not saying on an absolute basis, but yeah, it is one of the biggest.
Well, you will find that we are already running short of power, and we will now become a power deficit country if you expect too many of these to actually come through. Power is not cheap in India by any stretch. In fact, if you look at the fact that we have put, for some strange reason which I'm not able to understand, tariffs on solar from imports from China, you are actually driving up the renewable power costs as well. whereas you could have had it even cheaper. For all other sources of power, we have a problem. And, you need uninterrupted power. I doubt there is a state other than perhaps Bombay city, which has uninterrupted power in this country even today. So you will actually end up spending 3 times because you will make an alternative source for power besides the grid. And you will then have a backup in addition because you cannot have a data center going down even for a few seconds. So net, your capex cost, even on power, will be significantly higher than in countries where you have more reliable power coming through. So, land is expensive, all the equipment is mostly imported, manpower is not required, and power and land is not cheap. So I don't know other than regulatory arbitrage, where you are forced to keep data in India because of the fact that the regulations demand it, there is no particular upside that we have to offer as such compared to a global data center. That said, you should expect to have a few, and therefore, again, the one challenge that I see in data centers also are the longevity for the CPUs. If you are really looking at data centers which are going to cater to, let's say, AI, etc., then the question is, how many GPUs do you have right now, and how many you're likely to get, and what is the longevity you expect from it. But anyway, those are details. The IPO market is not interested in much of them. The market will continue to lap it up because right now there are very few which are listed.
Okay, not impressed, Anand. But what about, let's talk about another stock since you spoke about power. Genius Power, smart meters, tricky space, cash conversion takes long, working capitals are long. They have been saying that they're going to get their house in order. And there was a technical overhang as well with regard to the GIC block. Part of that, a larger proportion got cleared out, 10% I think out of the 15% got cleared out. And today's volumes are rather high. Stock is at the high point of the day. Any view on this name at 350 rupees? At its peak 2 years back, it was 450 bucks.
Again, the space is good, right? Clearly, we are looking at more of these the distribution companies having to go with digital meters. I don't know how many of them have not yet adopted, but I would imagine that there will still be a significant runway for growth. So at least demand is not an issue. Challenge is you are dealing with companies which are inherently unstable and bankrupt. So the question of cash flows will continue to remain a problem. There is not much that the company can do with it. So despite their forecasts, you'll have to make sure that it really depends on who they're supplying to and what is the cash flow position of that particular company that is able to actually pay for it. So overall, as I said, good growth possible. Cash flows can hopefully improve from here. Net, I don't see too many significant risks to this business.
There's about 2.5 minutes to go as far as the close is concerned. And we will look at some of the stuff. Aether Energy, any thoughts? One of the winners this week, I mean, actually all of the gains for the week came through on Friday. So it's up 10-11% Friday to Friday from 1460 to 1616 this Friday afternoon. Any thoughts on Aether?
Really one of the winners in the EV space. Some of the others started and have kind of floundered among the newer companies. This one has actually managed to grow its book and sustain the growth. The new facility also should help in kind of closing the gap between what their order book potentially could be versus their ability to actually deliver. So I think, for now, the momentum will remain fairly strong on the upside in terms of the sales growth, and that will automatically be reflected in the market cap. The market cap is already hitting serious numbers, but I would imagine that it will look much more palatable if you were to look at numbers 3-4 years out. So in short, one of the EV winners that seem to have evolved in the current ecosystem.
The big one, HDFC Bank, again, making newer lows every day. Lots of views, lots of opinion. Any thoughts here, Anand?
Well, the only thing I can think of is that, it is time for a management change, frankly. The current CEO has not managed to deliver on almost any count. The merger between HDFC and HDFC Bank was handled in a way that it took a long time. The service levels have fallen. I have been a 35-year-old consumer or customer of HDFC Bank, and I can only see the deterioration in the quality of service that you get over these years, and especially over the last 4 or 5 years. So while the entire system is set up for solid growth, and you should expect to see a bank like HDFC able to double itself over the next 3 or 4 years, something seems to be holding it back, and a whole slew of regulatory charges and investigations are not helping. I think a change at the top would be much welcome.
Yeah, absolutely. Thank you very much, Anand. A great conversation as always. Appreciate your views, and we'll chat again soon. Thank you. That's basically the before and after, right? I mean, before cash, 24,142 on the Nifty, 33 points higher is the final settlement rate. The Nifty Bank, 64 plus, 315 to 330, and the Sensex 70 plus, 315 to 330. So a bit of a bullish bias today on the indices. The BankX, actually, we should have 4 of these indices. We should have the BSE BankX as well, because yesterday, of course, because it was the expiry, the first monthly expiry on the BSE after the cash introduction, it was pretty wild moves. Today, it's more measured, but on the Nifty, it's about 33 odd points or so. Okay, well, I think that is the price action in terms of what we saw. I mean, it's been a pretty quiet week. The Nifty is down about 0.5%. The Nifty Bank is down about 0.5%. I'm talking about Friday to Friday. The mid-cap and small-cap indices are up a little bit, about 0.25%, 0.5% in that range. But otherwise, it's been, quiet. Even if you look at the NSE 500 universe and sort of, sort out the top gainers, top losers, I mean, they're in the 5, 6, 7% kind of range, both on the upside and, stocks which were lower as well. So it's been a quieter, absolutely a quieter week in that sense. It's a wrap on this edition of Closing Bell. Thank you very much for staying with us. Editors Roundtable will pick up on the action in just a bit.
Well, the Wall Street fell for the third straight week, marking its longest losing streak in 5 months. Mid-caps outperformed the benchmarks and managed to end the week in the green. FMCG and PSU stocks were among the biggest laggards, while a Friday rally helped the IT index emerge as the top performing sector. Well, over the next 30 minutes, we'll decode the markets on the Wall Street. The week that went by, we'll put the spotlight as well on the big supply of paper, the large trades that we've seen for the last couple of weeks. Hello and welcome to this edition of Editors Roundtable. I'm Nigel D'Souza. Joining me today is Ekta, Nimesh. Prashant will join in just a bit. And to help us out with a view on the market, we're joined by Gautam Chowcharia, the head of global markets at UBS. Hi, Ekta, as well as, Nimesh. And Gautam, thanks a lot for coming on the show.
I think this has been a week for me and Ekta, right? A lot of supply of paper and of course, healthcare has been the big talking point. She did a beautiful show as well. A lot of news as well in the healthcare space. So, and interestingly, Medanta today, which company was that which has hit a 1 lakh crore market cap?
Manipal.
Manipal
Manipal crossed
wow.
1
Another
lakh
company
crore.
which has hit a 1 lakh crore market cap.
I'll tell you what, but the cash session as well is in focus. And nowadays, when I speak about cash, I think of Prashant. So let's welcome Prashant on the show. Prashant joins in on the show as well. Welcome, Prashant. Interesting week. Well, Gautam, thanks a lot for coming on the show. Tell us, how are you feeling about the markets? The supply of paper is what we'll talk about in just a bit. But otherwise, it seemed like the pieces are coming together. Earnings, after a while, you can slice and dice it in various ways. But it appeared we had a pretty good earnings season. And we're optimistic that things improve from here on. Brent crude prices as well, sub $90 per barrel. We'll take that. Your sense on the Indian markets first up.
So, look, the growth cycle looks much more visible. We always hope for growth, but visibility is quite high now, both from this quarter's what we have seen, but also outlook generally. All the building blocks for growth recovery are in place. In fact, they have been in place since early in the year. It kind of took a step back because of what happened in the Middle East, a lot of doubts. And as you rightly said, with oil now behind or at least stabilizing, the growth visibility is high. That's very, very supportive. So the way to put it, we are still thinking markets are largely range bound. It's not enough to take the markets up in a big way. Supply of paper is one factor, but at least the downside is now fairly strong. Like I don't see the market correcting meaningfully in most scenarios. Like we saw one of the biggest tests around the Middle East crisis. Very resilient.
So you're leaning more towards the positive side.
It's positive. If you ask me 3 months, 6 months, it's tough to say markets will run away. If you're talking a 1-2 year view, there's enough building blocks for us to be positive on markets.
Is that the view on the global markets as well? That globally things are, because there is a lot of challenge, right? Inflation is still high. The 10-year yield is at almost at 4.7. How are you looking at the global markets right now?
But those building blocks have been there. The rates as well as inflation have been around for a while, and markets have still done well. Now, it's not been as broad-based a market globally. It's been much more narrower. But the broader market, even growth in general, is still holding up. So as a house, we still remain constructive. We're not shouting caution out there.
Gautam, but even you said I don't see a big rally or runaway kind of a move, but stocks are running away, isn't it?
Yeah, absolutely.
Right?
Yeah.
So it's almost like this weird feeling that the Nifty is not moving, but everything is moving. Everything, whatever needs to move is moving. It's not like anything is waiting for permission, right?
Yeah, that's how markets are. There's always some bull market somewhere or the other. But a point being, like,
but isn't it mostly good? I mean, you've got the large caps not moving, so the Nifty is not moving. But that's about it, right? Yeah. Otherwise,
absolutely. So Nifty, if you look at the composition of the large caps, again, they are the ones which have the relatively lesser growth out there.
Yeah.
So it reflects the fundamentals. So,
it's not a poor market outcome at all, right? I mean, it's been of course, if you're invested in a large cap fund or, your only old portfolios in large caps, then it's a different matter. But otherwise, and it's not even like a sectoral kind of it's a very stock specific.
Very stock specific.
Right?
Very stock specific.
Yeah.
You'd struggle to find there was this power, electrification kind of as a theme which came and that ran for a long time, but now even that is kind of sort of tapered off, right? So very, very individual.
The reason for that also is a lot of the themes which have come up in the last 6 months, 1 year are coming up. They are in the Indian market context, not very large. Like power, if you compare to say oil and gas or consumers or financial, it's still very small. We've talked about industrials, defense, in the context of overall markets, they're still small. So they can't in themselves drive the broader
Maybe it's
markets.
also that, as I think we had Harish Krishnan from Birla yesterday with us, and he was saying that, he started by saying, we asked him what he liked. And he said, well, let me tell you what I don't like. And he said defense, capital goods, and there was one more name, right? Which
Capital markets?
Capital markets.
Defense, yeah.
Right?
He
Capital
doesn't like
markets,
them.
defense, and I forget now. But the point is that it's almost as if these sectors, right? I mean, wherever there's been this tailwind, this broad consensus view, they've all done so well that they're kind of maxed out, isn't it?
So at a broad
unless
sector,
you have a very long view from here.
So there are two things here. One is it's easier to have longer term views in some of these sectors. The runway for growth is much more longer and visibly longer, not just hope, okay, for all the three sectors. And then when these sectors have a big run, like they all have had, then it becomes very, very important to not miss the long-term visibility, but also not get carried away. Therefore, you become more stock specific. So even say capital markets or in defense, our analysts these days are recommending selective stocks, not go all out. He was very bullish 6 months, 12 months back. Now he's becoming selective. And for both capital markets and then that. So you have to become selective at this level.
Capital market, capital goods.
Capital goods.
Capital markets, capital goods and defense.
Two capitals.
Like analysts is bullish in power also. We have seen some tapering off, but the underlying long-term thematic is very powerful.
But Gautam, how are you feeling about IT? Because that's seen a comeback this week. Even the mid-cap ITs actually outperformed frontline IT this week.
So look, the way I'll put our analyst view, and I'll give you overlay that what we are hearing from clients. Our analyst has been cautious to neutralish. Again, depending on the investor, some investors want overweight, underweight calls. So there are stocks he likes, including the smaller, more nimble ones rather than larger ones. But he has a buy recommendation on the large ones also. What's changed in the last 3 months in terms of our discussion with clients? There are many more clients, including some global ones. The local ones have been on that camp, but including some global ones who are challenging the structural bearish argument. So the local ones have not necessarily been in that camp. They've been mixed back. Global ones, global clients till 3 months, 6 months back were in the doomsday camp almost. But we are seeing a lot of debate out there. Our analyst has done few trips talking to GCC leaders, talking to AI native companies, AI product and model enablers. And the feedback you're getting is a very coordinated feedback now in the last, I would say, 2 months, that IT services have a lot to do in the broader business ecosystem. Where it's still unclear, that's why our IT analyst is not bullish, is more cautious and neutralish kind of thing, is with all this translate into meaningful revenue and earnings growth or not. Because till then, stocks have corrected and then rallied back. They're still at multiples which are building in good amount of growth long term. So that disconnect is still there, but at least the business model, I think there is enough comfort, challenge from the pessimistics and comfort from our channel checks that at least for the foreseeable future, IT services companies have a good role to play.
No, Coforge has gone from 1,100 to 2,000, right?
Yeah, in 4 months.
It's just, so you can look back and say, well, that was the point that you should have bought. But there was, as you say, but it's interesting. You're saying globally, maybe because they're also closer to what's happening, all the change, etc. They're turning a little more constructive.
I think some of these global names as well, Accenture, Cognizant, they're up 50-60% or thereabouts. So, from bombed out levels, they have bounced back. So tech is one sector that we just discussed. What about the other one? The ignored sector, when we talk about consumption, bulk of the sheet is optimistic on discretionary. But I think you have a bit of a contra view on staples as well. The ignored sector, not grown, no money made whatsoever, trading at probably levels when the Nifty was around 15,000-16,000.
Exactly. So our analyst is constructive on both staples and discretionary. Discretionary, I think, is fairly consensus out there. Staples part, and I won't say staples as a sector is thematically bullish, but for most of the companies, what's happened in the last 3-4 years is these companies or incumbents have seen the pressures from a slowing economy, slowing market, and I think most of them have a strategy in place, which some of them are already delivering, of how to navigate this and still grow. So we're seeing the analyst is bullish based on the specific company of either new product launches, restructuring of the entire distribution value chain, or just focus on volumes rather than just margins. And they're reaching that point where it starts showing up in earnings. So depending on the company, But across...
So give us a little bit of hint in staples.
No, I can't talk about Indian names, but again, if you look at the larger FMCG names, some companies have focused on volumes very clearly. Now, when a company starts talking on volumes, it's always a trade-off between margins and volumes, which means you might show volumes, but earnings doesn't show up. But once you have spent time with that strategy in place, that volume growth starts translating to earnings growth also. So and that's the phase we are reaching for many of these names.
A couple of years back, I remember there used to be this talk that and FMCG has been underperforming for a long time. But when the underperformance started, people were saying, well, the consumption basket has changed. People are not spending on the same kind of things anymore. I'm not sure if that. I was skeptical then. I'm not sure if that is the reason why, or maybe it is true. I don't know.
That would have been true 5 years, 10 years back also, in a way. Like
but
spending
this is right after, after COVID, or maybe a little 2 years after COVID, when they were saying, well, and it almost felt like, the argument that people don't want to spend stuff on things but experiences. So it almost was a,
but I guess the one theme which is playing out, probably maybe you can throw some more light. Any business which is into B2C, and where earlier it was the distribution reach was supposed to be a big mode. That seems to be out of the way now. Whether it's banks, whether it's consumer names, FMCG, is that really playing out in terms of valuation, in terms of the fact that now there is not a mode which people want to give now?
So that was a theme for last few years, not new per se, and the ability to reach
and
directly.
you're going to see increasingly that trend across all the B2C companies.
But what's also happening, and that's what the entire evolution of these companies are, that they also adapt to that model. That rather than just relying on the traditional distribution mode, you adopt by bringing your own suite of brands which cater to this need. So,
what's the view in private banks, Gautam? Because they've also underperformed. Like an HDFC Bank has done nothing for the last 5 years. Even others have really underperformed. The fact that the building blocks are here in terms of domestic liquidity, in terms of macros. You think it's time for them to come to the party?
We've been saying that for a while, and now it's not worked for us also in terms of the recommendation. I think it's a very consensus view also out there to be positive on financials. It's one of the rare sectors in India which has the comfort of valuation, very rare sector.
It has been a very comfortable opinion to hold.
Exactly.
But it's not been a very profitable opinion.
It's not worked. At least for the last, forget the bank you mentioned, but in general, it's not worked. Earlier, at least some of the large banks were working, but the last few quarters, even that's not working. I think the key is not just them being back because the macro growth is coming back. That's, I think, well known. Question is, will they be able to deliver? Like large private banks, if you look at the last 25, 30 years, they have always grown at more than the system credit, more than the market growth, and delivered superior earnings in a way, which actually has not been the case.
What's the UBS house view in terms of rate hike for second half of this year?
So our view is base case is status quo.
Status quo.
We're not in the camp that there will be 50 basis point rate hike. So that's a scenario for us, but a base case is status quo. Even though you could argue real rate, etc., are in the zone where you could argue for a rate hike, but that's not our view now.
Okay, I think we'll take a quick break here. I think UBS has initiated coverage on Urban Company this week, and we'll maybe come back and ask Gautam about that. Some new initiations. Stay with us.
Well, welcome back to Editors Roundtable. The big theme for this year has been the fundraising which has been done not only by the government, but by the private names as well. So it's been a record start to the FY27. And this is something which is likely to continue for the entire year as well. So first look at the government and what they've done since the beginning of this fiscal year. Almost 55,000 crores of fundraising has been done via OFS by the government as well. The top of the list is LIC. The government sold 6.5% stake and raised 31,500 crores by selling their 6.5% stake. Coal India, they sold 2%, raised 5,000 crores. IRFC, 4,600 crores. NHPC, GIC, again 3 to 4,000 crores. And the list is Hindustan Copper, Central Bank, Cochin Shipyard as well, between 17 to 3,000 crores. So this is a long list of companies where the government has sold stakes since April and have raised close to 55,000 crores. Not only this, look at the India Inc. And within the India Inc., it's basically the promoters and the private equity who've sold big stakes and have raised a massive amount of money. 65,000 crores and counting is the number for the India Inc. in terms of promoters and Ps who've sold stake. Top of the list is Adani Group. Across all the Adani Group names, whether it's energy, enterprise, solution, the group has raised almost 13,000 crores by selling stake. Lenskart is another name. Private equity has been a seller in that name. Despite strong Q1, the Ps have sold and they've raised close to 10,200 crores. Grow is another platform business where Ps have sold close to 5,700 crores. So is Paytm, so is Avenue Supermart as well. Some interesting mid-cap names as well, which have come in the list in the very recent block deal data. Rubicon Research, the private equity General Atlantic sold nearly 8% stake and raised 2,300 crores. Welspun Corp, after a big up move in that stock, the promoter sold nearly 1,500 crores worth of stake. So is the case with VR Scientific as well as ICICI Pru AMC, where the Prudential sold recently 2% stake. So that's a long list of even companies where private Ps and promoters have sold stake and have raised money. So this has been a big trend and been a bit of an overhang as well as far as capping the upside in the near term, because there is so much of supply of paper, both from government as well as from the private name. So Gautam, your take on the government actually now warming up and selling some stakes, and LIC has done well, right? I mean, despite big stake sale, the stock has done well. What's the broad sense in terms of supply of paper which is hitting the market?
So not just government, it's supply of paper broadly. We've been seeing for the last 2-3 years private equity and sponsors selling. We have seen promoters selling. Now the government is also jumping in. So there are two things here. One is a great thing because it shows the liquidity inherent in the market for all the different participants. But it also means it is providing some kind of cap on the market performance. But it's not a cap which is depressing valuations. It's just a cap on markets moving from, say, fairly to richly valued to crazy valuations. So, but it is a cap. And that's been that's one of the things we've always been seeing, that beyond growth and valuations argument for India, this liquidity on both sides, the local mutual funds liquidity as well as capital supply, paper supply, is going to be, still is, and I think will still be for the next 2 years, a big factor for markets.
I wanted to touch upon healthcare because that's one sector that you'll look at quite closely. Manipal, we were just discussing, has crossed 1 lakh crore in terms of market cap, and it just listed in the first week of August. So it's what, a 36% rally just from the time it listed. What is your view on healthcare? Do you think that the hospitals are the space to be, or do you think that they're overvalued at this point?
Look, on a headline basis, healthcare inherently will appear rich because they're in a growth mode. The hospitals, the underlying assets take time before they mature and reach the sustainable margins and levels. So that's our analyst always has screens and tables to show headline and the underlying levels. And if you look at underlying levels, it's not that rich. And across the board for healthcare. If you believe in the growth runway, which I think is difficult to argue against, the growth runway is long and broad for Indian healthcare, both in the penetration as well as the affordability, etc. So I think it's one of the easier sectors to be bullish on, which has delivered returns, and I think investors are still looking at it very, very closely.
Last 4 years, the CAGR return has been, Max has been top tier. Is some 45% CAGR. Exactly. This is from the close of 2021.
That's the whole COVID private equity rally that took place.
And we had an interesting view from a fund manager who's sitting right where you were sitting 2 weeks back. Lalit was here.
Kumar,
and his view was slightly different. His basic point was that this moves in cycles. This is the second big phase where hospitals are adding capacity. Some 30,000 beds will come up in the next 4 or 5 years. So, the last capacity addition resulted in very good profits, etc. And that's why you saw these returns. And now you're going into another big sort of capacity addition program. So, I mean, that was.
So I'll qualify that. So the difference now versus the last one, and I remember the last cycle also. Last cycle, there was some debate and doubts about whether this expansion is actually going to be profitable or not. Can the hospital companies execute on this expansion or not? I think the difference now versus the last time is the confidence in these companies to execute.
Execute, and the demand is there.
Demand, I think, is difficult to argue against, but execution capability is very, very well proven now. And the profitability that, okay, you expand and that convert that into threshold margins and IRRs, that's proven now. So it's the other way around. Now it's something has to go wrong for the thesis to not work.
Do you have that same optimism towards diagnostics? Because we had Metropolis, which came out with a very positive investor meet.
Yeah. So we are very bullish on diagnostics also. Again, not individual names, but broader sector. Again, the opportunity set is still a long way to go. Penetration, the range of diagnostic services which individuals take as a society, as well as the informal to formal. All the three drivers remain in place.
Gautam, before I let you go, on the broader markets, given that there is so much of momentum, is market losing the focus on valuations, only looking at growth and giving any sort of valuation for this company? Because, even from the list of the blogs that I highlighted, something like a Rubicon Research came at 450 rupees, at 1800, 100 times on TTM, 8.5% getting sold, and a lot of the mutual funds bought. Are you worried about valuations in the broader markets? So that's been ignored?
Yeah, parts of market, yes. Without getting into individual names, again, parts of market, it does look, it's a run up too fast. Where valuation multiples, but again, the question is for any company, even if it's 100 times, if the growth runway is going to be very high for visibly, it can be justified. But yeah, we parts of market we are worried about. But again, that's very typical of market cycles.
Yeah.
When you have liquidity and sentiment going up, while the broader growth is still not visible, wherever you see growth, investors will chase. We've seen that multiple times in the last 3 years itself.
Okay, all right. Well, we've run out of time, Gautam. Thanks a lot for coming down and giving us your inputs on all of those sectors as well as themes. Well, on that note, though, it's curtains down on this edition of Editors Roundtable. You stay tuned to CNBC TV 18. More news and updates on the other side. Goodbye, and thanks a lot for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Death toll in the devastating flash floods in Nepal and Tibet rises to 538. Over 1,000 people still missing. This includes close to 300 Indian nationals who remain untraceable. Rescue operations were halted for some time after a lake formed by a landslide on the Nepal-China border started to overflow. Iran agrees to draft conditions to reopen the Strait of Hormuz after Qatar steps in to revive diplomacy. Crude oil prices set for a weekly decline even as Brent moves closer towards $90 a barrel. Sensex and Nifty decline for the third straight week. This is the longest losing streak in 5 months. Rupee strengthens marginally against the dollar but remains above the 95 mark. Thursday's wild swings on the Sensex deepens. The scrutiny around the new closing auction session. SEBI chairman rules out any changes to CAS mechanism despite trader complaints of a casino-like 10-minute window deciding options payouts. Stock markets tread with caution across the world ahead of a speech by U.S. Federal Reserve Chairman Kevin Warsh at the annual banking symposium in Jackson Hole. CNBC TV 18 will bring you the speech live at 7:30 p.m. tonight. India agrees to buy Javelin anti-tank guided missile system from the U.S. The missiles are jointly made by Lockheed Martin and RTX. U.S. Ambassador to India Sergio Gore says there is tremendous potential for defense cooperation. Kumar Mangalam Birla calls FY27 the year of execution and delivery for Vodafone Idea during the company's annual general meeting. Says capex orders worth 9,000 crore rupees placed already. Also reiterates telecom industry's call for periodic tariff rationalization. A U.S. federal judge rules sanctions imposed on Anthropic by the Pentagon are illegal and unlawful. Judge says empty invocation of national security is not a blank check to punish critics of the government. All right, the top story this evening, the death toll in the flash floods in Nepal and Tibet has crossed 500, with bodies being recovered far downstream. More than 100 people are still missing, including over 300 Indian nationals who remain untraceable. Rescue operations were halted for some time after a lake formed by a landslide on the Nepal-China border started to overflow. The police in Nepal also issued an alert saying a dam on the Tibetan side may have burst again. The police asked rescue workers and public to move to safe locations. Nepal has declined offers from several countries to deploy search and rescue teams. South Korea's foreign ministry said it will keep negotiating with Nepal over the matter. As per the reports, the decision is partly based on the country's experience after the 2015 earthquake, when arrival of foreign teams had led to challenges in coordination. Nepal is instead asking countries willing to help to route financial contributions through a single mechanism. Prime Minister of Nepal, Balendra Shah, held a cabinet meeting to discuss the next steps for disaster relief. Meanwhile, External Affairs Minister S. Jaishankar took stock of the rescue effort in Nepal by speaking to the embassies in Kathmandu and Beijing. My colleague Arunima reports from Kathmandu on what has been a nightmarish 72 hours for families who are still awaiting information on their loved ones.
हमारे फैमिली में 5 जना नहीं है। हम लोग तो भागे, सब छोड़कर भाग गए हम लोग।
We are at the Maharajganj Medical Campus. This is the main hospital here in Kathmandu, where family members are now gathering to figure out as to if there is any information. Now you see the main gate of this medical campus, where whatever body has been found, they have put up pictures of those dead bodies with information that they have about from where these bodies were recovered, so that people can find out if this belongs to their loved ones. And you see so many family members here. आपके जो भाई थे वो इंडियन टूरिस्ट को लेकर गए थे, हाँ, कैलाश मानसरोवर की यात्रा पर लेकर गए थे उनको।
पहले रसवागढ़ी उधर गया था।
रसवागढ़ी गए थे। और वो टूरिस्ट जो थे उनका कुछ पता लगा? वो स्कॉर्पियो में गए थे?
कोई पता ना लगा, कुछ को मालूम ही नहीं। सब संपर्क भी नहीं है ना, कुछ क्या है कैसा है वो मालूम नहीं।
बच्चे बहन का बच्चा 3 है, एक लड़का 2 लड़की है। अभी वो मेरा बहन का क्या हस्बैंड अभी 3 दिन तक हो गए, अभी तक कॉल नहीं लग रहा है।
हॉस्पिटल से कोई कुछ बता रहा है अंदर से? हॉस्पिटल में कोई कुछ बता रहा है कि क्या है अंदर?
नहीं, हमारा कुछ कोई नहीं है, जो भी है ये लिस्ट में है, तो अभी लिस्ट में नहीं है, अभी दूसरे हॉस्पिटल में ढूंढने जा रहा हूँ मैं।
There are such families everywhere. They're all waiting to see if they can gather some information about their loved ones. And this is the situation not just at this Kathmandu hospital, but hospitals across Nepal. NDRF has been on standby throughout, but they were waiting for the Nepalese authorities also to reach out if they required more assistance. So as and when officially that communication goes from Nepal to India, India, we are told, is ready. Already relief material is landing here. Like I was telling you, we spoke to the NDRRM, the Nepal Disaster Management Agency here, and they said, we have enough material. What we are now looking for is also body bags, because downstream there are a lot of bodies that are still being found. Even though the epicenter is Rasuwa on the Nepal-Tibet border, bodies have been washed downstream, and it's a tough ask to ensure that you collect all the remains of one particular individual in one body bag so that DNA testing becomes easy.
All right, on to the West Asia conflict. The deadlock between the US and Iran continues as Qatar attempts to revive diplomacy. Here are the latest developments. Iran has agreed to draft a set of conditions to reopen the Strait of Hormuz, citing requests from mediators. Qatar's Prime Minister met several top officials in Tehran in a bid to break the standoff. Traffic at the waterway remains choked with only 7 vessels transiting, according to the ship tracking site Kepler. But despite that, crude oil prices are set to drop this week after the US pivoted to economic pressure. Qatar's Prime Minister met Iran's president, who's scheduled to visit India next month for the BRICS summit. Qatari officials said the talks will focus on reviving diplomacy and reopening the Strait of Hormuz as per international law. Qatar's Prime Minister also met Iran's Foreign Minister Araghchi to push for diplomacy. After the meeting, Araghchi said, and I quote, "Putting diplomacy back on track isn't impossible. It hinges on US understanding of one simple fact. Pressure doesn't work," end of quote. Amidst all this, Washington continues to claim Strait of Hormuz remains open. US President Donald Trump said millions of oil barrels are passing through the strait daily. He also ruled out any negotiations with Iran. The US President's comments were also followed by a rare video address by US CENTCOM Commander Admiral Brad Cooper, who also claimed that US forces have cleared mines from the Strait of Hormuz.
About Iran? There's not a lot to speak to. We don't want to speak to them. We're not looking to meet or anything. The strait is open. We're taking a lot of boats. Millions and millions of barrels of oil are coming out of the strait every day. Other countries recognize that. Every once in a while they shoot some, they put some shots out. We totally cleared the strait we have the best minesweepers in the world.
The U.S. military has achieved a major milestone in the Strait of Hormuz. We have successfully cleared sea mines in the Strait's international shipping lanes that were laid months ago by Iran's Islamic Revolutionary Guard Corps. We have been highly effective. No ships have entered or left an Iranian port without our permission, and we have only allowed ships to pass through on humanitarian grounds, which is a credit to the dedication and professionalism of our sailors, Marines, and airmen in particular, executing this complex mission.
Right, on to the day's market action. Sensex and Nifty declined for the third straight week, marking the longest losing streak in 5 months. This despite a positive close on Friday. Midcaps and the IT index managed to buck the trend. In fact, IT was the top performing index this week. Wild swings on the Sensex yesterday has prompted fresh scrutiny around the closing auction session. Sensex plunged more than 2,000 points in the final minutes yesterday during the monthly expiry of the futures and options contracts. It managed to recover soon after to end with losses of about 250 points. Many traders expressed anguish, saying the new system is akin to a lottery, but SEBI chairman remains firm on the closing auction session and ruled out rolling it back or changing it.
नहीं, अभी हम कोई चेंजेस नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी ऐप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever has to do and it has no relevance, then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well.
The Finance Industry Development Council has urged the Reserve Bank of India to reconsider its proposed blanket restriction on revolving credit products offered by NBFCs. The industry body warns the move could have unintended consequences for borrowers, particularly MSMEs. Now, FIDC says some NBFC credit products may not qualify as term loans under the RBI's proposed definition, but they also do not work like credit cards or bank overdrafts. India's telecom sector saw a pickup in subscriber additions in July, with net additions rising to 55.4 lakh. Airtel's net subscriber additions moderated to 27 lakh in July when compared to June, but still remained the highest in absolute terms. Jio saw additions rise to 24.5 lakh. Meanwhile, Vodafone Idea and BSNL added 2.4 lakh and 1.69 lakh subscribers, respectively. Vodafone Idea Chairman Kumar Mangalam Birla has said that the company has moved into a new phase focused on execution and growth after overcoming several legacy challenges. Speaking to shareholders at the company's annual general meeting, Birla said the first quarter of FY27 was the first quarter of net subscriber additions since merger. He added the company is better positioned to take part in India's digital growth opportunity. He also reiterated telecom industry's call for periodic tariff rationalization. Shares of Ather Energy surged after Hero MotoCorp increased its stake in the company. Hero has invested another 1,700 crore rupees for a 3% stake, taking its holding in the EV two-wheeler maker to 32.8%. This comes just a month after Hero invested 1,000 crore rupees for a 1% stake. Fed Chair Kevin Warsh is set to deliver his first keynote address at the annual Jackson Hole Symposium later today. Investors are closely watching whether Warsh would offer details on the US economy, bond markets, and the outlook for monetary policy. According to a survey by CNBC, 80% respondents want the Fed Chair to offer his views on the economy, but they are split on whether he should provide his views on the rates. CNBC's Steve Leisman is here with more on what to expect from the speech.
The Fed chairman's speech in Jackson Hole is always listened to carefully for clues about his outlook for rates. Will he be hawkish? Will he be dovish? This year, markets are listening for whether Kevin Warsh talks about policy at all. He's held back on his views to get a cleaner message of market pricing not influenced by his own Fed speak. But Warsh's colleagues in CNBC interviews here in Jackson Hole have not been shy about offering their outlooks.
I believe now is the time to act. I believe that we've been in an inflationary situation for more than 5 years. It's been running well above our target. I don't see any restriction in policy.
I think we may be a little bit more accommodative, certainly more accommodative than restrictive in the policy rate.
Schmidt did say he thought Fed officials could talk less, while Hammack offered it was her responsibility, she thought, to share her policy views. Tobias Adrian from the IMF writing, quote, broader communication about reaction function remains essential as long as it is conditional, disciplined, and uncertainty aware. Risk should be clearly spelled out. Warsh may give markets at least some of what they hope for tomorrow, potentially making a distinction between what he's willing to say in a speech on his own compared to when he's representing the committee after a meeting of a press conference. Steve Leisman, CNBC Business News.
And you can catch the Fed Chair Kevin Warsh's address in Jackson Hole from 7:30 p.m. onwards right here on CNBC TV 18. Finance Minister Nirmala Sitharaman and her Canadian counterpart held the first India-Canada Economic and Financial Dialogue in Toronto. Talks focused on digital payments, financial services, and wider cooperation in issues of shared interests. India expressed its readiness to initiate negotiations on a bilateral investment treaty at the earliest. Both sides welcomed opportunities to broaden the use of UPI in Canada through partnerships with payment service providers. The next economic and finance dialogue will take place in 2027.
The economic and financial dialogue reflects this broad ambition to move beyond traditional trade in goods and services and build a deeper economic partnership encompassing investment, finance, capital markets, and regulatory cooperation.
Canada and India are uniquely complementary. Canada can provide energy security and food security to India. And India can provide to Canada scale, talent, and technology. So I must say that this was a very, very fruitful morning in the launch of the dialogue.
All right, we'll take a break. Coming up, India agrees to buy a Javelin anti-tank guided missile system from the US. Details and the significance of this deal in just a bit. Welcome back. US Ambassador Sergio Gore has said that the Indian Army has signed a letter of acceptance for the purchase of Javelin anti-tank guided missile systems. However, there's no official statement from the Indian side yet on the agreement, but the deal has been in the making for a long time. Aishwarya joins us with more details.
After over 15 years and multiple rounds of negotiations, the Javelin is finally headed to India. The US ambassador to India announced this morning that the Indian Army has signed an agreement to take forward the purchase of the Javelin anti-tank missile system. This deal has been years in the making. India first began looking at the Javelin system in 2009, and negotiations began, but they sort of fell through because we were keen on technology transfer. Thereafter, India explored other options, including Israel's Spike anti-tank missile, while also building our own indigenous systems. Talks on the Javelin were ongoing, and the conversation sort of shifted from just buying the missile to potentially building it in India. Thereafter, at Aero India 2025, Bharat Dynamics signed an agreement with Raytheon and Lockheed Martin-owned Javelin joint venture to explore the joint manufacturing of the Javelin in India. Then in November, the US cleared the possible sale of 100 Javelin missile rounds and 25 launch units to India. And now the Indian Army has signed the letter of offer and acceptance under the foreign military sales process, formally taking forward the purchase. The US statement also says that the agreement opens discussions on the co-production of the missile, giving it a Build in India angle.
All right, thank you, Aishwarya, for that. Moving on, sugar prices have surged to a record high, with retail prices rising to around 70 rupees a kilo. Lower domestic production, festive demand and tighter stocks are adding to the pressure. But the ethanol diversion debate has also come into focus. Santiago has more.
Sugar prices have surged sharply over the last month. Government data says retail sugar prices have gone up from 48.18 rupees per kg on 20th of July to 55.7 rupees per kg on 20th of August. By 27th of August, this has risen further to 70 rupees per kg. The government attributes this to lower than expected domestic production due to damaged crop, festive demand and instances of hoarding. It expects this season's production to come in at 306 lakh metric tons instead of the initial estimate of 343 lakh metric tons. But the opposition says the government's ethanol policy has exacerbated the shortage. The Department of Food and Public Distribution says that in 2022-23, available sugar stocks stood at 443 lakh metric tons. 43 lakh tons were diverted for ethanol blending, leaving 400 lakh tons for domestic consumption, more than enough to meet that year's domestic demand of 280 lakh tons. In 2023-24, sugar stock fell to 401 lakh tons, and the government stepped in, telling OMCs to keep sugarcane juice and B-heavy molasses for ethanol within the cap of 17 lakh tons. For that entire season, only 24 lakh metric tons of sugar was diverted for ethanol, and there was enough to meet domestic consumption. In 2024-25, however, despite available stock coming in at lower at 375 lakh metric tons, no such intervention was seen. 35 lakh tons of sugar were diverted for ethanol that year. In 2025-26, however, despite production estimates being slashed to 306 lakh tons, 30 lakh tons of sugar have already been diverted for ethanol blending between November 2025 and July 2026, and the season still has 3 months to go. Experts say that unless the government issues a fresh order capping diversion, the sugar available for domestic use may be squeezed. Crystal has also flagged the situation, saying, and I quote, consecutive declines in sugar production due to lower yields and reduced acreage coupled with higher diversion of sugar equivalent towards ethanol significantly tightened inventories despite steady growth in consumption. Ethanol diversion has increased consistently over the past 5 years, rising from 0.8 million tons in sugar season 2020 to more than 3 million tons in sugar season 2026, with further increase expected in sugar season 2027, end quote. However, the government maintains that sugar diversion for ethanol has reduced every year from 12% in 2022-23 to 9% in 2024-25, and that 3/4 of the ethanol produced in the country now comes from grains. It further says, and I quote, this initiative also supports farmers by providing them with a stable income and reducing greenhouse gas emissions. However, this does not mean that ethanol blending would lead to a shortage in sugar for domestic consumption. Adequate sugar stocks are available in the country to meet domestic demand, end quote.
Right, important developments there. With that, it's a wrap on this edition of Business 360. News and updates continue right here. Thank you so much for watching.
Hello and welcome to the Editor's Playbook. I'm Shireen Bhan. Iran and the United States have been locked in a stalemate for 6 months. We've seen retaliatory strikes, a tenuous ceasefire, a short-lived deal and a double blockade of the Strait of Hormuz. Iran is still pushing back against Washington's much-wanted pressure campaign. Now, earlier this week, the Trump administration unveiled what it calls Operation Economic Outcast, threatening Iran's trading partners with dire consequences if they continue to keep its economic machinery running. But, as has often been the case with the White House, there was little clarity on how exactly Washington intends to execute the threat. The result, Iran has doubled down. And China, which accounted for roughly 90% of Iran's oil exports last year, has warned that such pressure tactics risk fueling further conflict. Meanwhile, traffic through the Strait of Hormuz as we speak is barely a trickle of it once what used to be. Tehran's defiance is a major challenge for the White House, with U.S. debt crossing $40 trillion and the midterm elections looming in November. Closer home, Delhi is bracing for an all-important BRICS summit next month, with Vladimir Putin, Xi Jinping and Iran's president all expected to attend. Now, Washington will be watching the BRICS summit closely. So today we ask, will the U.S.'s efforts to isolate Iran work? Is the inflationary risk rising, and is a rate hike on the anvil? And can the BRICS grouping muster a show of strength in New Delhi? I'm joined by my usual suspects, Prashant Nair, Nimesh Shah and Sri Ramayar. Gentlemen, appreciate you joining us here on the program. As always, it's Operation Economic Outcast, and that is where the story has now moved to. But so far, the oil markets have actually pretty much shrugged it off. In fact, if anything, oil prices have come off. Commodities is another story altogether. But I think the larger message the market seems to be taking from what has happened is that the risk of military escalation, perhaps that is abating. That's less of a risk today. Prashant, would you agree?
Absolutely, Shireen. I think, as you began by saying, right, it's no longer military, it's economic. That itself is basically, in a way, pulling back because, I mean, it's regressing in that sense. And I think that is the starting point here, that I think the US for some time perhaps has known that it's reached the limits of what it can do militarily. It's now come to a point where the question now comes, what next? Can you do more militarily? And the answer, I think, has been clear for some time, that unless you are willing to commit boots on the ground, which, of course, I mean, the MAGA base of President Trump in the US is completely opposed to. I mean, actually, one of the core factors, and I think we've discussed this when we started this program, and it was around the time when President Trump had taken over in the US, one of the basic pillars was no more wars, especially no more Middle Eastern wars, right? So while, they've kind of, this particular war has been essentially conducted through the air, feet on the ground is a very, very different kind of thing. So unless you're willing to go there, which I think is very clear they're not, perhaps they won't or they don't want to, and there is a fair bit of opposition. I mean, I think if that, I think if it were to come to that, it's pretty risk negative as well. I'm talking from a financial market perspective. Now, of course, we're not talking about that, but I'm just saying this is regressing from kinetic military kind of action to now what is economic. And now, Shireen, the point is, even this economic, the D-Day and all those, the bombast, right? Iran has been perhaps the most sanctioned country for the last 4 decades, 3 decades, 4 decades, right? So there's been sanctions after sanctions after sanctions. So how much will these new set of sanctions really achieve is the question, which perhaps we can discuss and debate as well. And that's the reason why. I mean, I think these set of sanctions are basically secondary sanctions, right? I mean, of course, on Iran, but on anyone who kind of trades with Iran or kind of, buys their oil or I mean, there are that entire thing which the US put out. So there's a bunch of things there, but these are essentially secondary sanctions because the country itself has been under severe sanctions for decades now.
No, you're absolutely right. And so far, I mean, at least China has unequivocally come out and said that the U.S. is in no position to dictate terms to trading partners, and unilateral action will not be taken lightly. So China has at least gone on the record. And, you know, we had that interview with the U.S. Treasury Secretary Scott Bessent here on CNBC, where he did tell our colleagues in the U.S. that President Trump was going to make calls to global leaders, you know, getting them to support Operation Outcast. But at this point in time, you know, as you rightly pointed out, it looks unlikely that we're going to see any significant or dramatic, meaningful change over what is already in place. But, you know, let's set that aside. Let's talk about the interesting trends that the commodity markets are throwing up, that the oil markets are throwing up. Brent, as I pointed out, is now trading below 90. Yeah. But the U.S., November elections, diesel prices, that's the big one, isn't it, Prashant?
That is what matters, right? I mean, when you and I are, I mean, in our case, it's different because prices are controlled. In the U.S. at the pump, I mean, people are not buying oil, right? Crude oil, they're buying diesel. That is essentially the real, in that sense, geopolitical hedge, if I can put it in that sense. And by the way, diesel is a traded commodity. Diesel futures are traded. So it's a market out there as well. So let me quickly run you through why perhaps, and when you think about it, right, I mean, the Strait of Hormuz, it may open, I mean, it's one of those things like Schrodinger's cat, right, is open and closed at the same time, depending on who you ask and where you look.
It's open and double closed. It's open and double closed.
So let's assume that tomorrow the Strait of Hormuz opens, right? If you think about it, what is, you know, in a way, the scar tissue which will remain, even if the Strait of Hormuz were to open tomorrow, I don't think it is oil. It perhaps is diesel. Because oil, there is, I mean, I think there's enough consensus. We saw a brief trailer with, in that sense that when there was a ceasefire, oil prices fell from 100 to 70 very quickly. So there's enough oil. There's no doubt about it in anyone's mind. It's just not getting through. But if this were to open tomorrow, I mean, I think the lasting impact in that sense perhaps is diesel. And let me just quickly tell you why. And this is not new because, you know, so let's, by the way, let me just tell you where diesel cracks are right now. Diesel cracks are nothing but the price of diesel minus the price of oil, right? Diesel, so this difference right now is $100. At the average for August perhaps is a little lower, but it's right now at $100, which is the highest we've had in a while. You go back to when the conflict started, Iran-US, this number was about $73. You go back to, in 2023, it was about in the 30s. When Russia-Ukraine started, it jumped to about 73. 73 fell to 30, back to 73. Now it's about, in August 2026, it's basically at $100 or so. And the reason why diesel essentially is the commodity to watch out for and is the pain point for consumers, and then, I mean, it feeds into inflation, economies, etc., are 4 reasons, right? Very simply put. Coming into the Iran war or coming even into the Russia-Ukraine war, diesel refining was far tighter. And the reason is pretty obvious. We were moving to, a world without fossil fuels. It was all going to be renewables. So generally, there was less capacity addition as far as refining, new refining capacity is concerned. Whereas if you look at, oil, there were lots of new discoveries in Brazil, I think in the US as well. Shale has been a big phenomenon in other countries as well. That is one. Second, if you look at Middle East and Russia, the two shocks, they've hit diesel much harder. And why is that? That is largely because, I mean, it's the nature of the thing. I mean, oil is, underground, whereas refining capacity is on ground, above ground. And it's a target-rich. It's target-rich in that sense. We've seen, I've spoken to people from energy consultancies, and they've said very interesting things. They've said, the nature of attacking these refineries has also changed. Earlier, what I heard was these attacks by drones, etc., cheap drones, used to be on the, outskirts, the outer perimeter of these refineries. Now the attacks that you're seeing, especially by Ukraine on Russian refineries, it's basically hitting things which will take much longer to repair and kind of bring these refineries back on track. By the way, Russia's diesel exports are down 40 to 50%, right? So this is the second point. I mean, I don't know if you guys saw, there were these in UAE. I saw over the weekend these visuals where they are netting these these large storage of diesel and refined products, because to prevent against these drone attacks. Number 3, seasonality. You're entering the winter season. Demand for heating oil, etc., goes up. So that's pretty. And by the way, it's also the hurricane season in the US, right? It runs to all the way from August to October. And so there's a demand push, but perhaps there is a supply thing as well. And the Chinese are the biggest buyers of oil. And we saw them back, I think, in June, July, because prices had gone up to about $100. They just simply decided to buy less because they had a lot of inventory. I think they cut their purchase by some 5 million barrels and prices cooled off. What will they do with regards to diesel? The only way they can cool diesel prices is by exporting a lot of diesel out, which I don't think, it's not the plan. I mean, they want to have as much of this fuel for themselves, energy security and all of that stuff. So I think 4 basic fundamental factors, starting, of course, from the fact that the starting point was much tighter for diesel as compared to oil. So when you think about what is the lasting impact of this, even if the Strait of Hormuz were to open tomorrow, perhaps I think diesel should be, on the top of the list.
Speaking of Schrodinger's cat.
Absolutely, and I like the way that you framed it as a geopolitical hedge. I think that's an interesting point to ponder on. Sriram, you wanted to make a point.
Two points. Because you called it the Strait of Hormuz, the Schrodinger's cat. It's a quantum problem. Yeah. The problem is not whether the Hormuz is open or not.
Superposition.
Whether the quantum of oil that passes through is so just adding to that. The second point is that diesel is not the only compulsion, only geopolitical hedge. Bond yields have emerged as the US 10-year bond yield has emerged as a much bigger hedge. And now in journalism, we have this rule of 3. If something happens 3 times, then you can assume that it's a pattern. And this is the 3rd time for when Trump has folded to the pressure from bond markets. First was the Liberation Day tariff on China. The moment it went closer to 5%, he paused it for 90 days. The second was in June, when in May, we were talking about US bond yields and the likelihood of the spike. And soon after that, he announced, the moment it reached near 5%, he announced a ceasefire. Now that this was ending, the yield spiked again. And now what he seems to have done with this D-Day is essentially a last roll of dice. And this is not my term, it's a column somebody wrote, a retired colonel wrote on our platform. Please do check it out, this economic D-Day. So to that extent, I think the fear of what Trump can do to Iran is increasingly or rather decreasingly less significant, it seems, at this stage. And that's what the oil markets are showing. But at the same time, the risk aversion that it may cause, which is reflected in the bond yield, is a genuine risk even for India. Yeah. The cost of capital, how much of the fund flows do come into India. If US bond yields get very attractive, then a lot of capital flight might happen. Then you have commodity price inflation and all of that, which these guys spoke about. And I guess, Nimesh, you have that point to make.
Yeah.
So again,
Absolutely, and I think the bond market is, of course, telling you a story and has been telling you a story, as you point out, through the course of the last 6 months, as we've seen this conflict escalate and then de-escalate. But Nimesh, on the risk of inflation, on the risk of a potential rate hike coming in as early as the end of this year, and what's happening with commodities, let's piece all of that together, because let's also remember the MPC minutes that came in after the MPC met, were far more hawkish than the MPC commentary itself.
Right. So, Shireen, I'll come to the India part later, but, while we all talk about crude, diesel, for that matter, the hard commodities like copper, gold, silver and all, quietly this year, it's been a return of these softer commodities. Y2D, look at the kind of moves you've seen in the soft commodity, performances. Cotton is up 37%, Y2D. Wheat is up 36%, rubber is up 31%, sugar is up 15%, and so is soybean up 17%. So clearly, it's not only about...
Iske graphics ke saath, there should be a feels like also, like on Google Maps.
Okay.
Temperature. Sugar definitely feels more than 15%.
So clearly, the softer commodities have seen a big comeback, so to speak. And there are obvious reasons. Obviously the geopolitical risk is there, but the fact that there are weather concerns as well, the fact that the import and export has get impacted in many countries because of this war. So clearly that's playing out. From an India perspective, look at what happened to the stock prices in sugar, because that's a clear play from the global surge prices as well. The sugar prices in India has actually been on a tear, and now government has taken some actions as well. But sugar stocks are at a new highs. stocks are up. In the last 1 month, the sugar stocks are up between 25 to 40%. And we've seen a big rally in all the sugar names. And every name will come up. Dwarikesh to Dalmia to Dhampur to Mawana. Everybody's up 25, 30, 40%. Interestingly, this has got a lot of implications on not only on macros, but on micros as well, on inflation as well. Goldman today actually put out a note, and they are actually a bit worried about the consumer companies with regards to this sharp increase in wheat prices, sugar prices, palm oil prices. So it's going to have a clear impact on Britannia. That's the most impacted stock from the consumer names. So is Nestle and Varun Beverages, which got impacted because of higher sugar prices. So that's the micro impact on some of the Indian companies and Indian sectors. Macro-wise, everything feeds into inflation, right? And that's going to be a big concern. You rightly pointed out the MPC minute was quite hawkish. Interestingly, Citi put out a note just a few days back. The Citi economists had said that they are actually, bringing up their expectation of rate hikes. They're expecting by December at least 50 basis points and a possible another 25 basis points rate hike, depending upon how inflation pans out.
What's going on as far as sugar prices are concerned, and is it likely to remain elevated?
Looks like it, Shireen. So the the sugar season runs from November to October, right? I mean, that's the production season. And it's a simple kind of math that the production this time around was, the estimate is lower than what we thought earlier. I mean, that's the industry estimate which came through. There is the carryover stock from last year, which is the inventory, also perhaps was not as robust. You add to the fact that there is, of course, now, a policy push for ethanol. So there is some diversion which has been happening towards that. And you add all of this together, you got this surge which has happened in that sense. So, we were just looking at sugar prices on platforms like Zepto and whatever else. And I think if you talk to your Kirana wala, I think it's north, around 70 or depending on where you look. Yeah. So which has been actually pretty sharp. And the point is you got 2 months more, right? So that data we don't have for the next 2 months. So, but the government has allowed imports in, etc. And of course, the effort, of course, will be to ensure there is enough. This is also the busy season. So in any case, there is a bit of a price increase which you see because of festive demand and all of that stuff. It's just that it perhaps has been on top of that a little bit more.
We'll put out this video of yours and then say, "Kuch kam meetha ho jaye."
I was having this tea right now. I was wondering where's the sugar in this. I wanted some sugar.
Let's move away from sugar and focus on the big summit that's coming up, a summit that's going to be watched very closely by the folks in Washington, D.C., and that is because the BRICS will be meeting here in New Delhi. So a lot of the current adversaries, and I say current adversaries because you don't know when the relationship is actually going to turn with the U.S., but China, Russia, the president of Iran, they're all going to be here in New Delhi. The BRICS grouping and whether this can in fact be a show of strength in the current environment. What is the market, if anything, taking away from this and the possibilities, Prashant?
It'll be closely watched, Shireen. That's for sure. But how much will really come out of it, in a meaningful way, which will make a difference to asset prices, to financial markets? I think it kind of remains to be seen. The one thing from a market perspective, which people have talked about for a while, it's not new, is this currency, common currency, right? And every now and then, President Trump, since he's taken over, has lashed out. Said, well, I'm going to impose 50%, 100%, whatever, if anybody is part of this. And he's of course gone after BRICS as well. And it's not as if the original grouping was small, and of course it's a much larger sort of set of countries now which are part of this, but a common currency was never really the base case or was never really likely.
I was just plotting the previous BRICS meetings and when they happened. So 2015, July was, so it's either BRICS or SCO or the one that happened in Kazakhstan, whatever, right? The multilateral group meetings where China and India are participants. 2015, there was a meeting where Prime Minister Modi and Xi Jinping met in July. September, we had a border clash. 2016, September, they met. This was again a BRICS summit. 3 months later, in November, there was a Demchok clash. 2017, July, and 2016, by the way, there was 2019. So there is a pattern. Every time they meet, within a few months, there is China engages us in the border, and then we are forced to respond. And in June 2017, for example, it happened within 10 days of it. They're meeting in June, and then within 10 days, there was a clash. Then that was the Doklam one. So since 2020, obviously, the interactions have gone down a bit. This is the first time I think they're going to meet, in a bilateral summit. No, not the first time, the second time, I think, in post-2020.
Yeah.
So that is one thing I think the market should watch out for and see if, again, I'm coming back to the rule of 3. This time it's happened 5 times. So it is definitely a pattern. We don't know if they'll follow it up again this time. That's definitely worth noting.
Well, with the National Security Advisor Ajit Doval was in China, meeting with Foreign Minister Wang Yi, and they did, of course, they are the 2 representatives to work out the border mechanism and on either side. So there have, of course, been active conversations between China and India, and of course, this meeting was significant because it does come ahead of that BRICS summit that takes place, but both are actively engaged on putting that border mechanism in place. And of course, that re-engagement on the economic front has already taken place. We've amended press note 3 and so on and so forth. So that has already happened. But yes, as I pointed out, Washington will be watching what happens at the BRICS summit very closely. And of course, there is also that specter of the Russia sanctions bill, right? And we have to recognize the fact that Washington doesn't agree on anything currently. I mean, you cannot get agreement, consensus on anything. Look at the Russia sanctions bill. Bipartisan support, 86 votes in favor. And I would imagine that is going to be something that India and Russia will also have to sort of look at and consider. And perhaps that could be an issue that does come up in the backdrop
we were talking before the show.
Meeting. And of course, China is a affected party as well.
So I'm saying, Shireen, we were talking about this before the show, that a lot of things that are moving right now are, what's his name? Ian Bremmer tweeted saying a lot of these world leaders are acting like, they're going to stay there, they're going to be there post-Trump as well. I think BRICS summit is important.
Not acting like. He's saying that they realize that they do have, I mean, Trump's term ends, but until he changes the constitution, he cannot run again. But many of the leaders, including Prime Minister Modi, don't have that problem, and President Xi doesn't have that problem. And I think that's an important point that Ian Bremmer is making. That's an important point that I think Canada is also sending out the message, saying that they'll ride out the Trump administration and ride out the Trump presidency and hold off as far as this whole tariff business is concerned.
I don't know about the others, but Carney is definitely making the right noises. And I think he's gaining the most political mileage out of this. But I want to say this for the markets and for global capital watching this space. I think BRICS Summit is important. But right now, there is no one event that can take outsized attention. Right now, things are, I mean, this week in particular, we have sent Piyush Goyal to Japan. You mentioned the National Secretary Ajit Doval in China. Minister Jaishankar was in Russia. And this has been the most...
Finance ministers in the US.
Finance ministers in the US. And this is true for every country. Yeah. Everyone is... Asim Munir is in Iran. CIA chief is in Moscow. And some of these visits are unprecedented. Like, you can't expect... nobody expected a CIA chief in Moscow, for so long, and it happened. So there is no point in watching just one thing. I think people need to have their eyes on, and I want to highlight some of the key events that have happened in the last 3 months, which have been defining and which has brought us to this point. First, US moving its assets away from Asia towards the Middle East. That allowed China to sort of, finish its construction in Vietnam. Russia, Putin suddenly landed up in an island, a disputed island with Japan. There is Korea and China decide to take the Arctic route to send stuff. Mecca Joint Defense Agreement, the Arab countries coming together to form, some kind of a NATO, kind of an alliance. Japan opened up its military exports, which, again, we have been the first to jump at that opportunity, which I think was a huge opportunity for us, and I think we've taken the right moves. Japanese parliamentarians are in China this week, by the way. Again, unheard of, and it was so unlikely. Last year when the government changed, nobody would have expected this. Then, like I said, and Ukraine has taken the war well into Asia. Now, some of these things, the impact of these things are like Ian Bremmer says, are likely to last well beyond Trump and any other world leader for that matter.
Prashant, Nimesh, Sriram, as always, thanks very much for joining us. Thoda kam meetha khaiye on that.
Exactly.
It's goodbye. It's goodbye. And thanks for watching.
Hello and welcome to News Center. I am Ashmit Kumar. Now, the big development that we saw only moments back, the market regulator SEBI has approved the initial public offer from Jio Platforms. India's largest telecom company filed its IPO papers in June, and nearly 2 months later, SEBI has waved the green flag. And this will be a $4 billion. Now, this is likely to be the largest IPO in India so far. My colleague Rachna Dhanrajani is joining us with more details on this IPO. Rachna, thanks so much for joining us. Again, take us through the offer, the timeline, what's at stake here, and what this could translate into as far as Jio is concerned.
Well, Jio went live in September 2016. As we know it, free voice, free data. It basically disrupted the telecom industry. And nearly 10 years on, now SEBI has cleared the issue. The observations have gone ahead, and it has paved the way for what could be the biggest public offering in this country. Now, let's look at the decade that the sector's had. Reliance Comms exited, Aircel went bankrupt, Vodafone and Idea had to merge to survive. In 2020, Jio Platforms was introduced, and it raised over $20 billion from Meta, Google, KKR, Silver Oak. Many investors came in, pretty much the global money that entered the market. The valuation then was $58 to $65 billion, but today we're talking about $110 to $120 billion. Now, talking about the IPO, the structure is 100% fresh issue. There is no OFS, equity dilation of just 2.9%. And because there is no OFS, which means all the investors continue on the cap table. Now, against Airtel, Jio is still a smaller company when we look at revenue and EBITDA. But step out Airtel's overseas business, and the picture completely changes because Jio's had more subscribers, 524 million against 482, ahead on domestic revenue, and behind on ARPU, which is 214 rupees against 257 rupees. From the details now, what we know is that all the fresh money that will be raised will be directed towards debt because the company has a bit of debt that needs to be retired, and this IPO is the way to do that since there is no OFS and just a fresh raise. So this could be the biggest IPO that the Indian markets have seen so far.
Right, Rachna, thanks a lot for putting that in context. The biggest likely IPO in the Indian markets. Thanks so much for that, Rachna. But the other big story that we're tracking, the death toll in the flash floods in Nepal and Tibet has crossed 500, with bodies being recovered far downstream. More than 1,000 people are still missing, including close to 300 Indian nationals who remain unaccountable. Rescue operations were halted for some time after a lake formed by a landslide on the Nepal-China border started to overflow. As per the US Geological Survey, the disaster in Nepal was caused by a glacial collapse that triggered a flood downstream. The tragedy is also a warning for India. Both countries share a fragile Himalayan ecology where glaciers, steep terrain and fast-flowing rivers make communities highly vulnerable to extreme weather events, and human activity can compound these risks. Unplanned construction along the river valleys as well as floodplains also aggravates the issue. Deforestation is another matter. Hydropower projects, riverbed mining and growing tourism also add pressure. It has altered these fragile landscapes from Kedarnath in 2013 to Chamoli in 2021. India too has witnessed how sudden floods in the Himalayas can turn deadly, making the case for development that respects the region's ecological limits. The flash floods in Nepal is perhaps a timely reminder on how natural disasters do not respect borders and why there needs to be a coordinated effort between all the countries in the Himalayan region on protecting the already fragile Himalayan ecological ecosystem. To help us again unpack
हमारे फैमिली में 5 जना नहीं है। हम लोग तो भागे, सब छोड़कर भाग गए हम लोग।
काफी लोग लाए जा रहे हैं।
खोने नहीं लग रहे।
Well, to help us understand again the true impact of these floods and what the road ahead may look like, I'm now joined by S.N. Pradhan, former Director General of the National Disaster Response Force. Also with me is Vimlendhu Jha, an environmental activist and the founder of Swechha. Also joining us from Nepal is Shri Ram Subedi, Senior Environment Journalist, joining us all the way from Nepal. To all of our guests, thank you so much for joining us. Mr. Subedi, let me come to you first. Now, in the days leading up to this unfortunate incident, there were reports of minor flooding in certain areas of that river in question. What I want to ask is that, was there any early warning indication that the authorities could have responded to, that could have perhaps led to some kind of evacuation, some kind of protective measures for the people in question?
Thank you very much. The critical questions in this whole disaster, we are on the third day of the disaster. It started on Wednesday. And the early warning systems, lack of early warning system is one of the reasons why we lost so many of lives. Because the early warning system required high Himalayan risks, what is happening inside the glaciers, how the big chunk of glaciers was about to fall in such a massive gravity, how it created the dam downstream, and how the sudden outburst of river came. So when we talk about the early warning system, our preparedness should be ahead of the disaster. Early warning system was late to mitigate the disaster, and the force of water, the river, was such a huge scale that only half an hour or 20 minutes it was left for the people to get into the safe zone. So yes, there was a lapse in early warning system, but the establishment of early warning system, how it has to be up to date, how it has to be in collaboration with everyone, is a critical question, and Nepal should work with its neighboring country to establish a robust.
Subedi, let me ask you that question. Let me press on that issue. You mentioned the early warning system. Was there an early warning, early indication coming in from the Chinese side? And is there a need for some kind of, is there a framework already in place that allows for sharing of this information in real time between China, between Nepal? Any indication from Chinese authorities?
There are mechanisms when there is a need, when the crisis strike, when any glacier outburst that would come to Nepal, and both the authorities would sit in one place and agree to collaborate. But as you say, there is a lack mechanism where whatever happening in the high Himalayas in the Tibetan side or high Himalayas in the Nepal, so there is no permanent 24 hours, functioning, robust early warning system that would help both the countries. It is what is being discussed time and again, but that has to be the case. That's not the case.
Well, let me just come in there. We have him on a slightly patchy line, Mr.
Yes.
Subedi, but again, we get the drift of what he's trying to say, that there's a need for a robust early warning, early information sharing system, especially between the Himalayan states. Let me also get Mr. Pradhan in on this. Mr. Pradhan, you've had many, many years of experience in response to such kind of disasters. We're seeing the unfortunate visuals on our screens as well. Tell us, many in India who are watching this are asking the question, are Indian states at risk? When we look at some of the border regions of Sikkim, of Arunachal, of Bihar, of Uttarakhand, of Uttar Pradesh, is there a risk that perhaps the Indian authorities need to guard against?
I think the risk is very obvious because we are downstream of these river systems. And obviously, if there are events at the upstream areas, there will be follow-up downstream destruction. It's possible. I won't say that it is happening this time, but it is very possible. I think we are alert on that. There's no doubt that it has to be a conjoint effort of countries together, because as the other gentleman was talking about early warning systems have to be put in place. I know it is a difficult and technologically a big challenge, but it has happened. For example, I think last year in October, similar event happened in Switzerland. Alpine village called Blatten was in danger, and they were all evacuated in time. There was only one casualty because the evacuation was well in time. I don't say that the scales match. Switzerland is a much smaller scale operation, but then we have to learn from the best practices and we have to invest in the best practices.
Speaking of early warning systems, Mr. Pradhan, is the issue more a case of diplomacy, of Himalayan diplomacy, than is it a case of technology? The question that I ask is that the root cause lies several kilometers upstream from India. Is there a case of perhaps closer coordination that's needed to allow authorities such as yourself, such as the NDRF, to prepare for any untoward incident?
No doubt, because river systems and nature systems do not respect borders. So if we stand on ceremony and stand on borders and jurisdiction, then we will be lose-lose for both the countries or multiple number of countries. So what is required is a very robust system of cooperation. In disasters, I don't think ideologies also should matter. When there is need for cooperation, either we sink together or we rise together. So if that is the practical underlying philosophy of disaster cooperation, I don't think that should be compromised. Every country should come forward and with openness for trans-border cooperation.
Well, as the visuals would clearly say, that the river waters did not distinguish between Nepalese, Chinese, or perhaps Indian. But let's move forward. Mr. Jha, before I get Mr. Jha in on this conversation, Mr. Pradhan, I want to ask you a quick question. Is there an interim measure required, some kind of perhaps safety protocol to be deployed in some of the border areas, some kind of evacuation or preparedness that's required? Because many experts tell us that this incident may not be isolated, that there could be quick succession of such events. Do we need to guard against that in the form of some kind of interim evacuation, especially the border areas?
Absolutely. Like in the case of cyclone, for example, Odisha, right now where I'm located, Odisha has developed a robust system of pre-cyclone evacuation so that there are minimal casualties, single-figure casualties, and lakhs are evacuated well in time. I know it, avalanche, it's an ice and rock avalanche, and it is a different baby altogether. But there are good practices across the world. There is technology, and given the political will, everything can be put in place. But it has to be done because, as I said, a disaster knows no language of politics or no language of countries safeguarding their sovereignty in the name of handling disasters. Disaster don't respect any sovereignty or borders.
Mr. Jha, coming to you now. Again, as far as this unfortunate incident, the way we've seen the visuals there, all of us have. Tell us, is this a freak weather incident that we're looking at, which comes only once in a generation? Or is this now a modern climate reality where we have unstable glaciers that collapse into a glacial lake and then subsequently cause flash floods hitting thousands, if not millions of people?
I think, dismissing this as a freak event, as a one-off event, as just a climate event would be real disservice if we really want to learn from something like this. Because, last 5 minutes, we've been talking about early warning system and lack of one, but we are not even able to understand that there was enough warning already. The fact that similar incidents actually happened in the same area 13 months ago. In India, we had a Dharali last year. We've had instances like these from Kedarnath in 2013 to in Sikkim, to other places. So therefore, for us to understand that one is the technological mobile-based beep, beep, beep early warning system that we are talking about, and the other is that the nature has already told us so many times how to behave, and similar instances have already happened as recent as last year in India and 13 months ago in the same geography that actually got affected this time. And we need to understand that, there is a collective abandonment of science or common sense. We know that Himalayas is actually very, very fragile. And despite knowing that, the geological challenges that it actually faces, we've been going on and on and on with the developmental model that is not conducive to its geology. So today's disaster primarily is not because of, of course, it could be triggered because of the amount of water that came down or because of GLOF, which is glacial lake outburst flood in that sense. But a lot of that is because we've actually went ahead and done construction or so-called developmental activities in the river reverse way without even understanding, studying, or perhaps studying but ignoring that this kind of a model cannot happen. As that huge Chinese immigration structure building that you see is actually almost in the center of the river, erstwhile river, and the river just reclaimed its land in that sense. So one is for us to understand that. The other is that there are almost 25,000 such glacial lakes that exist in that entire area. In Indian side, there are more than 250 such vulnerable lakes, at least in Alaknanda region that we're talking about. There are almost 5 to 7 very, very vulnerable glacial lakes that might collapse, that might actually be...
Mr. Jha, we're running out of time here. I'll come back to you for a quick 10-seconder. You mentioned 5,000 glacial lakes. The question that many are asking is, can we see more of that in the days to come?
Absolutely, absolutely. There might be, because, at the end of the day, the challenge that was faced by this glacial lake is faced by many such lakes. At least 250 of them are actually on the verge of collapse because their wall is really, really weak because of global heating that is actually happening at that altitude.
Well, again, serious questions. Those Mr. Jha pointing out 5,000 glacial lakes, 250 of them potentially could be on the verge of collapse due to climate change, due to heating of those glaciers. I'd like to thank all three of our panelists. Again, an unfortunate moment for the region. We hope and pray for all those who suffered the impact, as well as the families of those who suffered the impact. But I'd like to thank all of our panelists for joining us. On that note, let's slip into a very short break. But on the other side, we take a closer look at Jnani's sovereign AI push with CEO Ganesh Gopalan and CPO Bharat Shankar. Stay tuned. Welcome back to News Center. Now, AI-focused company Jnani has unveiled an end-to-end sovereign AI stack, Artha. This includes an Indian language model supporting 11 languages for enterprises, along with AI agents designed to perform enterprise and government tasks. So, why is this significant? What does this large language model bring to the table? And how cost-efficient is it? I spoke with the CEO, Ganesh Gopalan, and Chief Product and Engineering Officer, Bharat Shankar, earlier today. Listen in to that conversation.
Sovereignty is control over intelligence, right? Every entity today, right, whether it's a government institution, whether it's a private institution, every bank, every insurance company wants control over their intelligence, right? And because of this, need for control over their intelligence, we are bringing out a bunch of models, right? First and foremost, we call it Artha. Nani Artha is our overall sovereign infrastructure, right? We have another model called the EVON 3.3, which is a large language model. It's a 30 billion parameter model. And we'll talk more on this as we speak. And we have Plexus, which is our agentic AI platform. And all this put together, and not just one element, will solve this element of sovereignty that I spoke about.
How does this solution become perhaps the more lucrative option for an Indian enterprise?
See, that's a good question, right? And so what we've been seeing is, in the last couple of months, a bunch of Indian enterprises have been asking me, right, the same question, saying that, look, today we want control on our intelligence, but we use a frontier model, and we are worried that, whatever intelligence that we have is actually getting shared with many of our competitors, right? So what's the solution to this, right? And they were actually, some of them said, look, we are worried. I mean, what's the option? Should we look at Chinese models, open source models? But then, that's not a good solution either, right? So this is an answer to some of those questions, right? So what we are releasing is open source, open weight models. What it means is that every researcher in the country, every developer, every bank, every financial institution can take these models and run it on maybe a single node.
Bharat, I want to get your sense. This is a 30 billion parameter model. Where does it sit in terms of cost efficiencies? Because that's one question that Indian enterprises will be asking.
Right. So 30 billion parameter model by itself, right, falls under a large language model category. But where this model sort of shines is that because of the architecture. So this is a mixture of experts architecture. So what it means is that even though it is a 30 billion parameter model, the active parameters that get loaded at any point, right, is just 3 billion parameters. And they are sort of chosen based on the use case, based on the need. So what it means is that you are getting extremely high token throughput, right? And the way the models are trained for some of the Indian languages is that we are achieving the best possible token fertility scores, right, for Indian languages as compared to any other model of comparable size. So what it means is that to generate the same set of output tokens, the model consumes a very less fraction of input tokens. So which means that the cost naturally goes down. And since the active parameter size is just 3 billion parameter, what it also means is that the whole model can sort of fit in and load, right, in a single card, right? So which is also extremely sort of important when it comes to cost efficiency as a topic as well.
Can I just add on that? Please.
So important point here to note is we look at this benchmark of Indian language understanding and cost of compute, right? When you look at both these metrics together, right, we have the best benchmarks in the industry by far, right? And this beats some of all those models.
When you look at the runway, do you see more excitement coming in from the private sector or perhaps from the public sector?
I think it's going to be all over, right? So I think, the public sector is also not to be toyed with, because if you look at our problems in fundamental problems in education, healthcare, right? You will see that all these models will start to play a part, and some of the initial hesitation in adopting, I would say, new AI projects could be, fear about, data security, fear about model security. Now with these open source, open weight models by homegrown companies like us, which are backed by the India AI mission, will give government departments as well as private entities the confidence that they can now go ahead and, if necessary, build fine-tuned models based on what we provide for specific verticalized use cases as well.
A lot of times there's been conversations how there's a lot of excitement at the C-suite level in enterprises when they want to talk about here's the concept and let's see how it works on a pilot basis. But then full-scale deployment sometimes becomes a challenge. India is slightly behind the curve, at least that's what reports indicate. Tell us, will solutions, homegrown solutions like these, perhaps change that curve, where we sit on that curve?
So, like if we talk about the scale at which these AI agents are being deployed, our own scale, like there are about 30 million agentic interactions that we process on a daily basis. So it is the scale is sort of unheard of anywhere else, right? So what I'm trying to tell is the agents are already proven at scale, right? And also at the same time, enterprise adoption, right? Few years, it was just a boardroom discussion, right? So where they would do these exploratory projects on AI and agentic AI, but now that has become need of the hour, right? And enterprises have realized the value that an agentic AI solution can bring into their enterprise. So the rate of adoption is pretty good at this point, and it is only going up by the day, right? And what it also means is that the scale that we operate at today, right? We will soon be operating at 3x and 4x this scale very, very soon in a couple of months down the line. So yes, adoption is happening.
How do we go about it? There are a lot of questions that are unanswered. There's talk of maybe perhaps a dedicated legislation, perhaps. We've seen some kind of tweaks being done from the current frameworks as well. What would your recommendation be? What is the best way forward? This is, of course, a new technology. We don't want to stifle its growth, but then how do we also ensure guardrails?
Yeah, I think the government so far has taken a right step in this direction, right? But not going excessively on regulation on this respect, because this is technology that will change the world, right? And we are moving in the right direction. Models like ours, again, will supplement this, because a lot of the problems that you're worried about on security are all resolved, because our models will reside very often on the customer's servers, right? So it goes far beyond any certification that you can claim to have, right? Because the models are secure in your server, so you have full control over it. And I think we are doing the right thing so far by not going overboard on regulation. Yes, as all of us learn more and more about these technologies, right? Self-governance is extraordinarily important, right? Especially when it comes to providing guardrails at every step. Certain processes and businesses we'll all learn. It's necessary to have human in the loop at multiple places, at multiple steps. Right. So I think one of it is learning over time, rather than this is not the time for excessive regulation, because it's early days in adoption of this technology. But yes, there is a very important need for self-governance, right? And for organizations, model builders, application builders to be conscious of building guardrails at every step. And if necessary, like I said, put more and more human in the loop wherever needed.
Well, a strong push for sovereignty there by Nyani. But that's all the time that we have. It's a wrap on this edition of News Center. More news and updates will continue right here.
welcome to the special edition of CNBC TV 18 Explains CAS Conundrum, and we'll be talking about, CAS, the closing auction sessions. How has it moved in during this time as well? What should you be doing as traders, retail investors? We'll be taking some of your queries as well. I'm Vinny, along with me is my colleague Mangalam, and we'll be decoding all of that with our experts as well, Mangalam.
Indeed, we will be decoding all of that. The CAS Conundrum has had a lot of the retail investors and a lot of the institutional F&O investors and traders as well in a bit of a tizzy, particularly on big days like expiry that took place as early as or as recent as yesterday itself, which was the 27th of August. The BSE's new closing auction mechanism is facing its biggest test yet, and it's triggered a fierce debate over market stability. On Thursday, which was yesterday, the first monthly F&O expiry under the new closing auction session saw the Sensex swing wildly in the final minutes, plunging more than 2,000 points to some actually even calling it a flash crash in the last 15 minutes to eventually only settle about 250 points lower. The sharp move has left market participants questioning whether the mechanism is actually improving price discovery or creating more volatility in a market where liquidity during the auction window is still developing. Some traders have gone as far as calling the closing session a lottery. But despite the criticism, the SEBI chairman, Tuhin Kanta Pandey, is standing firm. He has defended the closing auction session and made it clear that there is no immediate plan to roll back or alter the mechanism. The regulator maintains that greater participation and improving liquidity will help the system settle into place. So is Thursday's extreme volatility simply a teething issue for the new market structure, or does it expose deeper concerns around liquidity and price discovery? We'll discuss that. We'll also listen to the SEBI chairperson. But before that, let's just pull up that graphic once again of the volatility that we've seen on Thursdays in particular. Yesterday was obviously a lot more pronounced because it was the monthly expiry. But if you look at it, on the 6th, 13th, 20th and 27th, the swings have been a lot wilder. So every time there has been the closing auction session, there has been a move which has been slightly limited. Yes, it has been a move nevertheless, which is what is intended. But particularly on expiry days, which are the yellow bars as you see on your screen, they have been a lot more pronounced, which is exactly the issue that we're looking to delve into. Before we do that, let's listen in to the SEBI chief's comments.
नहीं, अभी हम कोई चेंजेस नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी ऐप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
All right, you've seen the volatility and you've seen it for the last 1 month or so, last 4 Thursdays. And we have, heard from the chairperson of SEBI himself saying that they're standing firm behind the CAS. To decode this and to see whether this continues, these are just teething troubles or there's something structural, we do have a bunch of experts who are joining us on the show today as well. Rohit Srivastava, who's the founder and strategist at IndiaCharts.com and Strike Money. Alongside that, we have Chandan Taparia, who's the head of derivatives and technicals wealth at Motilal Oswal Financial Services. Both of them joining in. Thanks a lot, gentlemen, for joining in. Let's start with Chandan first. Chandan, what have you as an institution made of this when it comes to a lot of the client orders that come in, the kind of volatility that we see on expiry days? What have been some of the issues that you guys have been facing? And do you have any suggestions to give to the SEBI?
Yeah, thanks for having me, Mangalam. So what we noticed that because of the CS, the trading mechanism and the trading modus operandi has recently changed. Earlier, people used to do the option writing with the view that option is the theta decay property and it keeps on declining towards the end. But now as in CS, participants can bid the order at 3% range, and because of that sudden spurt happens, which usually in range of 70 to 220 points in Nifty and 200 to 500 points in Sensex. So nearby strikes are getting the volatility. So what we noticed, in fact, in last 1 month, that we are advising our traders to reduce the option writing or go with the option strategy. And in fact, in last 2-3 weekly expiries and monthly expiry, we got some opportunity to go with this long strangle. Usually, as per the theory, the option buyers only make money by 33%, and that is the probability, but the scenario has totally changed. So the option writer who was really working as a system trader to make the consistent return in the market, but the scenario has totally changed. So one suggestion is that in CS, the order can be put at range of 3% plus minus to the reference price which is taken from 3 to 315 volume weightage average. If the regulator reduces the price band of 3% to let's say 1.5%, then there will be the chances of comparatively less volatile move in the last 15 minutes in the market. I worked on 3-4 points. Let me just give some sense on that. First thing is that market moves as per the put call parity concept, but as index sets, the spot trading sets at 315 to 320 and future only trades. So there is no correlation in the put call parity that time. In Indian market and other global market, we see the W kind of pattern in the volumes. But because of the CS, last 30 minutes, there is no volume, only 1 to 2% volume of the entire day is happening. So because of this, I don't think the relevant price discovery is happening in the last hour. And suggestion is how, like let's say in the bank Nifty, there are only 14 counters, same in the bank X. So one counter which is having heavy weight and more weightage to the index, if that gets the build of, let's say, matching equilibrium at 3% higher, that can give the movement of 1.5 to 2% in the index. So I think these concerns needs to be addressed, and cap of 3% if reduced, then there will be chances of comparatively less volatile swing in the CS.
Obviously, cap reduced, then maybe less volatility during the cash session is something that we could see. And also in terms of volumes, which are significantly lower, right? Rohit, coming to you on this as well, right? Volumes significantly lower during this time. I think everyone's going before this cash session, they're doing most of their volume trades. What is your suggestion here? What is maybe more can be done to improve as well? And what have you seen over this period of time with your clients as well?
I don't think this is an issue of intent. SEBI has a clear intent of bringing a global methodology to the Indian market that they want everyone to follow. So I don't see intent as the issue. I think the issue that we are all facing is in the implementation part of the story. And, we can take many different angles to it. For example, you're asking, how do you improve this? Maybe there's nothing to improve because after all, you're copying something which is being done around the world. Even the 3% limit is there in certain markets around the world. So is that the issue? Or is it really an issue of participation, which is what he's bringing out? And if it's an issue of participation, then all you're saying is that the brokers, because right now, individuals for us who are sitting and probably using broker terminals, online apps, or the desktop terminals, are not able to participate unless you have a direct NSE terminal in which you can place certain types of orders. So if you're not using a direct terminal, which is now most of the market because everybody's transitioned to online, then those systems are not able to adjust to the happenings that are there right now. And that is one source of liquidity drying up. So it's very easy to blame that part that, okay, there's no liquidity. So my simple answer would be, then why didn't we get the exchanges to implement that first? Because what is happening is that individual traders and investors who have set up systems to trade based on what was there before definitely cannot adjust to what is going on right now, and which is what is leading to the noise. You can go to any forum or any WhatsApp group where there are traders and investors, and they are all not saying good things about what is happening right now. They're taking various angles to it, including manipulation, etc. And it's not helping that you have a global system which is supposed to work smoothly. And then we say that, well, it's because participation is not there and the brokers did not implement the updates that they were supposed to do. Now, why didn't we get the brokers to do the updates first? That becomes the first question. Were they willing to, unwilling to? I'm not sure if you've asked the brokers, are they willing? Do they have a timeline? If that timeline is 1 month, it means that for 2 months, because it takes time to implement changes to the software. Then for that long, individual investors and traders have to take the brunt of it, which means that all the systems and methodology that they have worked upon for months or years is suddenly has to be shunned. They have to probably just pull it down and stop executing, or probably completely change. Like you just heard what was being said, that you change the strategy and you do a different type of strategy. But people have raised funds under particular strategies that they're supposed to execute. And if you're running a strategy or a book, say, for example, and I've raised, say, 200 crores to run an options or derivative hedge book, and I'm looking at things like delta, theta, gamma, which is not only expiry to expiry. See, I think another wrong angle to this entire story is that you're saying that it only matters on expiry days. No, because your closing price is being varied every day. So when you're running a book and you need to make adjustments to various positions based on, the factors that are important to you, whether it's theta, whether it's delta, you'll need to increase or reduce exposure somewhere.
Right. No, Rohit, we entirely take your point. We understand your point that this is a system. Currently, it's facing teething problems, and we're not for even once saying that this is an issue of intent, because the intent is fairly clear. Earlier, it was weighted average, volume weighted average on a closing price, and all the funds and all those traders would actually try to match the closing price basis the volumes, and on those softwares, you would actually see the tick by tick data, and you would get a predictive close as well. Right now, to avoid someone gaming this system is where CAS has come, and because of lack of liquidity right now, lack of perhaps understanding as well right now, maybe people are just taking a bit of a backseat to see where this goes. We are seeing these wild swings. The question is,
Mangalam, yes. I get your point as well. Why should I pay the price for the testing?
Exactly. So then now the question is, now this has happened, right, what should you do? Yeah, no, I completely agree with you.
So you come up with a timeline for all the brokers to implement these apps, and for that time period, you step back. You go back to the old system till you have everybody ready.
Okay.
And they better give you a timeline. I mean, if this is something you want done, then you give a date and you give a timeline to complete. And then you go live with it. There's absolutely nothing wrong with having CAS with all the systems in place. Then we can make a better judgment as to, what is right or not working. But right now, with an incomplete system, we are trying to make a judgment on something which doesn't work. And across different things, like I said, don't just put it on expiry day. I'm someone who looks at charts. You know that. I look at charts every day. If my everyday's closing price is whipsawing from one level to another, then say, for example, I've created a system that gives me buy and sell signals on the closing price. The system is failing every day. It will give me wrong signals. So for me, suddenly the closing price has lost meaning. I need a new system.
Absolutely, point taken there, Rohit. But we're going to, on that note, actually sip into a very short break. We'll come back after the break as well and continue this conversation. Stay tuned in.
Welcome back. You're watching us on this special show, The Cash Conundrum, where we explain to you, the issues that the street is facing currently with the closed auction system, and at the same time, what are the remedies or suggestions that a lot of the participants in the market have for that as well. We've been speaking with Chandan Thaparia as well as we do have Rohit Srivastav as well with us. Gentlemen, we'll come to you. We'll discuss a little more on this as well. But we've been having continuous conversations. You've heard from the SEBI chair earlier saying that they are steadfast on this. It's not moving away from here on. But we also had Rajesh Baheti of Cross Seas Capital join in and give his views too. So let's hear that out before we continue our conversation with Rohit and Chandan.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever it has to do and it has no relevance. Then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well. A lot of the price anomalies that we see is due to the fact that people enter orders and they withdraw it all of a sudden, or they then start modifying the orders. So I think maybe there should be some penalty for withdrawal of orders or modification of orders, because clearly you're putting in orders at 3% up or down initially, and just a minute before the closing period when you can withdraw or modify the same, you end up modifying those orders, and that is creating the journey, is creating a bigger mayhem than just the closing levels that we are seeing. At least allow cash to have 10% or 15% of the market's volumes and then link it to the F&O. I mean, what is the hurry of pushing F&O segment into the abyss? It's a classic case. I feel that there's some stepmother treatment being meted out to the F&O segment.
Right. Firm and clear. Those views coming in from Rajesh. Rohit, coming back to you, you were making a point on if it's not bad intent, there are people who are still losing a fair amount of money. It's a zero-sum game. There are some making outsized gains from this as well. What do you say happens now? I mean, what has happened so far, obviously a lot of people have lost a lot of money. Lots of people have got a big windfall as well. You're saying that the SEBI should now perhaps, go back to the old system. We've heard from the SEBI chair, they don't intend on doing so. What happens?
No, what they really meant is they don't want to roll it back. I'm not even talking of a rollback. I'm just saying get system ready. And system ready means get the broking side, everyone to implement the availability. If you want more participation, all participants should have access, which is today through online, mobile apps, desktop, etc. Everything be ready and then go live again. I don't think people will mind if they are able to see actual prices of everything and participate in that between 315 and 320 till they get the real numbers and adjust their positions. But suddenly after 10 minutes, if you see the Nifty up 100 or 100 points up or 100 points down, then making those adjustments, especially where a lot of calculations are involved, is often difficult. I mean, I'll give you an example from very, very long back. We would run a delta hedge book. When I was in Sherkhan, I spent 18 years there. And this is 2006. We believed that the people who were running it would never lose money. And they always would be able to hedge their delta. But the problem came when you had overnight gaps. So when the market started to crash in May of 2006 and you had a gap down every day, then those gap downs you cannot adjust on delta. You have to do it by taking some hit on your book. And if it happens for 3 consecutive days, the loss can become massive. Now you're doing the same thing because in 10-15 minutes, when the market is opening one way or the other by a large amount, people who are system-based or based on certain logic suddenly can't adjust for those things.
Okay, point taken there. Maybe weave it into the system as well as what you are saying. Give it some time to get adjusted to it as well. But we have a few queries also that have come in from our viewers. And Chandan, I want to ask this one to you. Abhishek is writing to us from Patna. He's used to selling normally at 3:25 p.m. and wants to know now. with the cash system coming into place, when and where can he place that order? Further, he's asking if the auction price can move as much as 3% from the reference price, right? Then how should he be viewing this as well? And what is the price that he should be looking at? When is that can he place this order and look at the pricing finally as well?
Yeah, so very nice question. What I believe that till the market doesn't digest this new CS system, try to reduce the option writing after 315. What we have noticed that in Nifty, if your strike is near to 150 to 200 points, you should reduce the exposure, and same applies in Sensex when you have a strike in between 400 to 500 points. As per the standard deviation, one can bid the price in a range of 3% plus minus. So my suggestion is if you are doing the writing, try to exit it before 315, or otherwise you can go into the next expiry to creating some spread and all. If you are looking for buying strategy, you need to keep in mind either your premium will blast if you are having the nearby strike. So my advice is in Nifty, try to keep 150 to 200 points safer point. In Sensex, try to keep 300 to 400 points if you want to carry any option writing. Otherwise, try to reduce till the system doesn't get digest the new CS.
Right. Thanks a lot, Chandan, for that. We've gotten both yours as well as Rohit's views along with Rajesh, and we also heard what the SEBI chair had to say. We got in a viewer query as well, but this is the first of many shows around the closed auction system that we will continue to do here on CNBC TV 18. Thank you so much for watching. For all your queries, keep writing to us. We'll obviously get them, answered by a lot of the experts that come with us here on the channel. But what we'll do is wrap up on this edition of the special show, The Cash Conundrum. Take a short break, come back on the other side. Closing bell takes you through the last hour of this trading week.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Death toll in the devastating flash floods in Nepal and Tibet rises to 538. Over 1,000 people still missing. This includes close to 300 Indian nationals who remain untraceable. Rescue operations were halted for some time after a lake formed by a landslide on the Nepal-China border started to overflow. Iran agrees to draft conditions to reopen the Strait of Hormuz after Qatar steps in to revive diplomacy. Crude oil prices set for a weekly decline even as Brent moves closer towards $90 a barrel. Sensex and Nifty decline for the third straight week. This is the longest losing streak in 5 months. Rupee strengthens marginally against the dollar but remains above the 95 mark. Thursday's wild swings on the Sensex deepens. The scrutiny around the new closing auction session. SEBI chairman rules out any changes to CAS mechanism despite trader complaints of a casino-like 10-minute window deciding options payouts. Stock markets tread with caution across the world ahead of a speech by U.S. Federal Reserve Chairman Kevin Warsh at the annual banking symposium in Jackson Hole. CNBC TV 18 will bring you the speech live at 7:30 p.m. tonight. India agrees to buy Javelin anti-tank guided missile system from the U.S. The missiles are jointly made by Lockheed Martin and RTX. U.S. Ambassador to India Sergio Gore says there is tremendous potential for defense cooperation. Kumar Mangalam Birla calls FY27 the year of execution and delivery for Vodafone Idea during the company's annual general meeting. Says capex orders worth 9,000 crore rupees placed already. Also reiterates telecom industry's call for periodic tariff rationalization. A U.S. federal judge rules sanctions imposed on Anthropic by the Pentagon are illegal and unlawful. Judge says empty invocation of national security is not a blank check to punish critics of the government. All right, the top story this evening, the death toll in the flash floods in Nepal and Tibet has crossed 500, with bodies being recovered far downstream. More than 100 people are still missing, including over 300 Indian nationals who remain untraceable. Rescue operations were halted for some time after a lake formed by a landslide on the Nepal-China border started to overflow. The police in Nepal also issued an alert saying a dam on the Tibetan side may have burst again. The police asked rescue workers and public to move to safe locations. Nepal has declined offers from several countries to deploy search and rescue teams. South Korea's foreign ministry said it will keep negotiating with Nepal over the matter. As per the reports, the decision is partly based on the country's experience after the 2015 earthquake, when arrival of foreign teams had led to challenges in coordination. Nepal is instead asking countries willing to help to route financial contributions through a single mechanism. Prime Minister of Nepal, Balendra Shah, held a cabinet meeting to discuss the next steps for disaster relief. Meanwhile, External Affairs Minister S. Jaishankar took stock of the rescue effort in Nepal by speaking to the embassies in Kathmandu and Beijing. My colleague Arunima reports from Kathmandu on what has been a nightmarish 72 hours for families who are still awaiting information on their loved ones.
हमारे फैमिली में 5 जना नहीं है। हम लोग तो भागे, सब छोड़कर भाग गए हम लोग।
We are at the Maharajganj Medical Campus. This is the main hospital here in Kathmandu, where family members are now gathering to figure out as to if there is any information. Now you see the main gate of this medical campus, where whatever body has been found, they have put up pictures of those dead bodies with information that they have about from where these bodies were recovered, so that people can find out if this belongs to their loved ones. And you see so many family members here.
आपके जो भाई थे वो इंडियन टूरिस्ट को लेकर गए थे, हाँ, कैलाश मानसरोवर की यात्रा पर लेकर गए थे उनको।
रसवागढ़ी उधर गया था।
रसवागढ़ी गए थे। और वो टूरिस्ट जो थे उनका कुछ पता लगा? वो स्कॉर्पियो में गए थे?
कोई पता ना लगा, कुछ को मालूम ही नहीं। सब संपर्क भी नहीं है ना, कुछ क्या है कैसा है वो मालूम नहीं।
बच्चे बहन का बच्चा 3 है, एक लड़का 2 लड़की है। अभी वो मेरा बहन का क्या हस्बैंड अभी 3 दिन तक हो गए, अभी तक कॉल नहीं लग रहा है।
हॉस्पिटल से कोई कुछ बता रहा है अंदर से?
हॉस्पिटल में कोई कुछ बता रहा है कि क्या है अंदर?
नहीं, हमारा कुछ कोई नहीं है, जो भी है ये लिस्ट में है, तो अभी लिस्ट में नहीं है, अब दूसरे हॉस्पिटल में ढूंढने जा रहा हूँ मैं।
There are such families everywhere. They're all waiting to see if they can gather some information about their loved ones. And this is the situation not just at this Kathmandu hospital, but hospitals across Nepal. NDRF has been on standby throughout, but they were waiting for the Nepalese authorities also to reach out if they required more assistance. So as and when officially that communication goes from Nepal to India, India, we are told, is ready. Already relief material is landing here. Like I was telling you, we spoke to the NDRRM, the Nepal Disaster Management Agency here, and they said, we have enough material. What we are now looking for is also body bags, because downstream there are a lot of bodies that are still being found. Even though the epicenter is Rasua on the Nepal-Tibet border, bodies have been washed downstream, and it's a tough ask to ensure that you collect all the remains of one particular individual in one body bag so that DNA testing becomes easy.
All right, on to the West Asia conflict. The deadlock between the US and Iran continues as Qatar attempts to revive diplomacy. Here are the latest developments. Iran has agreed to draft a set of conditions to reopen the Strait of Hormuz, citing requests from mediators. Qatar's Prime Minister met several top officials in Tehran in a bid to break the standoff. Traffic at the waterway remains choked, with only 7 vessels transiting, according to the ship tracking site Kepler. But despite that, crude oil prices are set to drop this week after the US pivoted to economic pressure. Qatar's Prime Minister met Iran's president, who is scheduled to visit India next month for the BRICS summit. Qatari officials said the talks will focus on reviving diplomacy and reopening the Strait of Hormuz as per international law. Qatar's Prime Minister also met Iran's Foreign Minister Araghchi to push for diplomacy. After the meeting, Araghchi said, and I quote, "Putting diplomacy back on track isn't impossible. It hinges on US understanding of one simple fact. Pressure doesn't work," end of quote. Amidst all this, Washington continues to claim Strait of Hormuz remains open. US President Donald Trump said millions of oil barrels are passing through the strait daily. He also ruled out any negotiations with Iran. The US President's comments were also followed by a rare video address by US CENTCOM Commander Admiral Brad Cooper, who also claimed that US forces have cleared mines from the Strait of Hormuz.
About Iran? There's not a lot to speak to. We don't want to speak to them. We're not looking to meet or anything. The strait is open. We're taking a lot of boats. Millions and millions of barrels of oil are coming out of the strait every day. Other countries recognize that. Every once in a while they shoot some, they put some shots out. We totally cleared the strait we have the best minesweepers in the world.
The U.S. military has achieved a major milestone in the Strait of Hormuz. We have successfully cleared sea mines in the Strait's international shipping lanes that were laid months ago by Iran's Islamic Revolutionary Guard Corps. We have been highly effective. No ships have entered or left an Iranian port without our permission, and we have only allowed ships to pass through on humanitarian grounds, which is a credit to the dedication and professionalism of our sailors, Marines, and airmen in particular, executing this complex mission.
Right, on to the day's market action. Sensex and Nifty declined for the third straight week, marking the longest losing streak in 5 months. This despite a positive close on Friday. Midcaps and the IT index managed to buck the trend. In fact, IT was the top performing index this week. Wild swings on the Sensex yesterday has prompted fresh scrutiny around the closing auction session. Sensex plunged more than 2,000 points in the final minutes yesterday during the monthly expiry of the futures and options contracts. It managed to recover soon after to end with losses of about 250 points. Many traders expressed anguish, saying the new system is akin to a lottery, but SEBI chairman remains firm on the closing auction session and ruled out rolling it back or changing it.
नहीं, अभी हम कोई चेंजेस नहीं देख रहे हैं और सिस्टम ऐसे ही चल रहा है. पार्टिसिपेशन इस पे बढ़ेगी और सब लोग ब्रोकर्स और वो अपनी एप्स में एनेबल करेंगे और लोग सीखेंगे और इस मार्केट में आएंगे.
To me, it's alarming. It's very, very alarming if you make the entire zero DTE trading experience about the last 15 minutes and the rest of the day can just do whatever has to do and it has no relevance, then it's a problem. It will kill the zero DTE market. So if the unintended consequence of this is that it kills the zero DTE market or makes it a pure lottery ticket, a pure gamble, then they've achieved this and all is well.
The Finance Industry Development Council has urged the Reserve Bank of India to reconsider its proposed blanket restriction on revolving credit products offered by NBFCs. The industry body warns the move could have unintended consequences for borrowers, particularly MSMEs. Now, FIDC says some NBFC credit products may not qualify as term loans under the RBI's proposed definition, but they also do not work like credit cards or bank overdrafts. India's telecom sector saw a pickup in subscriber additions in July, with net additions rising to 55.4 lakh. Airtel's net subscriber additions moderated to 27 lakh in July when compared to June, but still remained the highest in absolute terms. Jio saw additions rise to 24.5 lakh. Meanwhile, Vodafone Idea and BSNL added 2.4 lakh and 1.69 lakh subscribers, respectively. Vodafone Idea Chairman Kumar Mangalam Birla has said that the company has moved into a new phase focused on execution and growth after overcoming several legacy challenges. Speaking to shareholders at the company's annual general meeting, Birla said the first quarter of FY27 was the first quarter of net subscriber additions since merger. He added the company is better positioned to take part in India's digital growth opportunity. He also reiterated telecom industry's call for periodic tariff rationalization. Shares of Ather Energy surged after Hero MotoCorp increased its stake in the company. Hero has invested another 1,700 crore rupees for a 3% stake, taking its holding in the EV two-wheeler maker to 32.8%. This comes just a month after Hero invested 1,000 crore rupees for a 1% stake. Fed Chair Kevin Warsh is set to deliver his first keynote address at the annual Jackson Hole Symposium later today. Investors are closely watching whether Warsh would offer details on the US economy, bond markets, and the outlook for monetary policy. According to a survey by CNBC, 80% respondents want the Fed Chair to offer his views on the economy, but they are split on whether he should provide his views on the rates. CNBC's Steve Leisman is here with more on what to expect from the speech.
The Fed chairman's speech in Jackson Hole is always listened to carefully for clues about his outlook for rates. Will he be hawkish? Will he be dovish? This year, markets are listening for whether Kevin Warsh talks about policy at all. He's held back on his views to get a cleaner message of market pricing not influenced by his own Fed speak. But Warsh's colleagues in CNBC interviews here in Jackson Hole have not been shy about offering their outlooks.
I believe now is the time to act. I believe that we've been in an inflationary situation for more than 5 years. It's been running well above our target. I don't see any restriction in policy.
I think we may be a little bit more accommodative, certainly more accommodative than restrictive in the policy rate.
Schmidt did say he thought Fed officials could talk less, while Hammack offered it was her responsibility, she thought, to share her policy views. Tobias Adrian from the IMF writing, quote, broader communication about reaction function remains essential as long as it is conditional, disciplined, and uncertainty aware. Risk should be clearly spelled out. Warsh may give markets at least some of what they hope for tomorrow, potentially making a distinction between what he's willing to say in a speech on his own compared to when he's representing the committee after a meeting of a press conference. Steve Leisman, CNBC Business News.
And you can catch the Fed Chair Kevin Warsh's address in Jackson Hole from 7:30 p.m. onwards right here on CNBC TV 18. Finance Minister Nirmala Sitharaman and her Canadian counterpart held the first India-Canada Economic and Financial Dialogue in Toronto. Talks focused on digital payments, financial services and wider cooperation in issues of shared interest. India expressed its readiness to initiate negotiations on a bilateral investment treaty at the earliest. Both sides welcomed opportunities to broaden the use of UPI in Canada through partnerships with payment service providers. The next economic and finance dialogue will take place in 2027.
The economic and financial dialogue reflects this broad ambition to move beyond traditional trade in goods and services and build a deeper economic partnership encompassing investment, finance, capital markets, and regulatory cooperation.
Canada and India are uniquely complementary. Canada can provide energy security and food security to India. And India can provide to Canada scale, talent, and technology. So I must say that this was a very, very fruitful morning in the launch of the dialogue.
All right, we'll take a break. Coming up, India agrees to buy Javelin anti-tank guided missile system from the US. Details and the significance of this deal in just a bit. Welcome back. US Ambassador Sergio Gore has said that the Indian Army has signed a letter of acceptance for the purchase of Javelin anti-tank guided missile systems. However, there's no official statement from the Indian side yet on the agreement, but the deal has been in the making for a long time. Aishwarya joins us with more details.
After over 15 years and multiple rounds of negotiations, the Javelin is finally headed to India. The US ambassador to India announced this morning that the Indian Army has signed an agreement to take forward the purchase of the Javelin anti-tank missile system. This deal has been years in the making. India first began looking at the Javelin system in 2009, and negotiations began, but they sort of fell through because we were keen on technology transfer. Thereafter, India explored other options, including Israel's Spike anti-tank missile, while also building our own indigenous systems. Talks on the Javelin were ongoing, and the conversation sort of shifted from just buying the missile to potentially building it in India. Thereafter, at Aero India 2025, Bharat Dynamics signed an agreement with Raytheon and Lockheed Martin-owned Javelin joint venture to explore the joint manufacturing of the Javelin in India. Then in November, the US cleared the possible sale of 100 Javelin missile rounds and 25 launch units to India. And now the Indian Army has signed the letter of offer and acceptance under the foreign military sales process, formally taking forward the purchase. The US statement also says that the agreement opens discussions on the co-production of the missile, giving it a Build in India angle.
All right, thank you, Aishwarya, for that. Moving on, sugar prices have surged to a record high, with retail prices rising to around 70 rupees a kilo. Lower domestic production, festive demand and tighter stocks are adding to the pressure. But the ethanol diversion debate has also come into focus. Santya Gora has more.
Sugar prices have surged sharply over the last month. Government data says retail sugar prices have gone up from 48.18 rupees per kg on 20th of July to 55.7 rupees per kg on 20th of August. By 27th of August, this has risen further to 70 rupees per kg. The government attributes this to lower than expected domestic production due to damaged crop, festive demand and instances of hoarding. It expects this season's production to come in at 306 lakh metric tons instead of the initial estimate of 343 lakh metric tons. But the opposition says the government's ethanol policy has exacerbated the shortage. The Department of Food and Public Distribution says that in 2022-23, available sugar stocks stood at 443 lakh metric tons. 43 lakh tons were diverted for ethanol blending, leaving 400 lakh tons for domestic consumption, more than enough to meet that year's domestic demand of 280 lakh tons. In 2023-24, sugar stock fell to 401 lakh tons, and the government stepped in, telling OMCs to keep sugarcane juice and B-heavy molasses for ethanol within the cap of 17 lakh tons. For that entire season, only 24 lakh metric tons of sugar was diverted for ethanol, and there was enough to meet domestic consumption. In 2024-25, however, despite available stock coming in at lower at 375 lakh metric tons, no such intervention was seen. 35 lakh tons of sugar were diverted for ethanol that year. In 2025-26, however, despite production estimates being slashed to 306 lakh tons, 30 lakh tons of sugar have already been diverted for ethanol blending between November 2025 and July 2026, and the season still has 3 months to go. Experts say that unless the government issues a fresh order capping diversion, the sugar available for domestic use may be squeezed. Crystal has also flagged the situation, saying, and I quote, consecutive declines in sugar production due to lower yields and reduced acreage coupled with higher diversion of sugar equivalent towards ethanol significantly tightened inventories despite steady growth in consumption. Ethanol diversion has increased consistently over the past 5 years, rising from 0.8 million tons in sugar season 2020 to more than 3 million tons in sugar season 2026, with further increase expected in sugar season 2027. End quote. However, the government maintains that sugar diversion for ethanol has reduced every year from 12% in 2022-23 to 9% in 2024-25, and that 3/4 of the ethanol produced in the country now comes from grains. It further says, and I quote, this initiative also supports farmers by providing them with a stable income and reducing greenhouse gas emissions. However, this does not mean that ethanol blending would lead to a shortage in sugar for domestic consumption. Adequate sugar stocks are available in the country to meet domestic demand. End quote.
All right, important developments there. With that, it's a wrap on this edition of Business 360. News and updates continue right here. Thank you so much for watching.
and welcome to Startup Street. I'm Arundhati Ramanan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Hero MotoCorp to invest up to 1,758 crore rupees to raise its stake in Ather Energy to 32.8%. Hero, currently Ather's largest shareholder with a 29.88% stake, will acquire additional shares from an existing investor. Dipinder Goyal's Temple acquires London-based longevity clinic Longevis ahead of wearable launch. Financial details of the acquisition were not disclosed. Temple is preparing to launch its wearable device later this year. Pre-seed VC firm Industrial 47 raises 85 crore rupees in the first close of its 200 crore rupee debt fund, debut fund. The fund will back 15-20 early-stage startups across space, defense, energy, advanced manufacturing, and other frontier technologies. Dream 11 pivots to an AI-first global sports engagement platform, moving away from fantasy gaming. The platform will discontinue prizes and focus on personalized sports content, live streaming, stats, scores, commentary, community features, and social contests. Dream 11 COO Vaibhav Kokal has also been appointed CEO. Indigo Ventures invests in Sarvam Series B, deepening its bet on sovereign AI to enhance customer experience, employee tools, and complex airline operations. A U.S. federal judge ruled sanctions imposed on Anthropic by the Pentagon are illegal and unlawful. Judge says empty invocation of national security is not a blank check to punish critics of the government. Those were the headlines that we're tracking for you this evening. On what's brewing today, Indians are traveling abroad like never before, but the demand is also shifting. From standard holiday packages to more personalized end-to-end experiences, Chandigarh-based A-Travel-Q is looking to tap into that opportunity, having served more than 10,000 travelers across 180-plus destinations. Now, the startup has raised fresh funding at a 10 crore rupee valuation and is looking to scale its technology, customer experience, and international travel offerings. Joining me now to discuss this further is Prashant Daroch, the founder of A-Travel-Q. Prashant, thank you so much for taking time out and being here with us on Startup Street. You know, A-Travel-Q is a travel company focused on personalized international travel, right? Take us through the gap that you saw in this travel market that you were trying to solve for, and tell us what's on offer.
This is Prashant Daroch. I'm the founder of A-Travel-Q. So in the last decade, there's a trend which is, growing worldwide, and that is more and more people are traveling as per the customization. For example, Indian used to travel in a group tours to Europe, maybe a decade or two back, but now almost more than 70 to 80% of the travelers, especially those are above, 30 and less than 50 years of age, they want to travel, let's say, to the Europe as per their own demands. For example, they don't want to stay in Paris. They want to stay maybe in the Bordeaux or the south of the France. So that's why the customization travel is the need of the hour. And this is the trend which is going global as well. So that's what we are trying to tap into.
Absolutely. And you've raised this funding at a 10 crore rupee valuation, right? You haven't disclosed how much you've raised, but take us through what the investor thesis was behind backing A-Travel-Q and how much capital have you raised in total so far? Also, take us through how you plan to use these funds.
So far we have raised around 3 CR, and the use of the funding would be in terms of the technology, in terms of expanding to the global. So for example, within a quarter we are launching in US, UAE, and UK also. So the investment which we have raised so far will be used for the destination expansion, and we're looking forward to cater to the global audiences also now. So for example, what we are trying to do is we are building from India to the world. So anybody who wants to travel anywhere in the world, from no matter which destination they want to travel or from where they're based out of, we will take care of that part. And given the fact from India, we can actually deliver. We have this added advantage which only we have. For example, in India, we can actually run a helpline for the customers. Those are during travel where the response will be in less than 60 seconds. And trust me, when you're traveling, when you're in a new country, the response within 60 seconds is a huge help. And, everybody appreciates it. So we're looking forward. So we will use the funding which we have raised to expand globally, to set up offices in USA, UK, UAE, and maybe within a year or two, we'll raise more funds and expand to the more English-speaking countries to begin with, and Spanish-speaking in the second phase.
All right, so that's how you've planned it out. You've served over 10,000 travelers and facilitated nearly 6,000 international trips, right? What are the key growth metrics today? Revenue, repeat customers, and average booking value?
So average booking value is close to 3 lakhs per booking, and the retention rate which we have received so far, and that is because of the concierge model which we have developed. So the retention is close to 70% now, which is a huge in the industry. And this is only possible because right before the travel, we customize everything as per the customer preference, be it where they want to visit, which part of the city they want to stay, what sort of activities they want to do. So this ensures that once customer is back from the trip, there shouldn't be a negative feedback. So far, the 70% retention of the customer is really something which inspires us to go global now.
That's inspiring you to go global. You claim 60 to 70% loyal customer base, right? What's sort of driving such high repeat usage, and how do you differentiate from large online travel platforms offering international packages?
So, for example, we are not a OTAs, we are not a travel company, we are a customized travel plan company, right? So we never ever sell customer packages they see online. So, for example, on any major international platform, you go and you size it. But with us, you can tell us, for example, if you want to travel to Europe, so you can list us of the cities you want to travel, and then we will plan everything as per your preference. For example, location of the hotel is very important. So if customer wants a hotel in the city center, we do that. If they want a hotel in the outskirts, we do that. So one of the key reason, and that is the whole premises of our idea, and that is the customization as per the customer preference is close to 90%, which ensures that customer repeats. The customer comes back to us and they plan the next trip with us also.
All right, and personalization is this key proposition that you have, right? So how much of the travel planning process is technology-driven versus human-led? And where are you using AI to sort of improve the customer experience today?
So, the best part about the AI is the AI sits at the bottom line, but which is very crucial. So what usually used to happen is AI is great for the discovery. So, for example, earlier the itinerary, let's talk about Europe, let's talk about New Zealand or Australia. Earlier the itinerary, for example, customer wants 10 itineraries, right? Or 5 itineraries. Earlier, it used to take 2 to 3 hours, but now it takes less than 5 minutes for a customized itinerary, which suits customer. And then customer goes through it, and then we customize it further by human expert. And our experts, for example, if we have somebody who looks after Europe, they look after only and only Europe only. So AI is actually doing 2 things, and which is very much AI, I'll be very blunt and honest with you. AI is one of the major reasons that we are in a position that we can actually cater to global audiences from India. Reason is very simple. The AI discovery will give us an edge where we can share the itinerary as per the customer preference in less than 5 minutes. And then the human part, the consultant part, they will add value and customize it further. So yes, AI is going to be the foundational stone for us as we're looking forward to grow internationally.
So AI is the foundational stone. And if you could quickly tell us in 10 seconds, top destinations for your clients today. What are the trends telling you?
So we primarily deal in Europe, Iceland, then Norway, then Australia, and New Zealand. So for us, these are the primary destination for which we have seen a tremendous growth in the last almost 5 or 7 years. And the new destinations, especially South Korea and Japan, they are going to be huge in the next 5 to 7 years. And everybody should travel to these places as well.
Absolutely. I mean, they are beautiful countries to go to. But Prashant, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you.
Well, South Park Commons has just closed a $575 million fund for, which is more than double its previous fund, and they're also deepening their India bet. Their first 2 funds targeted ownership stakes of 6 to 8%, but this new fund pushes that target to 50% or more, with meaningfully larger follow-on checks. For more on this, let's bring in Prateek Mehta, the General Partner India at South Park Commons. Well, Prateek, let's start with this $575 million fund for. How much of the fund do you expect to deploy in India? And over what time frame?
We are very bottoms up and emergent, right? So we are not bounded by set formulas. So we look at the opportunities that come our way, the kind of founders that we engage with, and that will determine our pacing, if that is the question. At least this kind of founders that we are meeting today in the Indian ecosystem, we are quite excited. If we look at the Fund 1, which was roughly a $40 million fund, India Fund 1. We've been fairly quick pace on deployment. Over the last 2 years, we made close to about 20, 25-ish investments in India. So clearly fast-paced and reflective of the kind of value creation that's happening here.
You know, interestingly, you're moving from a 6 to 8% ownership target in your earlier funds to 15% or more in this one. What does that mean in terms of check sizes for an Indian founder at the seed and seed plus stage?
No, that's a great question. At seed, we've almost always had a certain ownership target, which has been between 8 to 12%. What we've realized is that founders today, they need conviction early, which is the pre-seed motion. They also need us to stay longer with them as they build out. So, and hence larger fund to be able to double down and invest in our seed bets, and also for breakouts to stay longer as they raise more capital. So, and depending on the kind of bets people are going after, the capital outlay is different. So in deep tech, there might be a requirement for higher capital. Software has become significantly cost efficient, so there might be a different outlay out there. So depending on what founders are building and what they need, we are there to support them.
But Prateek, specifically for the India market, how many companies are you looking to back with this new fund, and how much of the capital is really going to go into new companies versus follow-on investments in your existing 20-plus portfolio?
Look, it's hard to project a number on how many companies will be back because, as I said, it is, today, if you look at most people who are, most VCs who are raising funds, the pace of deployment is high because the rate at which companies are getting created and the rate at which they're scaling has kind of shifted over the last few years. So it is very hard to be deterministic about this, but we will see how things emerge in the larger market and accordingly invest.
Well, essentially, Prateek, you're saying you want to stay with your best companies for longer instead of handing them off to larger funds. But does that mean SPC is effectively becoming a much bigger capital provider through the life cycle of the company? And how much more capital are you really willing to put behind a winner?
It's hard to programmatically answer that question, Ritu. You are aware that our last fund was about $275 million, and this is meaningfully larger. And we do believe that a larger pool of capital lets us support some of the breakouts for longer. Because this is such an uneven game, it is, I'm sorry, I would have loved to give you numbers, and because I'm also a person of specifics, but this is one place where clairvoyance is really hard.
Finally, Prateek, where are you seeing the biggest opportunity for this capital in India? I mean, typically it's AI and software, of course, but fintech, consumer, the newer frontier tech areas, where do you see the most opportunity, and what would make you write a very large early stage check today?
Sure. We are primarily a bottoms-up investor. So we look at what the best founders and best builders are gravitating towards, and we get excited by that, right? We are not the prepared mind kind of investors, but we get inspired by what builders are building. So in that context, having said that, if I look at the specific areas in the Indian context where we definitely seem to have made meaningful progress, right? On the space tech side, we made meaningful progress. On both biotech and biocompute and biochem side, there are like interesting founders coming up. We are seeing a bunch of core AI bets, right, around the intelligence layer and around the infra layer coming up. Of course, you talked about application where a lot of players have already placed bets, and that area will keep emerging. Financial services in Indian context is always going to be interesting because we are eventually very under-penetrated on financial services. I personally have a lot of experience in that space, so kind of a soft corner for that. Eventually, we are a large consumer base, and we will see a bunch of emergent consumer experiences coming by, right? But a large part of the playbook for India is going to be, and our edge is also going to come from areas where globally we outshine on talent pools, right? If you look at the STEM pipeline in India that we have coming out of the top institutes, right? And not only the IITs and BITS, but also the IISCs and TIFRs and larger deep science platforms. My personal belief is that we'll see people going after very ambitious problems from India across all the, you said frontier tech, deep tech, across the board. We have edge on mechanical, chemical, materials, like bunch of places where we have a bench strength of people. And I'm already meeting a bunch of founders who are going after interesting problems in these spaces.
All right, Prateek, we'll leave it at that. Thanks very much for joining us here today on Startup Street.
Great catching up. Good to talk to you, Ritu.
On that note, it is time for us to head into a short break. But coming up next, India's sovereign AI push gets a new boost. Jnani.ai launches Evon 3.3, a foundational model trained in 11 Indian languages. A special conversation on the other side. Stay tuned. Welcome back. It's Sabadaz on Startup Street. Indian AI company Jnani AI is making a bold push towards sovereign AI with the full stack ecosystem designed for enterprises. As part of this play, the company has launched Evon 3.3, a foundational model trained natively across 11 Indian languages. Jnani.ai claims Evon 3.3 outperforms other models on Indian language tasks, while costing significantly less to run than frontier AI models. The company expects its sovereign AI stack to see rapid adoption across both private and public sector enterprises.
Sovereignty is control over intelligence, right? Every entity today, right, whether it's a government institution, whether it's a private institution, every bank, every insurance company wants control over their intelligence, right? And because of this, need for control over their intelligence, we are bringing out a bunch of models, right? First and foremost, we call it Artha. Jnani Artha is our overall sovereign infrastructure, right? We have another model called the Evon 3.3, which is a large language model. It's a 30 billion parameter model. And we'll talk more on this as we speak. And we have Plexus, which is our agentic AI platform. And all this put together, and not just one element, will solve this element of sovereignty that I spoke about.
How does this solution become perhaps the more lucrative option for an Indian enterprise?
See, that's a good question, right? And so what we've been seeing is, in the last couple of months, a bunch of Indian enterprises have been asking me, right, the same question, saying that, look, today we want control on our intelligence, but we use a frontier model, and we are worried that, whatever intelligence that we have is actually getting shared with many of our competitors, right? So what's the solution to this, right? And they were actually, some of them said, look, we are worried. I mean, what's the option? And should we look at Chinese models, open source models? But then, that's not a good solution either, right? So this is an answer to some of those questions, right? So what we are releasing is open source, open weight models. What it means is that every researcher in the country, every developer, every bank, every financial institution can take these models and run it on maybe a single node.
India is fast emerging as one of the most important markets for global fashion brands, but with international players expanding, homegrown D2C brands scaling up, and consumers becoming increasingly value conscious, competition is only getting tougher. So what does it take for a global fashion brand to win in India today? Zenia Bariat speaks to both Mango and Myntra to discuss just that.
Choices that the customer today has significantly got upgraded itself. The choices are much more, and at the same time, I think what doesn't change is the desire for the latest trends, the latest fashion, and when it comes to that, each consumer has its own taste, own interest, and the important thing is for every brand to maintain its DNA and be clear what its DNA is. And today, with the availability of data, with the availability of a lot of information and a lot of various signs that the customer leaves with you, it's possible to actually go much more narrower and deeper in terms of what the consumer and the customer is really looking for, and to be able to target and to be able to fulfill that need. If I give an example on the Myntra app, over the last 2 to 3 years, we have consistently and constantly improved the personalization that we offer for our customer. And based on the various signals that the customer leaves in terms of what they are looking for, the kind of products they're looking for, whether it is a dress at that point in time or a top, and also the price range that they are looking for, maybe the kind of silhouettes that they are looking for. Based on that, the personalization engine offers back much more targeted to what she or he is looking for.
Right.
And that is how we are able to narrow down from the wide plethora of offer that is available to fulfill the need of the consumer much more quickly and much more accurately.
But Mango is not just competing with international brands. It's also competing with a lot of homegrown D2C labels that are there available in India. So where do you see the consumer sitting for the Indian market for Mango?
Our consumer is all over the place. Our consumer, we are in the business of, creating a collection very rooted in our DNA, to be truthful to ourselves as a brand, because we are not here for the next 2 years. We are here for a long run, for a long story, okay? And then our consumer is all over the place. No, actually, in Myntra, and Venu can elaborate more on that, no? Aside of big metros, no, is where we are growing the most.
I want to ask, how much of what you sell globally is sourced from India?
The exact number I would need to check, no, but obviously in India there are very good manufacturers of some categories, no, and at the end of the day, what we are trying is to organize a collection, launch a collection every season, okay, which is designed in Barcelona, in our Barcelona atelier. All the specifications and sketches are done in Barcelona in our facilities, okay? And then we are creating partnerships with a lot of suppliers across the region, okay? Because quality and craftsmanship is super important to us, no? And therefore the exact percentage I would need to check, and I will tell you. No?
Fair enough. So my last question to you: does the India-EU FTA India-EU free trade agreement make it more likely for you to increase the sourcing from India?
100%.
All right.
100%. You know, trade barriers are never a good idea, no? And you know what we want is to offer our consumers the best quality, the best possibility for them to shop, and this is an excellent idea, excellent news.
And with that, it is a wrap on this edition of Startup Street. More news and updates continue right here on CNBC TV 18.
AI, the next frontier. An initiative by NASSCOM and CNBC TV 18.
NASSCOM and CNBC TV 18 hosted the very first edition of AI The Next Frontier in Mumbai. The event explored how enterprises are building AI-native capabilities, from modernizing applications and strengthening data foundations, to redesigning workflows, embedding agentic AI, and rethinking security, governance, and talent. The marquee session at the event was a power-packed discussion moderated by CNBC TV 18's managing editor, Shireen Bahan, on the theme, The Indian IT Industry, New Models, Agentic Delivery, and Value Creation.
I've got a fabulous panel here to address those issues. So without further ado, Rajesh, I want to start by talking to you. 15 lakh crore rupees gone in market cap erosion since the 2024 peak. What is the market not appreciating about the story? Indian IT, as Salil Parekh told me in our interview recently, Indian IT abhi zinda hai. Why is the market not appreciating that?
It's absolutely zinda hai, but I think it's important for us to note a couple of things. One, if you ask anybody in the room, and if you look at the last quarter results of all the companies, the top one included, the medium ones, of course, grew. When you look at the top ones had about 3% year-on-year growth. The medium tier and many of the companies which actually did fairly well at 9 to 12% of growth, and the smaller ones actually even had higher growth. But more importantly, when you go back and look at the order books, almost all of them had the largest order book ever in the history of this industry. So they've all been doing really well. On the contrary, as you rightly mentioned, all of them had a headwind from the stock market point of view. I do not know how the stock market valuation happens, so I can't really comment on what they do. But I can always tell you one thing. They always price for the worst case, and then when they look at the terminal value, they want to make sure that whatever they are seeing on the order books, whatever the story that we've been sort of saying for the last 1 or 2 years, holds good for the long term.
Well, Amit, let's talk to you now in terms of recalibrating growth. And as I said, is the era of double-digit growth something behind us? Do we need to recalibrate ourselves into appreciating the fact that at least for the foreseeable future, for the industry, for companies like yours, it's likely to be low single digit? And what does that then mean for the next 5 years as far as this sector is concerned?
I think I tend to take a pretty bullish approach on things, and possibly by nature an optimist. But if we look at how things are shaping up, we look at a few transitions, and possibly our industry is experiencing one right now. And it's a transition of two pivots. I think that was also spoken about in the first presentation of what's under pressure and what's new. And the growth of opportunity in the new is something that we have been reporting quarter on quarter. It's been last 3 quarters we've been reporting, and that's a mark of confidence and conviction. The path that we have taken, the path that we have chosen. The transition on anything to do with operations is expected to be pushed for efficiency and productivity always, with or without AI. That has always been the candidate, and it will always remain a candidate. But the pivot towards new opportunity is what we are seeing more and more. What used to be an industry known for effort, largely our industry has always been known for how much effort we have put in. I think that pivot is moving from effort to intelligence. Our industry is getting redefined for intelligence. Our industry is getting recalibrated for intelligence, and that's the transition that we are all experiencing right now. But a huge opportunity ahead of us.
Arundhati Bhattacharya, let me address the big question with you. And I think every headline has been screaming about the SaaSpocalypse. Now, how do you, sitting at Salesforce, deal with this?
I think, our results are expected very shortly. So really can't speak about that in as clear a language as I could. But I think that that narrative has already been proven false. The thing is, we are all in a stage of transition. And let me make this comment regarding this outcome-based pricing. When this outcome-based pricing really starts working, they want to go back to the license-based pricing, okay? Because the outcomes are so many, they don't like it then. Then they want to go back to the early one. But having said that, this is a real case.
Yeah.
So, but having said that, on the SaaSpocalypse, you have to understand one thing. The frontier models, you just can't put them somewhere and expect the entire enterprise problems to be solved, okay? Whenever you're deploying something new, there has to be governance, there has to be auditability, there has to be observability, there has to be, various regulatory and other compliances have to be correctly recorded. Not only that, in the architecture that you already have, you don't have a clean slate. You're putting in something where something else is already working. So putting all of that together in order to have the best outcomes, it needs a lot of engineering. It's not something that happens on its own. Neither is it something that, any of the frontier models will resolve on their own. And therefore, the requirement for companies such as either ours or even the service companies, that requirement still remains.
Puneet, as I was saying, the only person on this panel who doesn't have a stock problem is Puneet. Microsoft is still,
so glad.
is still holding up. But, the massive CapEx spends that we're seeing globally at this point in time, almost $700 plus billion between the, hyperscalers put together. Almost 200 billion for Microsoft alone. Now, when we look at this CapEx build out, and I'm asking this in the context of what the opportunity is for this sector here in India, how does this sector benefit from this kind of massive CapEx build out that we're seeing happen globally? Where does the value creation for this sector lie when we talk about this CapEx build out?
Listen, I think first up, the reason for the amount of investments that you're talking about is, and we were having this discussion outside, this is unlike anything else we've seen in our lives. It's the most consequential technology of our lifetimes. And a lot of this CapEx is going into manufacturing intelligence. And intelligence has always been linked to biology. We have always carried intelligence in our small heads. For the first time, we're making compute become cognition, right? For the first time, we're manufacturing intelligence. So that is the race we're on, and that's the reason the investments will continue to go on. To your question on where the value is, and I was with a client recently, and he said, some of these frontier models that I'm working with, they're like brilliant strangers. I said, can you explain this to me? He said, they're brilliant strangers. They know everything about the world. They know nothing about me. Can you get me a familiar friend? Can you get me a child who grows up in my organization, understands my context, the knowledge turns, what does a good work look like? And then get that to answer questions or do work for me, which is where the new value pool is, and Naushir spoke about, right? Which is translating this enterprise ontology, the enterprise context into these frontier models. And getting these models to work for you on your own terms versus the other way around. Satya spoke about the reverse information paradox. Don't pay for these models twice. So I think that is where the real value pool is, and I don't think there's anybody better positioned than the services companies in India.
I think Satya has been on the forefront of this business of the limits as far as renting intelligence is concerned, and something that Palantir, Alex Karp has also been carping about, particularly on CNBC. So we'll get into that discussion in a second. But Srikanth, regretting listing?
Not yet.
Not yet. But would it have been better? Were you still private?
See, I think this, like Puneet has just mentioned, this is the most transformational tech that we have seen in our living memory. And to think of this as just one more small wave that'll pass by is, I think, a big mistake. I think whether this on this panel or anywhere else, if you're making that assumption, it's going to change the world in very significant ways. And 2026 is just the beginning. We are at that point where recursive self-improvement is beginning to happen in the models. These models are already building the next wave of the models. The models are getting better at a rate that's unimaginable. They're doing long horizon tasks. So they're not just being part of your tech budgets. Tech budgets are increasing, as Noshir was saying. Yeah. They're going from 4.5% of revenue to 6% of revenue. So there is a certain increase in tech spends that's happening, and many of the service providers can benefit.
AI, the next frontier. An initiative by NASSCOM and CNBC TV 18. AI, the next frontier. An initiative by NASSCOM and CNBC TV 18.
But let me address the anxiety that not just industry is dealing with, but people are dealing with. What does this mean as far as my future is concerned? What does this mean as far as my child's future is concerned? What does this mean as far as the country's future is concerned? This has been the big job creating sector. This has been the sector that's given, aspiration to middle class India. What happens, Rajesh, there? We talked about the revenue and the headcount decoupling. That is very visible in the numbers. Headcount growth has been flat. With all the opportunities that we've already spoken of, do you believe that we are now unlikely to see net addition as far as headcount is concerned of any significant kind going forward?
No, I think this industry will always be the net addition in terms of the net employee growth year on year. I don't think that's going to go away anytime soon. However, we all know that the kind of growth that you saw in the past is not going to be there going forward. So what does it mean to the broader population, especially people who are coming out of education institutions, so on? I think NASSCOM has taken a view that the curriculum will have to fundamentally change what they are teaching within the university. So we've had a program called AI Curriculum, and we're working with METI and the government closely, also with the education department, to say, how do you really go back to the universities and start to change that fundamentally? TCS is involved in that exercise. So is all the top tier companies that we've been able to enroll in, and then go out and make this transformation.
Arundhati Bhattacharya, we have a job problem and we also have a talent problem, and we need to address both. But on the job front specifically, do we need to recalibrate the way that we've looked at this industry in terms of job creation as far as talent is concerned? This has again been an industry that spent significant amounts of money, set up universities and so on and so forth to train people. I mean, employability has always been a challenge. How do you see industry rising to the occasion of an AI era?
Well, one thing I do see, and in a way I think it pleases me as well. Earlier, for instance, no matter what discipline a student would complete their engineering in, they'd land up in IT. So whether he was an aeronautical engineer or whether he was a chemical engineer or he was a civil engineer, they'd all land up in IT at the end of the day. Those were the jobs that were actually available. Today, on the other hand, an aeronautical engineer is very much in demand, because missile technology is something that's really and truly making its space. Civil engineers, high demand. Okay, hospitals are getting built, schools are getting built, smart cities are getting built. Chemical engineers, again, very high demand on account of the kind of pharmaceutical products that we are coming up with. So my belief is that AI will be the backbone that will release the job requirements in other areas. And again, very simple example from our own company here in India. I have a 5-member research team, market research team. They were addressing only my enterprise accounts. That's all they could do. And I could not afford more than 5 people in that team. Today, that 5-member team covers my entire set of accounts right up to SMB, plus all of the accounts in the ASEAN region.
You know, the jobs issue, but more importantly, I want to pick up the point that Arundhati made in terms of demand expansion, revenue generation. I think, you know, how close are we to move beyond this cost optimization business to actually seeing the benefits of AI show up in terms of revenue and demand?
I think like some of these roles we're talking about, Shireen, didn't exist 12 months ago. The ontology of an enterprise and agent orchestration and hill climbing, like this is new stuff. Like we were talking about new value pools, there are new jobs and new opportunities that are the next generation.
Is it really new stuff or just showing up in a different suit?
No, I think it is definitely new. And I've been in tech for 25 years. All of us have been many years. This is new and this is real. I think the tech is real and these opportunities are real. I think we as parents and as technologists, right, I think we should have a very honest conversation about how careers will shape up in this new world. Careers will still be long, they won't be static. Like my father had a career, it was like a deed that he had, right? Like my kid will have to do a career. So they'll have a portfolio of things to do. And I think that to me is a feature, not a bug, which is what I was telling you outside, which is expecting my 17-year-old teenager to make a choice for his life right now is more pressure than telling him, saying, listen, you get to do 10 things in life. Yeah. Good, bad, ugly, right? It's a combination. Second, AI will amplify all of us, right? I started my career at IBM and McKinsey. The first couple of years were grunt work. All of us did grunt work, right? Which was good and bad. Now, if AI takes away that grunt work, the next generation gets to do more interesting work at the start of it, right? Which means they have a lot more ability to amplify themselves. Again, another gift, right? And they're entering a much kinder world. But you have to be clear-eyed, it's a massive transition. We need a skilling revolution in our country. We've all spoken about this. We're training 20 million people in India, not enough. But it requires a completely different skill stack compared to the ones that we grew up with. And we have to make that transition for the next generation.
Amit?
I think the shift is moving jobs from jobs to careers. I think we have had a very linear thinking as a country, as an industry, that one line of work defines your job and is equal to your career. I think that will get reshaped to a career conversation which can combine a deep job or a combination of jobs across. And I think that's the thinking and that's the effort that we should be putting towards. Make the young generation, make the colleagues conversation pivot towards careers, say that we'll build your careers, we'll help build your path, rather than say that we protect jobs.
Okay. Shrikant?
I think the first thing I want to say is that to the platform conversation earlier, we must recognize that fundamentally there's a shift between labor and capital and machine and human, right? A lot of the work will be done by the machine and much less by the human. So by definition, if you take a static view of the world, the work for human beings will have to shrink. But then comes the next S-curve, which expands the work because there's many more things to be done. The world has infinite number of problems to be solved, and therefore work will expand, and therefore more work will be there.
Thank you very much. Yes, go ahead.
Unlike the most technology disruptions that come through, it starts with research and then standardize, industrialize, and eventually democratize, which makes the price affordable for the technology. But AI is completely taking a different race, right? It came in a different freemium model and now hitting price peaks, like most of us are talking about token economization and things like that. How do you see that as a very suited panel here?
So I think two things, right? And this is, everybody's saying this, the models that you see today are the dumbest and the most expensive they'll ever be. So they're only getting cheaper and smarter, right? So that's the first thing. Second, I think the ability for enterprises to tokenomics or whatever you call it, but the ability to get these, like the first thing I tell clients is don't use frontier models for non-frontier problems. Right, which is just because you have the access to the flying car and you don't take it grocery shopping, right? So I think your ability to orchestrate and get these intelligence at that scale has economics, right? And we now all understanding the economics between cost and capability and our ability to trade off and work with this. So the fundamental models will continue to get cheaper and smarter every day. Our ability to get them to work the right horses for the right courses as enterprises and platform and providers will only get better, right? So that's how we scale this. It's not sustainable to do this at the level it is right now, and that's how we'll scale it.
As AI increasingly takes over the knowledge work,
what do you think should be the competitive advantage in this AI era? As you think?
What will be India's right to win in the AI era?
Look, I mean, as most people have said about this layered cake, and again, we had a conversation about that this morning as well. There are multiple layers, one could potentially play, starting all the way from power to a semiconductor and all of that. I think India will have a play in pretty much every layer. The question is, which are the layers that India can really take leadership? Right? Clearly, I mean, there's a data layer, there is an application layer, there is a harnessing layer. Of course, we're figuring out that is potentially a lot more important for enterprises to truly adopt and then truly get into some meaningful solution. So as a leader, I mean, if your question was leadership in terms of how do we sort of position India in many of this, I believe that's what it is. In terms of ensuring that we are able to take our advantage, which is around talent and around what we could do, enterprise context, domain knowledge, and so on, and then turn it into something who can build the best harness layer in the whole world.
Let me end by asking each one of you, and Shrikant, I'll start by asking you 10 seconds, the most overrated risk, AI-related, and the most underrated AI-related risk.
The most overrated is Terminator. I don't think it's happening anytime soon. It might happen in 20 years, but not happening now. Okay, that's one. And the underrated is the alignment problem. The fact that it can do a lot of damage very quickly. An AI agent that you set out to do a task is doing more damage than good. I think it's underrated. It's already happening. And we will see a bunch of these things happen in this year.
Absolutely. And we have seen live examples of agents going rogue and, people trying to put the guardrails in place at this point in time. So that's a very legitimate and valid concern. But we don't need to worry about Terminators anytime soon. Amit, the most overrated risk and the most underrated risk.
I have a common view to that. Speed.
Fair point. Puneet?
I think the most overrated is AI will replace humans. I don't think that's going to happen. It's going to amplify us. The most underrated is skilling. I think some people still think that it's like a hobby. This is guerrilla warfare against irrelevance every day for all of us. So if you don't take this seriously, the skilling part, I think that is truly underrated today.
Well, the overrated, I think, is the thought that it's a magic wand.
Yeah.
Going to solve everything simultaneously. And the underrated one, I think, is the fact that I still feel people hanging back, not really believing that things have changed materially, and they're not going to change back.
You can't wind the clock back. Rajesh, the final word.
Because I'm representing the industry, so I got to be very careful. The most overrated risk or the comment which I always hear is that it's going to replace all the tech services companies. It's not going to happen. So that's overrated, clearly for me. And the most underrated would be the cyber risk, security and the trust and risk factor, which happens all along. I think we don't speak enough about how much we are not talking about in terms of the real risk of cyber attacks and so on and so forth because of AI.
So the message you want to send out to the market: don't write off Indian IT services.
Absolutely, yeah.
Indian IT, Abhi.
Abhi bhi zinda hai.
Abhi bhi zinda hai. All right. Ladies and gentlemen, thank you so much for joining us here on this panel. Appreciate your time. Thank you very, very much for joining us here this evening.
AI, the next frontier. An initiative by NASSCOM and CNBC TV 18.
For 25 years in the business, I feel like it's been a lifetime. A little bit of reinvention helps.
That is true.
Women thought that men bought them jewelry out of love, but they've used women as conduits to money launder and store black money multiple times.
Moving away from the wedding business, aren't you?
No, the wedding business is still there. I don't need to advertise it anymore. It's a very secure category for us. The room has got too crowded because of social media, and everybody says कि मुझे भीड़ में नहीं मरना है. So everybody is looking for identity. In the global stage, what really sets your identity is where you come from and where you belong, which is one of the reasons I think that, I did a very smart thing by putting the tiger on the logo, because the tiger is a national emblem.
Were you confident when you launched it, and have you been surprised?
No, I was surprised. I was really surprised. I'm never confident because I have imposter's complex all my life. I can't make clothes that make you look like Cinderella stepsisters. The luxury existed in this country because people needed to create distance with money for social status. People who live outside India, they use the accessory as an ammunition to tell people that they come from India. So it becomes...
India has arrived.
When I want people to wear my clothing, I do not want them to represent me. I don't want them to feel that they are representing the country.
You said that you have a difficult relationship with couture.
I see Cinderella in a shirt and jeans.
So you will not need a van to pick up a Sabyasachi outfit? No, never.
I'll kill myself. If I have to make clothing, you would rather fit into an Uber.
What does it truly mean to say that the brand is now going global?
I don't think the brand